a new price action strategy pops up. Some new trend lines, liquidity grabs, Fibonacci tweaks, you name it. And let's be real, it can get overwhelming fast. But what if you had a toolkit that could cut through this noise, giving you the most critical concepts in a powerful way? Well, that's exactly why we built the Price Action Concepts Toolkit. It's not just another trading tool. It's your all-in-one system for coding price action in real time. And by the end of this video, it's a must-have. Color-coded, based on the price action strategy pops up. Some new trend lines, liquidity grabs, Fibonacci tweaks, you name it. And let's be real, it can get overwhelming fast. But what if you had a toolkit that could trend lines, liquidity grabs, Fibonacci tweaks, you name it. And let's be real, it can get overwhelming fast. But what if you had a toolkit that could cut through this noise, giving you the most critical concepts in a powerful way? Well, that's exactly why we built the Price Action Concepts Toolkit. It's not just another trading tool, it's your all-in-one system for decoding price action in real time. And by the end of this video, you'll see exactly how it works and why traders at every level are making it a must-have. Let's dive in. At its core, trading is all about price action, the movement of price over time. No matter the strategy, volume footprint analysis, TPO charts, or any other method for that matter, price action is the common thread that ties everything together. Yet mastering it can feel elusive. That's where the Lux Algo's Price Action Concepts Toolkit comes in. It takes complex market dynamics and simplifies them into clear, actionable insights. And to do this, we start with market structure. Market structure is the backbone of price action analysis. It is a simple and clear way to identify both macro and micro trends. In order for us to simplify this for traders, the Price Action Concepts Toolkit automatically plots key labels at the most important turning points in price. So let's break down how that works. An uptrend forms when the market creates higher highs and higher lows. When a higher low is broken, the toolkit plots a bearish change of character label, meaning we might be entering a bear market. Likewise, in a downtrend, when a lower high is broken, a bullish change of character appears, hinting at a possible bullish market. However, majority of the time, the trend doesn't reverse and instead continues in one direction, and that's where a break of structure label is formed. This confirms that the market is following through with the initial trend shift and is often used as a confirmation to get into trades. So to keep things visually intuitive, these labels are color-coded based on the anticipated direction of the structure change. But if you would like to take it a step further, you can also enable color candles. This will shade your chart candles based on the structure labels. Green candles for a bullish trend, and red candles for a bearish trend. So that's it for structure, right?
You serious?
You see, an experienced trader knows that trends exist within trends. And this can cause you to enter a trade after a change of character or break of structure, only for it to turn out to be a retracement within a much larger move. So to help traders tackle this, we provide two versions of market structure. The swing structure is plotted with solid lines and accounts for more data, highlighting major macro moves, while internal structure identified by dashed lines uses less data and captures smaller structure fluctuations within the larger trend. By using both versions, you can confidently assess market structure and ensure your decisions to enter a trade are aligned with the broader market direction. Once we had the market structure implemented, it was time to tackle the next crucial element: support and resistance levels. These are key price zones where price is expected to react, making them essential for traders when setting stop losses or identifying target areas. Nearly every trader uses this concept in some form, with the most common approach being key swing points as reference levels. But we decided to take a different approach. Based on our research, the most effective and widely used method for detecting support and resistance levels is through order blocks. These are zones where market orders accumulate before a significant move, acting as hotspots of institutional activity. However, we didn't stop at just regular order blocks. We introduced volumetric order blocks. This enhancement not only highlights where orders are clustering, but also provides insight into buying and selling activity at those levels. Additionally, we gave users the flexibility to adjust the time frame for these levels and even detect breaker blocks, adding another layer of market intelligence. This has become one of the most popular features in our toolkit. For a deeper dive into how it was developed, check out our dedicated video on order blocks. And next, we dove into liquidity concepts. Liquidity is the heartbeat of the market. It refers to how easily a market can be bought or sold. After all, trading isn't possible without someone on the other end willing to buy or sell. So, market levels of high liquidity often end up being where traders' stop losses are placed. This creates prime opportunities for market makers. The Price Action Concepts Toolkit brings liquidity to life. Every feature within this category is built with the intent of how users can make trading decisions at these liquidity zones, because trading isn't just about identifying liquidity. It's about understanding how the market reacts to it. Let's break down the features available. First, we have liquidity trend lines. These dynamic zones adapt to real-time liquidity readings. Zones will only appear when market participants have actively sought liquidity there. Traders use these areas as reaction points, either to continue an existing trend or wait for a break to spot potential reversals. And then we have pattern detection. The toolkit identifies a number of bullish and bearish chart patterns in real time. To make decision-making easier, there is also a dashboard displaying the name and type of pattern detected. For instance, if a descending triangle appears, the first thing to note is that this is a bearish pattern. It signals sellers attempting to push prices lower. A trigger for this setup is waiting for the support to break and for the price to start closing below that zone before considering a trade. We also have the equal highs and lows feature, which highlights market areas that are at relatively the same level. These are most significant when they occur in well-established and clear uptrends or downtrends because they can mark the very top or bottom of the market. Once one is detected, the idea is to wait and see if it is followed by a market structure shift in the opposite direction of that trend, making them perfect for an early warning sign of a reversal. And finally, for this category, we have liquidity grabs. This is an advanced way of potentially identifying market manipulation. This feature first identifies liquidity zones and then detects any unusual price action within those areas. If such activity is detected, a bullish liquidity grab appears in blue, while a bearish grab appears in red. This often indicates that the market could start moving strongly in either direction of the grab. If both occur in relatively the same area, it could indicate a higher likelihood of a ranging market, in which case you should avoid trend trading strategies. Now that we have a solid understanding of liquidity concepts, it's time to tackle another crucial category: imbalances. These often occur as price moves toward or away from liquidity areas, creating gaps where supply and demand becomes unevenly distributed. These imbalances in the market will need to be corrected, and as such, they can act like magnets, pulling price back to fill these voids. So, recognizing the importance of imbalances, we didn't just implement one. We integrated 5 of the most significant types. This includes 3 major types of fair value gaps: volume imbalances and opening gaps. Simply select the ones you want, and they'll be instantly highlighted on your chart. As mentioned earlier, price reacts to these zones much like a magnet to metal, making them ideal levels to set targets or to place your stop loss. If being used as an entry method, traders will often wait for a reaction off these key levels before executing the trade. Many of these trades will take place between surplus and deficit zones. To navigate these areas effectively, you need a way to identify these areas. This is where the premium and discount feature comes in. The premium and discount tool simplifies this by dividing the market into overbought, premium, and oversold, discount areas, giving you a clear visual representation of whether price is trading at a favorable level for entry or exit. On top of this feature, there are many psychological levels in trading that are widely used in price action strategies. Traders can enable key price levels such as Monday's high and low, previous monthly levels, and other significant reference points. Additionally, we've recently introduced a Fibonacci tool, but we took it a step further than a standard implementation. Instead of simply plotting fixed retracements, We allow traders to anchor Fibonacci levels between major points on the chart, using almost any feature within the toolkit. Whether you want Fibonacci levels drawn from the premium and discount zones, or between the high and low of an imbalance, the possibilities are endless. So now that we've explored all the features of the price action concepts, let's talk about the glue that ties everything together: alerts. Staying ahead in the market is all about timing, and we've made sure our alert system covers every angle to keep you informed when it matters most. The toolkit offers 4 types of alerts: pre-built alerts, ready to go for a quick setup; any alert function calls, perfect for combining multiple features into a single customizable alert; custom alert creators, offers more flexibility in combining alerts and introduces the ability to set alerts based on sequences. The all-new alert scripting feature allows you to build alerts from the ground up with ultimate flexibility, perfect for advanced users. Because alerts are such a game changer, we've dedicated full-length videos to breaking down each alert type in detail, showing you exactly how to set them up and optimize them for your trading strategy. So no matter what kind of trader you are, you'll always be in the loop and ready to act. Now you can see that what sets the Price Action Concepts toolkit apart is that this isn't just a collection of features. It's a thoughtfully designed system that simplifies your analysis and helps you trade more effectively, from identifying market structure to spotting liquidity zones, imbalances, and key levels. Everything is designed to give you a comprehensive view of the market. You can access this toolkit directly on our website at luxalgo.com. It's included in all 3 of our plans: Essential, Premium, and Ultimate. If you opt for the Ultimate plan, you unlock even more powerful features. You'll gain access to the Price Action Concepts backtester, allowing you to fully backtest every feature within this toolkit, and exclusive access to the first-of-its-kind AI backtesting assistant, an intelligent platform that understands the Price Action Concepts toolkit inside and out, helping you uncover the most profitable strategies this toolkit has to offer by simply asking questions within the interface. We hope you enjoyed this video and learned something new. Thank you for watching, and until next time.
Ah, nature. You always know the right time to call. When life plays dirty, water wipes. Now 2 times stronger and even softer.
Mike, thank God. I know you're on vacation, but we've got a situation.
Hey, what's wrong?
It's my first big campaign, and the pricing is messed up everywhere.
Okay, slow down. Let me pull up Zoho Marketing Plus.
Marketing Plus? Really? You're gonna fix this from the beach?
Yep. First, we'll fix the pricing on the page. Done. Next, let's check what else is on the schedule.
Can I also see everything that's going live?
Yeah, it's all here. Events, emailers, automated stuff, reports.
What about schedule posts? Can I still fix those?
Reschedule, redo, re-anything. All here without hopping tabs.
So, we're sorted.
Almost. Update the pricing doc and brand assets so no one else uses the wrong numbers.
Yep, got it. Honestly, I thought I ruined it all.
You're good. Everything is fixable with Zoho. Now, if you'll excuse me, there is a pina colada waiting for me.
Yeah, sorry.
Run your business on Zoho. These are some of the most advanced overlays and signals ever created on TradingView, refined and optimized through years of testing, real-world experience, and input from some of the sharpest minds in day trading. This toolkit is packed with powerful features, including proprietary machine learning algorithms for trend and contrarian confirmations, dynamic adaptive overlays, automatic take profit and stop loss calculations, and so much more. But here's the thing: to unlock the full power of this tool, it's more than just knowing the features are there. You need to know exactly how they're designed to be used, and that's what today's video is all about. The best practices and pro-level tips to help you absolutely crush the markets, no matter your experience level or trading style. At the core of the Signals and Overlays toolkit are the confirmation and contrarian signals, designed not to blindly tell you when to enter, but but to confirm the strength or a reversal of a trend based on current market conditions. Trend confirmation mode is ideal for trend-following strategies, helping you stay on the right side of the market when momentum is strong. Contrarian mode, on the other hand, is built to spot potential tops and bottoms, making it a perfect fit for mean reversion strategies or traders looking to fade extreme moves. To get the most out of your signals, we strongly recommend enabling the ML classifier. ML, short for machine learning. With this activated, every signal gets a confidence rating, giving you a clear sense of how strong or weak it is so you can better align it with your trade setup. This is hands down one of the most popular features in the entire toolkit, and we've even created a dedicated video that breaks down the ML classifier in full detail. Now, to truly maximize your signals, you'll want to combine them with candle coloring. These two work hand in hand. Let's say a signal rated 2 appears. This typically means you're seeing a retracement in an already established trend. But here's the twist. Not every retracement will stay a retracement. Sometimes that same signal can trigger a full-blown reversal. So how do you know which is which? This is where candle coloring becomes your secret weapon. When a signal 2 first appears, the candles will usually be purple, which is your visual cue that the trend is currently weak. As long as those candles stay purple, you have time to perform deeper technical analysis within that zone to spot the ideal entry point to continue your trade in the overall trend direction. For example, if you notice a higher low forming within the purple zone, you can wait for price to break above those purple candles before considering a buy trade to continue the trend. On the flip side, if a signal 2 shows up, but the candles start transitioning from purple to red, that's your warning sign. This could mean momentum is rapidly building in the opposite direction. This simple color shift gives you a visual roadmap to gauge the market's transition between trends, helping you avoid jumping in too soon or getting caught on the wrong side of the move. The key takeaway: never follow signals blindly. Signals are just the starting point. It's your job to confirm them using the candle colors and your own analysis. Now, what about signals rated 3 or 4? Should you enter the trade immediately? You can, but only if it aligns with your overall analysis. There's no need to rush into a position just because a signal is there. As long as the candle colors are still green, you can perform your analysis within that green zone to identify the best possible entry point. Now, there are also exits plotted which are based on the last signal generated. These exit highlight points in the market where the toolkit suggests caution. You may want to use them to close partials or anticipate a pullback. They're available in both confirmation and contrarian mode. Now, if you're scalping and you want a bit more granularity when it comes to transitions, the gradient candle coloring is available. This is an advanced, highly detailed candle coloring system, so we usually recommend it for more experienced traders. That said, for scalpers, this mode is a game changer, giving you a crystal clear view of those subtle shifts and micro deviations in the trend. The gradient coloring is also available in contrarian mode, but here the colors take on a different meaning. Green areas indicate potential oversold zones, red highlights possible overbought zones, and purple represents neutral or balanced conditions. This combination of ML confidence ratings, candle coloring, and your own analysis is what separates smart trades from impulsive ones. Now, looking beyond the signals and candle coloring, this toolkit also includes 5 additional overlays at the time of this video. Let's break down what each one is designed for. First up, we have the Smart Trail, also a very popular feature of this toolkit. The Smart Trail was designed as a dynamic trailing stop for entries, adapting in real time to account for volatility. You can enable the Smart Trail to help you gauge whether you should exit your trade early before hitting take profit or stop loss. Unlike traditional trailing stops, the Smart Trail dynamically adjusts and pulls closer or moves away from price as it develops. Because of this unique behavior, you'll often see price bounce directly off the Smart Trail, which is why many traders also use it as a potential entry point. Next up, we have the reversal zones, a powerful tool for identifying the expected range in which price is likely to trade. There are a few different ways you can apply this feature in your trading. One common approach is to use it as a guide for exiting your trades. For example, if you're trading from the upper reversal zones and aiming for a take profit to the downside, you might want to reassess your position as price approaches the lower zone. If your target falls beyond the lower zone, it could make sense to either take partial profits or tighten your stop loss as price enters the reversal zone, since based on the data, this is where reversals often occur. Because of its nature, the reversal zones are best suited for contrarian strategies. However, you can also adapt them to trend trading if you know how to read them correctly. In strongly trending markets, the reversal zones may lose some of their value, so you might want to rely on other overlays instead. If you choose to use the zones in a trending environment, you can gauge momentum by watching the candle colors, when price stays within the upper or lower zones and candles remain green for bullish trends, or red for bearish trends, it's often a sign that momentum is still strong. But if the candles flip back to purple, that could indicate weakening momentum and signal a good time to exit. Now, you might be wondering, how do you know if the market is trending or ranging? That's where the dashboard comes in. The dashboard includes a feature that highlights current market sentiment, helping you decide which overlays and features are most relevant for the conditions. We'll cover the dashboard in more detail later in the video. The next overlay is the trend catcher. And just like the name suggests, this feature is all about catching trends extremely early. Forget waiting for confirmations. This one is designed to react fast and get you in first. The trend catcher is highly responsive while still filtering out some market noise. You'll notice cases where the market appears to be trending steadily, and then a single unusual candle can trigger a reversal from the trend catcher. This can be incredibly powerful if used correctly, but because of its reactive nature, we don't recommend relying on it as a standalone feature. Instead, many traders use it alongside their main entry strategy to help filter if it's a good time to enter. It's also perfect for those moments when you have a strong intuition about a setup but can't quite pinpoint the ideal entry. In those situations, the trend catcher can be your best friend, helping you spot early opportunities before they fully develop. Following the trend catcher, we have the trend tracer, a similar tool but much less reactive. While the trend catcher focuses on early signals, the trend tracer excels at identifying the overall trend direction and highlighting stable price points within that trend. This makes the trend tracer especially useful for trend-following strategies. For example, in a bullish trend, you might consider buying when price dips below the tracer, holding the position as long as price stays above it, and then exiting once price starts closing below the tracer again. It's a versatile tool that helps you gauge both trend stability and potential reversals, giving you a more balanced view of the market compared to the faster, more reactive trend catcher. The final overlay is the Neo Cloud, designed specifically for swing traders and longer-term position traders who want to enter positions and hold them for extended periods. Unlike the trend catcher or trend tracer, the Neo Cloud doesn't plot a single line. Instead, it creates a dynamic zone. In a strong trend, in this case, a bullish trend, the lower boundary of the cloud will steadily trend higher, signaling ongoing strength. However, the upper boundary can occasionally plot lower than the previous level. When this happens, it's often an early warning sign that the trend may be losing momentum. The entire toolkit is heavily centered around discretionary analysis, meaning there's no single right way to enter or exit a trade. Because of that flexibility, we designed the Take Profit and Stop Loss feature to work with any of the signals or overlays you choose to trade with. In the Take Profit and Stop Loss section, you'll find a drop-down menu where you can select which feature the levels should be based on. For example, if you choose the Smart Trail, the moment the Smart Trail changes direction, the system will automatically plot both Take Profit and Stop Loss levels. There's also an option to base your levels on the Custom Alert Creator. Combined with the alert scripting feature, this is an incredibly powerful system that allows users to create fully customized alerts for virtually any setup they can imagine. Since these are advanced features, we've created 2 dedicated videos that walk through exactly how to use them. If you haven't already watched those, we highly recommend checking them out to unlock the full potential of these tools. Now, looking back at the signals and overlays, you'll notice that each one comes with a sensitivity setting that you can adjust. This directly controls how reactive the feature is to market data, giving you flexibility to fine-tune it to match current conditions. For the confirmation and contrarian signals, the dashboard offers valuable guidance to help you choose the right sensitivity value. One of the most useful metrics is optimal sensitivity, which analyzes recent price action and automatically calculates the ideal setting for the current market environment. You can simply enter this recommended value into the sensitivity panel to optimize your signals for better performance, or, if you prefer a more discretionary approach, you can manually assess the price action and adjust accordingly. For example, when using the Smart Trail, you can observe how sharp or smooth the current market swings are, then cycle through different sensitivity values until you find one that fits well with the current volatility. This way, if you're using the Smart Trail as a trailing stop, you can be confident that it's properly calibrated to the conditions you're trading in. Beyond that, the dashboard also provides additional insights, including trend strength, volatility, squeeze metric, and volume sentiment. These can all be used to further optimize your overlays. The trend strength reading quantifies the strength of an underlying trend as a percentage, helping traders determine whether the market is trending or ranging. A fire emoji signifies a trending market, while a snow emoji indicates a ranging market. The volatility reading assists users in identifying periods of high and low volatility, allowing for better placement of stop losses. An upward trending chart appears when volatility is rising, while a downward trending chart signals declining volatility. The squeeze metric is a unique tool for detecting when the market is compressing into a tight range, distinct from a ranging market. Once the squeeze reaches 100%, an explosive move is likely to follow. Finally, volume sentiment estimates whether most of the volume within a candle comes from buying or selling participants. And for the ultimate optimization, you can leverage the backtester, which is included in the ultimate plan. The backtester allows you to test any feature in the toolkit against historical data, helping you identify the best performing settings based on long-term behavior. We hope you enjoyed this video and picked up some valuable insights about the toolkit. If you don't have access yet and want to give it a try, you can get 30 days risk-free over at luxalgo.com. Thanks for watching, and we'll catch you in the next one. Today, we're about to show you an indicator that's so innovative. It doesn't just show volume, it translates it. It spots divergences, tracks surging money flow, and even reveals when the latecomers are piling in, giving you an edge before the crowd even knows what hit them. If you're still analyzing the market without understanding volume, you're trading blind. Volume isn't just noise, it's the heartbeat of every move the market makes, and this tool will flip your analysis on its head. The indicator is called the oscillator matrix, and it's built from 5 powerful components: smart money flow, hyperwave divergences, reversals, and confluence calculations. Let's start with the engine behind it all: smart money flow. Money flow and liquidity are the lifeblood of any market, and in the oscillator matrix, they're front and center. The smart money flow feature is designed to detect emerging trends based on the activity of real market participants. When green waves appear, it signals money flow is increasing in the market. Red waves, money is flowing out. But here's where it gets next level. By analyzing the angle of those waves, you can gauge whether buying or selling interest is accelerating or fading. To make that even clearer, this feature includes a threshold system. Above and below the 50-level baseline, you'll see threshold markers that indicate extreme conditions. When money flow rises above the upper threshold, it's a sign of heavy one-sided bullish activity. But when it drops below the lower threshold, you're looking at intense bearish activity. Now here's the thing. When money flow reaches those extremes, the market often kicks into a powerful trend. But we all know the danger that moment can bring. Sometimes by the time momentum kicks in, it's too late to enter, and a reversal could be lurking. That's why we also built in the overflow feature. Overflow occurs when excessive liquidity floods into a trend over a short period. It's often a sign that late traders are chasing the move, and that the trend might be nearing exhaustion. If you're already in a position backed by your analysis, that's your cue to hold, not chase. If you're still on the sidelines, wait for the overflow to fade before making your move. If necessary, you can go into the settings of the money flow and increase or decrease the length to have it more aligned to your type of analysis. Higher values will be more indicative of longer-term money flow analysis, while lower values for shorter-term analysis. While smart money flow and its supporting components focus on volume and liquidity to gauge market interest, you still need clear, actionable triggers to enter and exit trades. That's where the hyperwave comes in. The hyperwave is a normalized, adaptive oscillator designed to capture price trends with precision, without all the noise that plagues traditional indicators. It's your go-to tool for spotting both trends and reversals, and it's made up of 2 components: the hyperwave line and the signal line. The signal line is your trigger mechanism. It can be configured as either a simple moving average or a trailing stop function, and when it crosses above or below the hyperwave, a small dot is plotted, highlighting potential turning points. These crosses are often extremely early signals of trend shifts. On the oscillator matrix, you'll also notice dashed lines at the 80 and 20 levels. These represent overbought and oversold zones. If a hyperwave cross occurs within these extreme zones, a large turning point dot appears, marking a high confidence reversal signal. When you combine this with your smart money flow analysis, you're no longer guessing. You're pinpointing high probability trades earlier and with more precision than ever before. Now that we've introduced the hyperwave, you'll start to notice something subtle but critical within the oscillator matrix: divergences between price and the hyperwave. The oscillator matrix includes real-time divergence detection between hyperwave signals and price action. But here's what sets it apart. Most divergence indicators calculate after the fact, often several bars too late, by which time the move is already halfway done. Ours doesn't wait. These divergences appear in real time. No delays, no lag, just pure, actionable insight exactly when you need it. You can adjust the sensitivity of the divergences to see more or less. And we also added a feature to display these divergences directly on the chart, so you can compare the price to the divergence detected, making it easy to incorporate into your chart analysis. This is the icing on the cake. You can now analyze volume and liquidity to understand market flow, spot ultra-early entries at key turning points, and detect shifts in direction before they're even on most traders' radar. Every feature is crafted by real traders, designed for one purpose: to help you capitalize on your edge with precision. And if you thought that was the end of it, think again. We pushed the limits even further with this toolkit. With so many powerful features working together, we knew there had to be a clear, visual way to interpret their collective signals. That's why we introduced the confluence features. Here's how they work. We have the upper and lower confluence zones. When both the hyperwave and money flow features signal an uptrend, the upper zone is shaded deep green, indicating strong bullish confluence. If only one shows bullishness, the upper zone appears in light green, signaling moderate agreement. The same logic applies to the lower zone during downtrends, using shades of red to reflect bearish confluence. This gives you an instant read on how aligned the core features are at any moment. No second guessing required. But that's not all. The confluence zones measure only two components, so we built something even more powerful: the confluence meter. When enabled, this meter takes into account not just hyperwave and money flow, but also the signal line, divergences, and overflow conditions. A higher meter reading means multiple elements are confirming a strong bullish trend, while a lower reading suggests a powerful bearish alignment. It's the fastest way to see the full story of market sentiment at a glance. And for our final major feature, let's talk about reversals. While reversals can often be identified using tools like hyperwave turning points, overflow exhaustion, or divergences, those are all trend-based methodologies. We wanted to go a step further and build a feature specifically for traders focused on spotting reversals directly. So, if you look above or below the confluence zones, you'll notice small dots or large triangles. These are your reversal signals. When a small dot appears, it usually signals a minor retracement within an existing trend. It's a softer heads up. But when you see a large triangle, pay close attention. These indicate a potential major reversal, and often appear just before significant market turning points. It's a layer of early warning, designed specifically for reversal-focused traders. And there you have it, every component of the oscillator matrix working together in one seamless, intuitive, and powerful toolkit to help you dominate your market analysis like never before. And now that we've introduced all these features, let's go ahead and show you some examples of how you can combine all these features in your analysis to truly get the most out of this toolkit. Now, looking at this price action, the first thing that stands out is the bright green confluence zone. That's your signal that multiple features are aligned in support of this uptrend. But let's break it down even further. Notice how smart money flow consistently made higher highs, each time pushing through the thresholds with strength. That's a clear sign of ongoing buying interest in the market. However, take a closer look. We're also starting to see signs of overflow. Now, remember, overflow doesn't guarantee a reversal. What it does tell us is that late trend participants are jumping in. Entering a trade at this stage carries higher risk, as these are often followed by retracements or even full reversals. And that's exactly what played out. As the overflow signal dropped off, we didn't see an immediate reversal, but a sharp retracement. At the same time, the hyperwave, which had been trending higher, made a notable swing to the downside, ending that strong momentum to the upside. But despite that, money flow was still rising, so buyers were still interested at this point. But then, another divergence was detected. Another strong sign of the market starting to diverge from the uptrend, and a reversal could be imminent. We also have a strong hyperwave signal triggered within the overbought zone. And also notice that we are below the strong reversal signal and the buyer's overflow falling off once again. The market is clearly getting weaker, but to put the nail in the coffin, look at the money flow. Whereas before we were consistently testing and breaking the thresholds, now we're failing to even reach them. And if you mark the previous high in money flow, you'll see we've begun forming lower highs. More sign that buying interest is fading. And right on cue, the market followed with a massive sell-off from those highs. Let's look at another example. In this example, we're looking at a downtrend, and it becomes clear once you examine the money flow. Mark the lows, first, second, and third. Each dip pushes deeper into the threshold, confirming strong selling pressure. But here's the key moment. On that third low, we begin to see overflow. That's our warning sign. Late sellers are entering, and jumping in here would be risky. As expected, the market follows with a retracement, a temporary pullback, as the overflow fades. Now take a closer look at the hyperwave. Notice how it's crossing above the 50 line, while selling interest remains and no overflow is present at this turning point. That's your perfect opportunity to enter a trade. Clean signal, low noise, and strong timing. As the downtrend continues, another overflow signal appears. But thanks to the early hyperwave entry, you're already positioned, avoiding a late, high-risk entry. This is a textbook example of feature confluence, multiple signals aligning to help you time your trades with precision. And these are just two of the many ways you can approach market analysis with the oscillator matrix. The possibilities? Endless. With a toolkit this powerful, alerts are essential, and we've got you covered. The oscillator matrix supports everything from pre-built alerts to fully customizable scripting. Whether you want to catch real-time reversals, divergence signals, or trend confirmations, the alert system ensures you'll never miss a key opportunity. We've created dedicated walkthrough videos on how to set up and maximize these alert features. So if you haven't seen those yet, we highly recommend checking them out. We hope you enjoyed this breakdown and gained valuable insights into the oscillator matrix, a true game changer in market analysis. If you're ready to take your trading to the next level, you can get 30-day risk-free access to this toolkit, along with the Signals and Overlays toolkit and the price action concepts at luxalgo.com. Thanks for watching, and as always, trade smart, stay sharp, and we'll see you in the next video.
Please stop using ChatGPT and Canva like children's toys.
So what should I do then?
First, stop scrolling. Second, download Cursive. Third, use it for 15 minutes a day. And finally, you'll become a master of AI tools.
So this is how I became the most dangerous person in the room. One habit changed everything. I replaced social media with micro-learning. Now, instead of wasting time on social media, I spend 15 minutes a day actually learning how to use AI for writing, planning, brainstorming, the real work. That's it, just one skill a day. This is the 28-day AI challenge built for beginners over 40. Starts tomorrow. Tap the screen to join us and try the one habit that really makes you unstoppable.
For the past few months, we've been on a mission, not just to refine our AI platform, but to completely reimagine what's possible for traders. And today, we're unveiling something that changes everything. First, we'd like to introduce Lucid, the LuxAlgo Universal Conditions Identifier. For the first time ever, users will now be able to effortlessly create strategies that combine components from all three of our main toolkits: Signals and Overlays, Price Action Concepts, and the Oscillator Matrix toolkits. This isn't just a new feature. It's a breakthrough in strategy replication and synergy. Previously, users could only create strategies using the features of one toolkit at a time, while relying on external sources to access limited elements from the other toolkits. Now, with Lucid, you'll be able to access all strategy trigger placeholders from each toolkit at once. For our backtesters, this means we've completely reimagined the approach users take when creating strategies. We've now implemented strategy scripting, where users can combine each toolkit using the Lucid connector, which is now fully possible directly within each backtester. You can now build trading strategies with a level of complexity never before possible, either on TradingView directly or with our AI platform first, making the search for a real trading edge using the best toolkits available on the platform easier than ever before. But we didn't just stop there. Our AI platform now boasts tens of millions of strategies. We've listened, and one of the biggest roadblocks users mentioned was manually recreating conditions in TradingView. Well, we're happy to announce that using our alert scripting framework, strategy reproduction has become much faster, smarter, and more accessible. With just one click in our AI platform, users can now copy strategy conditions from the AI and seamlessly paste them into the backtester on TradingView to recreate strategies in seconds. Plus, the AI now supports advanced strategies that combine all three toolkits for even more powerful results. So let's take a look at how it all works. The AI interface remains intuitive and easy to use. Simply go to luxalgo.com, log into your profile, and click on the AI chat option. This takes you directly into the platform where you can request strategies for over 90 tickers, spanning stocks, ETFs, crypto, forex, commodities, and futures. The AI's ability to interpret user input has been significantly improved. It now intelligently prompts for additional details to ensure the strategy it returns matches your request more accurately. Once a strategy is generated, you can view its performance metrics, equity curve, and a full breakdown of its conditions directly within the platform. If you like what you see, just click the star icon to save the strategy to your profile. It will then appear in the sidebar under Save Strategies, where you can track performance over time, including automatic updates with new trades, and revisit its setup conditions at any time. Now, here's where the latest update changes everything. Previously, users had to manually input all the strategy conditions to recreate them. But now, with a single click on Replicate Strategy on TradingView, the platform guides you through a streamlined step-by-step process where you'll receive a ready-to-copy and paste strategy script tailored for TradingView. So let's follow these steps. Simply head over to TradingView, switch to the correct ticker and time frame, add the relevant backtester and toolkits, as specified in the instructions. Then, if used in the strategy, navigate to the Lucid Connectors section in the backtester. Select the required connectors and then paste in the provided script. And just like that, your strategy is live. From there, you can set alerts or automate the strategy using third-party platforms. And of course, strategy scripting within the backtesters can still be used to create fully custom strategies from the ground up, without relying on AI. Full details on available placeholders and proper syntax can be found in the documentation on our website at luxalgo.com. We've also significantly improved the consistency between the results shown on our AI platform and those generated on TradingView. However, in some cases, you may notice slight discrepancies. If you do, please don't hesitate to report them in our Discord community. To get access to the AI platform, our backtesters, and the new Lucid connectors with copy and paste AI strategy replication onto TradingView. It's available through our Ultimate plan. This is a new era of AI-driven backtesting, and we're proud to help shape the future of technical analysis. We can't wait to see how you'll use it. Thank you for watching. This is the most powerful and advanced backtester on TradingView. At LuxAlgo, we have three main toolkits: the signals and overlays, the oscillator matrix, and the price action concepts. The most frequent questions we get about these toolkits are, do they actually work? What's the win rate? How can we test it for ourselves? That's why we've developed not one, but three cutting-edge systems to backtest every element of each indicator, pushing the bleeding edge of what's possible on TradingView and uncovering extremely powerful and never-before-seen strategies. Today, we're giving you a step-by-step walkthrough of the signals and overlays backtester and explaining all the functions made available right at your fingertips. So let's get right into it. When you're going to backtest a strategy, the first thing to consider is how much data you would like to use in your backtest. This is extremely important because if you use a small amount of data to test or develop a system, it may trick you into thinking your strategy is profitable, when in reality it is not. So, when backtesting, we recommend having at least 100 trades. But the more data you have, the closer you will come to uncovering a strategy's true performance. The backtester allows you to use a certain number of bars, start from a specific date, or use the entire history. If you decide to use the bars option, and you input 3,000, it will only backtest using the last 3,000 candles. If you choose the date option, you can select the exact year, month, and day you would like to start and end your backtest. Entire history, as the name suggests, will use the entire history that can be seen for that ticker on TradingView. But it also allows you to use TradingView's deep backtest feature, which can pull data far beyond what you can see on the chart. Once you've decided when you would like to start your backtest, we'll then need to set up our strategy. Now, the way the Signals and Overlays toolkit primarily provides signals is through the trend confirmation or contrarian modes. These signals can be adjusted to be more or less reactive with the sensitivity input or the autopilot feature. If you are not using the autopilot feature, a dashboard with a list of sensitivity values will be shown, which shows you how well each value performed. We'll cover this feature in more detail later in this video, but this is where you would choose what value to input into sensitivity. Now that we've chosen the sensitivity of our signals, we can move on to setting up the details of our long and short trades. You can enter trades not only based on the main confirmation or contrarian signals, but also based on any of the 5 overlays from the indicator. Here's an example of a trade setup. If you want to enter based on the smart trail, you must first disable the signal type, then enable the smart trail. You can then use the drop-down to tell the system when you would like to take the entry from the smart trail, and we'll use a switch up or down. Now the indicator will take an entry when the smart trail is switching directions. Just like this, the other options also have a similar drop-down, allowing you to choose exactly how you want to use each feature. It is important to note that if you have more than one entry condition selected at a time, they may act as filters. In this example, we have confirmation signals, but we also have the smart trail enabled and set to bullish. This means that a trade will only be taken if the smart trail is bullish when a signal is detected. We can even take it a step further and set the signal to bullish classifier and input values 2, 3, and 4. This way, a trade will only be taken if the smart trail is bullish when a signal is detected, and only if that signal is rated a 2, 3, or 4. Ignore if it's a 1. The trend strength feature from the dashboard is also available. This is a great way to filter out trades in consolidating markets. We can set the reading to be greater than or lower than a certain value before a trade is taken. The session options allow you to choose specific times to enter trades. For example, if I am backtesting the entire year of 2021 but only want to enter trades between 4 a.m. and 5 a.m., we can set that here. And now notice trades are only taken during this time period. We also have access to what is called external sources. We have 3 external sources, and they allow you to use your own indicators as part of the strategy. For example, here we have the MACD indicator alongside the Signals and Overlays toolkit. If we wanted to backtest confirmation signals but only when the signals appear during a bullish MACD reading, which is when the MACD line is greater than the signal line, we can easily do that using the external sources. So for the first option, we select the MACD line, then for the conditional operator, we select greater than, and for the final field, we select the signal line. This now reads, MACD line must be greater than signal line, and since we also have our signal type enabled, it will act as a filter, causing trades to only be taken if the MACD is bullish. One of these 3 external sources allows you to input a specific value, and that field also accepts placeholders such as close, high, and low. For the external source to work, you must have your external indicator on the chart, and the indicator must provide a plot for the signal you want to use in the backtester. Now, by default, when a trade is taken, the trade will remain open until another is detected. But if you would like to ignore new signals until you reach take profit or stop loss, then you can enable this feature to don't allow trade until closed. Speaking of take profit and stop loss, our next section covers setting stop loss and take profit options. The system provides a number of ways to set profit or stop loss. You can set your stop loss to a specific price, currency amount, a certain number of ticks, percentage, ATR value, or a trailing stop loss. The take profit options are the same, except instead of a trailing stop, you have a forecast option. The forecast option is an advanced feature that looks at the performance of past trades and determines the most likely take profit zone based on past performance. The trailing stop feature is based on percentage, and if enabled, it will trail the price, preventing you from giving back profits as it moves in your direction. If I want to set my trade to have a 1-to-2 risk-to-reward ratio, I can simply select my stop loss feature, for example, ATR with a value of 1. Then, if my take profit is also set to ATR, I can set that to a value of 2. The value inputted in the box acts as a multiplier for the value returned by the option selected, and if you have plot, take profit, and stop loss enabled, you can see them visually on your chart. External sources also make a return here, allowing you to use external indicators as take profit or stop loss triggers. It functions just as we showed you before. However, when using an external source, you will be able to close partials. For example, once a take profit condition is met, instead of closing 100% of your trade, you can close 50% and allow the rest to run. You can also do this with built-in exits provided by the Signals and Overlays toolkit and the exit long and short time, which allows you to close partials or the full trade at a specific time on the chart. And our final exit options are exit on signal and exit on entry. If exit on signal is enabled, it forces the system to exit a position once a confirmation or contrarian signal is detected, and the exit on entry option forces an exit when a new position is detected. We also have the overlay settings, which allow you to adjust how reactive each overlay is to price data. This is very useful as it helps us adapt to different market conditions to find what works best. Just make sure to copy these settings to the Signals and Overlays indicator as well. That way, you'll be able to see the changes on the chart. We also have settings for the forecast feature. When the forecast is enabled, the way you can think about it is if the projected forecast is in the same direction as your trade, it might have a higher chance of being accurate. This can also help you determine where to potentially place your stop loss if executing trades manually. Below that, we have the optimizer. This optimizer works alongside the advanced optimization dashboard. The optimization dashboard provides a quick overview of which settings will give you the best performance on the asset, allowing you to fine-tune the indicator based on your desired outcome. The dashboard returns information such as the number of trades taken, win rate, profit factor, maximum drawdown, potential ratio, and which sensitivity value yields the best performance. If we want to test more sensitivity values, we can simply increase the range of values here. By default, the dashboard is set to find the sensitivity value that returns the highest profit, but we can adjust that to prioritize any of of the other stats available on the dashboard. The entry price area feature allows you to see the running P&L of an active trade, where red indicates when the trade is in drawdown and green shows when it is in profit. This allows you to visually see how long your trades typically remain in drawdown before moving into profit. And finally, you will find the long alerts messages and short alerts messages options. This feature allows the backtester to trigger an alert when any of these conditions are met. The entry message triggers when your long or short entry conditions are met, and the exit message will trigger when you exit a trade based on a signal or built-in exits. The trailing stop and stop loss options will alert you when the stop loss or take profit levels are reached, and the TS option will alert you when the trailing stop causes an exit. The exit long take profit and stop loss will provide an alert if you are using external sources for take profit and stop loss. Now that we've gone over all the features within this backtester, let's quickly go over how you can use these features together to backtest a new strategy. Now, we can, of course, create a new strategy to backtest, or we can easily find a strategy that is already performing well using the AI backtesting assistant. If we go to the AI assistant, we can let the AI know what asset we're trading, what time frame we would like to trade, and what features we'd like to use. With this, we can pull from thousands of strategies to find one with a low drawdown or a high win rate. Maybe we want over 1,000 trades. There is so much we can get using this AI. It will provide all the details we need for the backtester, such as the entry conditions and start date, and we can just input those and start optimizing our strategy. But of course, we can also create a strategy from the ground up on any market, and it's also super easy to do. Here's how we'll approach it. Here, we're looking at a random asset, and we can see that the strategy's performance by default is not very great. However, we also see that this backtest is based on a small amount of trading data. So we'll increase the number of bars to ensure at least 100 trades in our backtest. Now that we have a larger sample size, we can begin improving our strategy, as it is still clearly underperforming. We'll continue using the signals for entries, but a good starting point is checking the dashboard to see which sensitivity value is suggested as the best based on these market conditions. After inputting that value, we now have a slightly better performing strategy. Now, it's usually a good idea for your strategy to have a fixed stop loss or a trailing stop. So we'll head to the take profit and stop loss options and set a trailing stop to limit the drawdown and secure profits as the trade moves in our favor. As I input different values, notice that the suggested sensitivity value in the dashboard changes. This is because the optimizer constantly determines the best sensitivity based on the conditions used to enter and exit the trades. I think we found a good value. For this strategy, we want to allow the possibility of trades running into extremely large profits. So we won't set a take profit option, since our trailing stop will track the price and can also act as our take profit. We'll also add a trend-based overlay in order to help filter trades only in trending markets. And we can also go down to overlays settings and adjust the value of the overlay until we start to see decent performance. We'll go down to the settings and also increase the range of sensitivity values to make sure there are no other values that might offer better performance. Now, things are starting to look much better. At this point, it's important to remember that just because a strategy performed well does not necessarily mean it will continue to perform well in the future. To illustrate this, imagine you're a driver on a racetrack. Up to this point, you know the route well. You know when to take 2 left turns and 1 right turn based on past experience. However, if you continue driving into unfamiliar territory and assume the same pattern applies, you could end up making a wrong turn and getting into an accident. In trading, relying solely on past data without adapting to changing conditions can lead to poor future outcomes. We need to ensure we have a robust and adaptable strategy. We hope you enjoyed this video and learned something new about the system. All these features and more are covered in great detail in our documentation at luxalgo.com. Thank you for watching, and we'll see you in the next one. You've been long and hard about your strategy, did some small testing here and there. But what if you could instantly see how your strategy would have performed in the past, without wasting hours manually replaying charts? Enter the Price Action Concepts Backtester. This is the second backtester in our ultimate package, and it's fully loaded with all the features you love from our Price Action Concepts toolkit, plus a few surprises. By the end of this video, you'll know how to backtest your existing strategies and even craft entirely new ones. So with that said, let's get to it. The first thing you'll see when opening the Price Action Concepts backtester are the backtesting window settings. This is where you define exactly when your backtest starts and ends, giving you full control over the historical data you want to test. Next, you'll land in the long and short conditions setup. This is where the magic happens. Every feature from the Price Action Concepts toolkit is available here, ready to help you define your trade entries, exits, and everything in between. And trust me, we've made sure you have a ton of flexibility to fine-tune every detail. Let's walk through a few key features and how to use them. So we're looking at long conditions, and you guessed it. This is where you'll set up the rules for your buy trades. For long conditions 1 to 3, the first dropdown lets you choose between a bullish or bearish condition. The second dropdown lists all the available triggers, including change of character, break of structure, and some more nuanced options like price entering or exiting an order block. For example, if we set the condition to bullish, any of the triggers we then select will be based on a bullish condition. And if we select enter order block as our trigger, the backtester will trigger a buy trade whenever price enters a bullish order block. Likewise, if we set the condition to bearish, then the opposite applies. The backtester will take a buy trade when price enters a bearish order block. Now, to the right of that trigger, we have one more option, which is the step setting. If you're familiar with the price action concepts indicator, you'll know this allows you to create alerts based on specific sequences, and we've brought that same power into the backtester. We'll demonstrate how this works as we set up the second buy condition. For condition 2, let's set the trigger to detect a bullish break of structure. As soon as we do that, you'll notice all trades disappear from the chart. That's because we have both conditions currently set to step 1. With everything being set to step 1, this means that both conditions must be true at the same time for a trade to trigger, which for these conditions has never happened. To fix that, we'll change condition 2 to step 2. Now, the backtester will first wait for price to enter a bullish order block, step 1. And only after that happens will it wait for a break of structure, step 2, before triggering a trade. This step sequencing feature also works seamlessly with the external sources in the session's filters, truly giving users more control over how your trades are executed in the backtester. But there's one more critical feature to highlight here, the invalidation behavior dropdown. This comes into play when using steps, ensuring your conditions are met in the exact order you've defined. Within the steps dropdown, you may have noticed an invalidate option. If any condition is set to invalidate and occurs in the middle of your sequence, the entire step sequence resets back to step 1. But the invalidation behavior setting gives you even more precision, allowing you to choose whether to invalidate if step 1 repeats, or if any step at all repeats out of order. It's an incredibly powerful feature for creating precise rule-based strategies, and once you understand it, it opens up endless possibilities. Everything we just covered for long conditions also applies to short conditions and exit conditions. The logic works the same across the board. Now, exit conditions allow you to define exactly when a trade should close. So, for example, you can set up a buy trade and have it closed only when the RSI becomes overbought or the MACD changes direction. But if you're not looking to use external indicators or any price action-based theories from the dropdowns to handle your exits, we've got you covered with a full set of traditional take profit and stop loss features. Here, you'll find options like ATR, trailing stops, percentage gains, and more. All these exit conditions give you the flexibility to exit trades using classic technical analysis methods or dynamic price action rules, whichever fits your strategy best. If we scroll down even further, you'll find all the price action concepts features organized into categories, including market structure, volumetric order blocks, imbalances, and so on. Each of these can be fully optimized to match your trading style. For example, if you're using imbalances as a trigger in your long or short conditions, the backtester will by default look for fair value gaps. But right here, you can customize that to use any of the other available imbalance types. You can even change the length of order blocks, market structure, any feature really, since we made it a top priority to make sure users can fully fine-tune every detail of their strategy. And below this section, you'll be able to also enable the forecast feature, which analyzes your past trade performance and provides an estimated forecast for future trades over a user-defined number of bars. Once you've theorized your strategy, back-tested it, and you're now ready to move into forward testing, you can fully automate that process with alerts for every single trigger within the backtester, allowing you to sit back while your strategy runs on autopilot. With this backtester, paired with the Price Action Concepts Toolkit, you can build strategies from the ground up or bring in strategies you've been trading manually and finally see how they perform across any market with full historical data. But there's another way to approach this. Alongside the backtesters, you also get access to our AI Backtesting Assistant platform, the first of its kind AI agent designed to completely transform how you discover trading strategies for any market. Here's what makes it so unique. This AI understands the Luxalgo Price Action Concepts Toolkit inside and out. It can instantly generate back-tested strategies that already meet your custom criteria. For example, if I want to trade Bitcoin, I could simply ask the AI for a strategy with over 100 trades, using the Price Action Concepts Toolkit, and requiring at least one imbalance and one order block as part of the logic. I could also set minimum performance requirements, like a profit factor above 1.5 and low drawdown. And just like that, the AI delivers a strategy that fits the bill. ready to trade immediately or further refine in the backtester. It's a game changer for strategy development and optimization, putting cutting-edge AI and backtesting power directly into every trader's hand. We hope you enjoyed this video and learned something new about the Price Action Concepts backtester. We'd love to hear your thoughts, so drop a comment below and let us know your biggest takeaway or any questions you have. Thanks for watching, and we'll see you in the next one.
Today, we're unveiling the new Lux Algo screeners. So as you know, we've had all of these exclusive toolkits a part of Lux Algo, and just recently we have introduced the backtesting system in a higher plan for people that want to backtest all of our exclusive toolkits. But as of today, we now have exclusive screeners that perfectly coincide with all three of our Lux Algo exclusive toolkits. And what these do is that they aim to give you a simple way to find trading opportunities across the assets that you want to screen for. So we're going to do a full walkthrough in this video for how these screeners actually work. But first, let's take a closer look up at all of the features. Okay, so now let's do a full walkthrough for how these screeners work on your charts, as well as what advanced features are included, and of course, how you'll be able to get access as a Lux Algo user. So there's actually 3 screeners that go with each Lux Algo toolkit, but for the sake of simplicity, since they're all the same structure and have the same components, but just different features per each toolkit, we're going to go over the signals and overlays screener. So before we dive into all of the settings here and how this all works, what is a screener, right? A screener is a simple way to find trading opportunities. And in the case of Lux Algo, we've introduced very complex screeners because we have tons of different elements a part of our exclusive toolkits. So we have the signals and overlays toolkit here, which you all know, and this has various different ways to display signals, whether you're trend following or a contrarian trader. It also has different ways to adjust the signals and introduce various specific indicator overlays like the smart trail that's enabled here on the chart. Then it also has a dashboard with various metrics like trend strength, volatility, the squeeze metric, as well as volume sentiment. So what we've done here with the screener is we've given you a full panel to visualize all of these different components across a multitude of assets that you can select, as well as all timeframes for each specific asset. So you can quickly take a glance at the screener, however you set it up, because it's fully customizable and displays in real time, which metrics or features are aligning to something that you want to go and take a look at as a potential trading opportunity. So as a very basic example, say you have a bunch of crypto tickers or a bunch of stocks here on your screener, and you want to take a quick glance through at which of these have bullish confirmation signals active, which is displayed right here in this column. You can quickly see that Apple stock on the 15-minute chart has a strong bullish confirmation signal active, as well as all of the different features within signals and overlays that you enable as a part of this. So you can quickly see all of the information that you need about specific tickers that you can select directly within the screener. Now, by default, the screener, since it has tons of components from the entire toolkit, is at the bottom of your chart just like this. And the reason for that is that this is a more traditional approach to using a screener, similar to the built-in screener by TradingView. But if you want, you can fully customize this and easily put it on top of your chart just like a dashboard by simply dragging and dropping, going into the settings and scrolling down to the location and putting it to the top right or the bottom left is what I would recommend. And then, of course, you would simply just disable a good amount of these features so that it can more properly fit here directly on your chart as an advanced dashboard for Lux Algo toolkits. All right, so now here we go. We now have a super advanced Lux Algo signals and overlays based dashboard on the chart. And the really awesome thing about this is that it can easily do multi-time frame per each specific ticker. So if we want to look at the daily time frame for all of the tickers that we're watching, whether it's stocks, Forex, or crypto, absolutely anything directly from TradingView's built-in ticker search here, we can go and right next to it select the daily time frame or any time frame so that this screener is specifically displaying the time frame that you want to see. Okay, so that's the ticker section right here, as well as the time frames. And the first thing that you will notice within the settings is the sort by drop-down menu. So sorting allows you to easily go ahead and organize this in a very simple way. So if you wanted to sort the screener by the rating, which is just a general confluence of all of the features included within the screener, you can go ahead and select rating right here within the dropdown. And now you'll see that the screener is actually sorted from strong bullish down to strong bearish automatically so that you can go and easily look for the most bullish tickers, for example, directly at the top of the screener from the tickers that you select. So we know based on this screener setup that GBP USD on the 15-minute chart is the most bullish out of all of the other tickers that we have selected within the screener. And of course, since there are tons of other metrics that are included within the signals and overlays toolkit, as well as the screener now, you can go ahead and select the other options within here if you want. If you want to sort the screener by trend strength, the volatility, squeeze metric, the volume sentiment metric, or the number of exit signals that have gone off, you can actually sort your screener in these various ways as well. And if you click ascending, it will just show you the bearish to the bullish. So it's just simply flipped around. Now, scrolling down here, we have the tickers and timeframes, which we just went over. Then you will notice that we have the signal section, which has the algorithm set to confirmation by default. But if you're more of a contrarian trader, like you're trying to find reversals specifically, you're not trying to just follow the trend, you could set this to contrarian so that the screener will specifically use the contrarian signals algorithm within the signals and overlays toolkit. And just like the signals and overlays indicator itself, it has a sensitivity setting so that if you're someone that likes to use higher settings for your signals from within the toolkit, you can go ahead and easily set this as well within your screener. And now moving on to the screener elements, you can see that we have absolutely everything as a part of the signals and overlays toolkit directly within here. So by default, you will see something like this, where we have the ticker and the time frame, the actual price that's updating in real time, as well as the percentage change on the day that's updating right here. Then you have the rating, which just gives you a breakdown comparing all of the other elements within the screener. Then you have signal, as well as the exits that have occurred. Then you have the overlays on by default, which is Smart Trail, the Trend Catcher, and the Trend Tracer. And then you have these other metrics, which are incredibly useful in the context of screening, which is the trend strength, the volatility, and the squeeze metric. So the reason why I bring that up in terms of the metrics specifically being really useful here is that, for example, on the daily time frame, looking at the squeeze metrics, we can easily see which assets on a high time frame are likely to be in a squeeze, right? So we can see here, NVIDIA on the daily is at a 3.18% squeeze metric. And just because it's been in a solid uptrend for many, many months now, that is definitely not considered an opportunity for trading a squeeze to the upside. However, if you look at Apple on the daily chart, this is up at 97%, which is much more likely to be in a potential squeeze on the daily time frame. And of course, you can look at the other metrics quite simply as well across these different tickers. No matter what chart you're on, you can see that the S&P 500 on the daily has a 95% trend strength. So you may not want to consider fading that asset here on this time frame. And you can easily just go ahead and get a quick overview of all the features you want to display here on your chart directly. Now, since this is just a walkthrough and a tutorial, we are enabling a ton of different features. This is the default, and you will by default have this in the bottom pane below, which is set to the location of top center. When you go to the bottom of the settings menu, you can select the location as well as the screener size, so that you'll see it just like this in a more traditional view for a screener. But again, you can simply drag and drop, and then considering that this is on top of the actual price display, you will likely want to consider disabling some of these features if you're using it more like a dashboard, so that it's not this massive and doesn't get in the way of the actual price. So if you wanted to make a small dashboard that's just considering the main components that you want, like the price, the percentage change on the day, quick and actionable information, but just the signals, no overlays, and we don't even need a rating for this. We just want to see the metrics as well as the signal and the percent change, and then put it in the top right of the chart. We can see just how useful this is compared to typical dashboards that you'll see for technical indicators. And if you see this price scale on the left side of your screen, you can just simply right click on the right side price scale and merge it all into one. That can typically happen when you're dragging and dropping elements onto your chart, just like we did to get this right here. Now, the next component of how this screener can really be taken to another level is the filtering. So you see that we have the screener elements here. We have all of the features from the signals and overlays toolkit, but you'll also notice that they're all set to none, which means that they don't have any filtering for what assets are actually showing on the screener here in the top right. Now, if I go to signal and I select only strong bullish confirmation, which is what this symbol is right here, we can see that the screener has now gotten rid of everything besides the tickers that are in a strong bullish confirmation based on the signals. And this is a very basic example of what sort of filtering you can do with this new screener for the signals and overlays toolkit. So this can be especially helpful if you don't always want to have the full set of tickers on your chart and you're really looking for a specific setup to go and quickly see as you start your trading day and want to actually look for assets to trade based on what things you find notable within the signals and overlays toolkit. And you can introduce multiple filters at once. Say that you want your signal to be a strong bullish confirmation and your trend strength to be above 70. We can go ahead and enter that right here. And you'll see that the only 2 tickers out of all 10 tickers that are selected here within the screener with their designated timeframes, of course, are the S&P 500 and NVIDIA on the daily chart. So that just shows you how the filtering can work and how custom your setups can really be for using these exclusive screeners as a part of the Lux Algo indicator suite. Now, we're really excited to have this released for all Lux Algo users, coinciding with which indicator toolkit you have. So if you have just the price action concepts toolkit, you'll have the price action concepts screener for completely free. If you have the premium and you have the signals and overlays, the oscillator matrix, and the price action concepts, you will have 3 screeners available for you completely free to coincide with your exclusive toolkits. So I know we just went over the signals and overlays in this video, but for all of the other Lux Algo toolkits, they have screeners that are set up in the same way so that you can scan, for example, market structure, order blocks, imbalances, and various different features like that for different styles of trading with their own individual screeners. Now, of course, in the highest plan, we have the back testing system, which is a bit different and takes these toolkits to another level in terms of giving giving you an ability to actually backtest all of the features within all of our toolkits, and all members who have access to the backtesting system will also, of course, be given access to our exclusive screeners for all 3 of our Lux Algo toolkits. So everybody should be added in by the release of this video. If not, it will definitely be within about 24 to 48 hours. And if you have absolutely any questions on that, please go to our website and contact the customer support live chat, and they'll be able to make sure that you are all set. Now, for all new users that join us, you will be given access to the exclusive screeners as a part of which toolkits you get access to directly on our website, which is luxalgo.com. Okay, so we're really excited to have this released. It's been heavily requested within our community, and we know it's going to give all of our users a lot more functionality in terms of finding trading opportunities across the assets that they trade. Of course, feel free to leave us feedback within the Discord in the feature request channel, and make sure to go down in the description, check out all the links that we have there. We have the Discord community as well as our Twitter and TradingView accounts. So make sure to go and follow those to stay up to date on everything that we're doing. And thanks for watching, guys. We'll see you all.
Right course.
You started trading to gain freedom, but now you spend hours staring at charts waiting for the perfect trade. You ran from one prison and ended up in another. To avoid this trap, alerts are very important for any indicator, and that is precisely why our team spent months developing the most powerful and advanced alert system ever created for an indicator on TradingView. In this video, we'll break down alerts across our toolkits into 3 main categories. And at the end of the video, we will explain our most powerful alert system that allows users to create very specific conditions and sequences in a way never seen before. So let's get into it. For our first category, we have built-in alerts. These are predefined alerts created around the main features of each indicator. To access these alerts, you first need to ensure the indicator is on your chart. Then, click on the Create Alert icon at the top of the window. A new panel will open, and where it says Condition, you want to select Lux Algo Signals and Overlays. Click on the drop-down below, and you can now see all the alerts available for this indicator. You'll notice that there are 2 options here called Any Alert Function Call and Custom Alert Condition. These are more advanced options that we'll discuss later. All the other options listed here are based on signals that could be generated by the indicator. If you're not sure what each option is referring to, you can learn about them using the alert reference page in our documentation at luxalgo.com. For now, let's say I want to get an alert whenever a bullish confirmation signal is detected by the indicator. I will simply select Bullish Confirmation. You will then need to tell TradingView how often you would like the alert to be triggered. I want the alert to be triggered once per bar close, meaning when the bullish confirmation is detected, the alert will be sent once, but only when the candle closes. Finally, we can give our alert a name and type a message we would like to receive when the alert is triggered. Then click Create. Now we'll get notified when a bullish confirmation signal is detected. While this is great for basic alerts, there is one issue. If a user wants to receive alerts for other conditions, they would need to create a new alert for each condition, and users can only create a limited number of alerts. So our developers got to work, and that's where our second alert system comes into play. Any alert function calls. With any alert function calls, users can create a single alert that will be triggered by multiple conditions by simply checking the options they would like to get alerted for. To use these alerts, click on the indicator settings and scroll down until you find the Any Alert section. I can select Bullish Confirmation, Bearish Confirmation, Bullish and Bearish Exits, Stop Loss, and Take Profit. Below those conditions is a box we can use to input a message we would like to receive when any of the above conditions are met. Then click OK. Now you want to go back to create an alert and select Signals and Overlays, but this time select Any Alert Function Call. We can set a name for the alert and click Create. Now, if any of those 6 conditions are met, the indicator will notify me with this one alert. The next method of creating alerts is our most advanced option to date and is available across all 3 of our main indicators. If you go into the settings of the indicator and scroll down, you will see a section called Custom Alert Creator. This system allows users to create unique alerts based on specific sequences of events. Here's an example using the Price Action Concepts toolkit. First, let's enable market structure, order blocks, and liquidity grabs. Now, within Custom Alert Creator, I can enable and select Bullish Liquidity Grab to get those alerts. But if I only want to get that alert if the liquidity grab is also a bullish structure change, I can also check market structure and select any internal bullish. The indicator will now create a highlight bar at the bottom of the chart to show you every single time those conditions were met. But what if we wanted an alert to be triggered only if the conditions were met in a specific order? That is also possible with our system. By default, if the step values are left at 1, all the conditions need to be met simultaneously for the alert to be confirmed. To have them confirmed in sequence, we simply change the step values. Here is an example. We can have a liquidity grab as step 1, any internal bullish structure as step 2, and price entering an order block as step 3. And not only can users create these sequences using features from our toolkits, but the system also allows users to integrate external indicators into the custom alert creator. For example, if you happen to use the MACD as part of your setup, you can use one of our external step options to access the MACD indicator. Let's say I want a bullish change of character, but only if the MACD histogram is above 0. First, we need to ensure we have the MACD indicator on the chart. Then, we want to use the custom alert creator to select the bullish change of character for market structure, and then use the external step to select the MACD histogram. Use the conditional operator greater than, and enter the value in the last box, which in this case is 0. Now, we will only get an alert if there is a market structure change and the MACD histogram is greater than 0. Once you've created your sequence using the custom alert creator, you need to go back to alerts. Select the toolkit and then select Custom Alert Condition from the drop-down menu. Name the alert, set a message, and click Create. Now you have created one alert based on those conditions. The Custom Alert Creator is an extremely powerful tool that every user should take the time to learn and master. In future videos, we'll discuss using placeholders and creating alerts with the backtesting systems. We hope you enjoyed this video and now have a better understanding of how to create alerts when using the toolkits. Don't forget to use the documentation for more information regarding alert creation and how each option works. Also, join our Discord to provide feedback or suggest updates to the tools. Let us know what features we should cover next. Thank you for watching, and we'll see you next time.
Ah, nature. You always know the right time to call. When life plays dirty, water wipes. Now 2 times stronger and even softer.
An AI that guides you in creating winning trading strategies. Whether you're a beginner or experienced, you'll find this tool useful. In this video, we're going to break down how you can use the LuxAlgo backtesting assistant, from logging in and exploring different strategies to customizing and fine-tuning them to match your style. By the end of this video, you'll see just how transformative this assistant can be for saving you time, boosting your confidence, and making smarter trading decisions. Let's get started. You can access the AI backtesting assistant directly from our website, or by going to luxalgo.com/backtesting as an ultimate user. Once logged in, you'll land on a dashboard where you can start requesting strategies. To get started, you'll see prompt suggestions, or you can type your own in the chat box. We'll start by using one of the suggestions. Provide a strategy with simple conditions and good results. Keep in mind that while it has access to thousands of strategies, it will only return a couple at a time to avoid overwhelming users. In this table, you can see details for each strategy, such as the ticker, toolkit, net profit, and more. Below that, it will provide you with more in-depth details, such as the exact entry conditions of that strategy and even the date the first trade was taken. And now that we have 2 strategies, we can dig deeper with the AI to compare the strengths and weaknesses. This can help identify issues we might overlook initially. For example, between these 2 strategies, when we look at the weaknesses, we see the price action concept strategy has a small number of trades, something you might not have noticed at first. So, let's ask the AI for a price action concept strategy with a higher trade count. Now, we get a strategy with more trades, but notice the asset has changed. This highlights an important point. To get the best results, we need to be specific with our prompts, letting the AI know exactly what we need. For example, I could input, provide me a strategy using the signals and overlays indicator on Bitcoin 5-minute time frame. The strategy should have over 50 trades and a high profit factor. By specifying the toolkit, asset, time frame, number of trades, and profit factor, we guide the AI towards more targeted outcomes. And while it's great to have the system just provide strategies, we can use it beyond that to develop more complete trade ideas. For example, let's say we're trying to determine which asset to trade. We can ask the AI, with your understanding of Bitcoin and Solana, which of the two is more volatile? So it seems Solana is more volatile. If Solana is more volatile, we can ask, what strategy is good for trading volatile markets? And it provides us with a number of options. Let's go with mean reversion strategies. Now, let's ask, provide me with a mean reversion strategy for Solana using the Signals and Overlays toolkit that has over 50 trades and a high profit factor. Notice this time I did not specify the time frame or the features to use. This is because, in this scenario, I am most concerned about the profit factor. The AI already understands how mean reversion strategies work and what features from the indicator to use for such a strategy. I just want a strategy that has more wins than losses over the last 50 trades. It's good to remember that by not being too specific, the AI can search through more conditions. So if you're having trouble locating a strategy, consider loosening the conditions a bit. A single change can make a huge difference. Now, looking at the results, we can see it's using contrarian signals from the Signals and Overlays toolkit. This is good for mean reversion strategies. It has over 100 trades, has a high profit factor, and a really low drawdown. Now this is good, but let's ask for some more details. When was the last trade for this strategy, and what time frame is this strategy on? And now we know the last trade wasn't too long ago, and this strategy is on the 5-minute time frame. And we can see the net profit of the strategy, but we can also ask the AI to provide the net profit as a percentage of the starting balance. It's important to remember that all strategies in the AI are back-tested using a balance of $10,000 and the same order size. So the profit is relative to the trade size and account balance used. To demonstrate this, assuming we like this strategy, let's go ahead and recreate it on our chart. First, we'll go to our Solana chart on the 5-minute time frame. Since this strategy is for the Signals and Overlays toolkit, we'll also pull up our Signals and Overlays backtester. The strategy starts on August 23rd, 2024, so we'll input that into the start window. Now we'll need to enter the long and short conditions. This strategy is using normal contrarian bullish signals along with the bearish trend tracer for long conditions. The short conditions are using normal contrarian bearish signals with the bullish trend tracer, and just like that, we now have the strategy on our chart. We can go to the Properties panel and change the account size and order size to better match our real-world account balance. From here, we can further develop this strategy by asking the AI how we can further improve metrics such as the win rate or drawdown. The possibilities are endless. Let's look at some other strategies we can find using the AI backtesting assistant. Let's ask, across all tickers, provide me with a strategy that has over 2,000 trades and a low drawdown. And just like that, we've gotten a strategy with a low drawdown and over 2,000 trades, which would usually take forever to develop on your own. We can also ask the system to provide us with 3 strategies, all with over 50 trades. Comparing multiple strategies allows us to identify the strengths and weaknesses of each, helping us choose the most suitable one for our specific trading goals. We can also be very specific with the features we'd like to use. We can ask the AI to provide us with a strategy that uses the steps feature from the price action concepts, has a drawdown below 30%, and also uses the liquidity grab as part of the steps. And there it is. We've truly made it that simple to find a strategy. So go down to the link in the description for access, and you'll be able to experiment with different strategies that work best for your trading goals right away. We have many updates planned that we can't wait to share with you, and look forward to your feedback. Thank you for watching.
Monzo Business is Britain's most recommended business bank account for overall service quality. Recommended by businesses like Clanico Club Coffee Shop in London. So here's raising a cup to you, Clanico Club. When it comes to crafting coffee, you're the business. Make the switch and join over 800,000 other UK businesses already banking with us. Search Monzo Business today. Service Quality Survey Awarded 2025. Visit monzo.com/service results. UK sole traders or limited company directors only. T's and C's apply.
We just released the very first AI backtesting tool for trading indicators. 2 years ago, we announced our first backtester for our exclusive indicators, and for the first time, directly answered the question, does this indicator actually work? We allowed users to backtest everything within our Signals and Overlays toolkit. Since then, we've listened, we've refined, and when the time was right, provided 2 additional backtesters, making the most complete framework for data-driven analysts using our best toolkits on TradingView. So, over the past year, we've monitored how our backtesters were used, where users faced challenges, and where they found success. And today, we're excited to announce the newest addition to the suite, the AI Backtesting Assistant. The LuxAlgo AI backtesting assistant is trained on a vast number of parameters from our exclusive toolkits and is capable of providing backtesting data on nearly 1,000 individual strategies. Not only will the system deliver backtested data based on our premium indicators, but it will also dive deeper into the analysis, offering suggestions and allowing you to compare strategy performance across different markets. In effect, it's like having your own personal secondary analyst, one that fully understands the LuxAlgo indicators you're using and your goals as a trader. The AI backtesting assistant can provide strategies based around whichever assets are chosen by the user, returning information such as win rate, profit factor, drawdown, and much more. It's able to automatically sort through the best settings and combinations of features you want to give you the best possible strategies right away, without you having to go through and find these on your own. For an example of how it can be used, let's look at an Amazon chart on the 15-minute time frame. Let's assume you've completed your analysis, and you're now looking to go long at the current price. Maybe there isn't enough room here for 1 or 2 losing trades. So you'll want a strategy with a higher win rate to increase the chances that the next trade will be correct. Typically, you'd need to customize, tweak, and test endless combinations of settings within the toolkit's backtester to find the optimal strategy. But instead, now you can simply use the AI backtesting assistant on the LuxAlgo platform. The assistant already understands every single setting of our indicators, understands the current price action on Amazon, and can find the ideal strategy for you within seconds. A user may type, "The Amazon stock has broken out of a range and is now retesting the high of that range. I want a strategy with a win rate above 60% that uses the trend catcher to take a buy trade." The assistant will then look at current price action and provide the best strategy or entry conditions based on this scenario. Once it provides a strategy, you can take it a step further, requesting details on what features are being used, sensitivity value, the exact entry and exit conditions. The possibilities are endless. Let's pull up the Bitcoin 5-minute chart. We can ask, what's the best win rate strategy for BTC/USD on the 5-minute chart that uses overlays and confirmation signals? And with that simple request, it provides the strategy. If we happen to change our mind and want to focus on a different metric, like profit factor for example, we can type, how about which of the strategies has the best profit factor? And using the context from earlier in our conversation, it will give us exactly what we need with the conditions we described earlier. So far, we've demonstrated how it can be used to return simple strategies with simple request, but it can also handle more complex requests and strategies as well. If we don't have a specific asset we'd like to focus on, we can ask, what is the best profit factor strategy across any futures ticker? But it needs to be a 3-step price action concepts combination strategy. In our price action concepts, users can create custom sequences of events before a trade is executed, and the LuxAlgo AI backtesting assistant understands this. It will search all available futures tickers, find a strategy that uses 3 steps before executing a trade, and provide the one with the best profit factor. Of course, you can then optimize this based on other metrics such as win rate, net profit, and even drawdown. You can even request general information about an asset, allowing you to develop more complete trade ideas beyond just your technical analysis. Backtesting your strategy with any combination of indicators is essential. It is the only way to truly know how robust and effective your strategy will be. However, we understand the struggles of manually doing this on TradingView with a backtesting script. Not only may it feel inefficient, but for the non-technical user, backtesting can seem very daunting. This is why we created this, to make backtesting strategies more accessible to everyone. Not only for advanced traders, but also for the non-technical who want a simple interactive assistant that helps give them the insights they are looking for on any market. For this initial version of the AI backtesting assistant, it will work on 20 of the most traded assets in the world and 3 of the most important timeframes traders need. It fully understands both our price action concepts and the signals and overlays toolkit. We have many amazing updates and features planned for this tool, and as powerful as it seems now, this is only the beginning. You can imagine how much further this can go as we add more features, data, and refine it over time with our community of over 150,000 traders. As this new assistant is designed for our backtesters, it is accessible with our ultimate plan on our website, which not only gives you access to the AI assistant, but also 9 other exclusive tools, the complete suite of 10 incredible products. Existing ultimate users automatically get access to the assistant, starting now. This is a new frontier of backtesting, one that is powered by artificial intelligence, and we're happy to be at the forefront of this transition for technical analysis. We look forward to your feedback and to see how you'll use this product. Thank you for watching. This feature lets you transform any strategy into a fully custom alert directly on TradingView. No limits, just pure creative control. It's called alert scripting, and it's by far the most powerful alert system ever developed on TradingView. We're putting that power right into the hands of every trader. We'll guide you through everything you need to know, from placeholders and operators to syntax and real-world script examples. By the end, you'll have the skills and knowledge to build the most powerful alerts and take part of, or your entire strategy to the next level. So what exactly is alert scripting? Simply put, it's a way to create fully custom alerts from the ground up. Unlike basic alerts, which are predefined and trigger on simple signals, alert scripting allows you to build alerts for just about anything you can imagine. Each alert script is made up of 3 key components: placeholders, operators, and the syntax. Once you understand these, you'll be able to create any alert you can imagine. We'll start with placeholders. There are over 100 placeholders available when combined across the price action concepts, the signals and overlays, and the oscillator matrix indicators. And they can be grouped into 7 main categories. The first, which are the market data placeholders. These placeholders include anything related to basic data on the chart, such as a candle close, open, or volume. Next, we have time-related placeholders. These allow you to carve out specific time periods to trigger your alerts, such as the New York, London, or Asian session. External placeholders allow you to use up to 5 external indicators as a part of your script. For example, the MACD, the Bollinger Band, or a moving average. They all can be combined with the features of the Lux Algo indicators to create more complex alert systems. Next, we have custom alert creator placeholders. These allow you to reference a setup that you might have created using our previous alert system. Next, we have sequencing placeholders. These will help when creating alerts using the steps feature, or if you're invalidating a condition. Which now brings us to the toolkit-specific placeholders. These are placeholders that are exclusive to each of the 3 toolkits and provides you with direct access to all the features within each indicator. And finally, UDP, or user-defined placeholders, lets you create a brand new placeholder based on a set of conditions you define, and then you'll be able to reference those conditions in the future by just using that placeholder name you created earlier. Now, this is a lot to take in, but stay with us, because we'll be showing you examples of using these placeholders shortly. But before that, to make use of these alerts, you'll be using them alongside what are called operators. These can be broken down into 3 categories. There are comparison operators, which, as the name suggests, can be used to compare 2 or more items. For example, to check if 2 items are equal, greater than, or not equal to each other. There are also cross operators that help identify the exact points where 2 values intersect. The logical operators will allow you to connect blocks or conditions together. This will be done using the key phrases of and or. And finally, we have the historical referencing operator, which allows you to access past data. To start using them, go to the settings of the indicator. Scroll down to the alert scripting section. And this is where we can start combining our placeholders and operators to create alert scripts. So let's break down the anatomy of a few alert scripts here. This script is for the oscillator matrix. We're checking for a bullish divergence occurring during bearish overflow, but the hyperwave must also be below the 50 level and has started to trend higher. Now, to break down this script, we have 5 placeholders and 6 operators. 3 of those operators are logical operators, 2 are comparison operators, and 1 is an historical reference operator. Placeholders are always enclosed in curly brackets. This is how the script knows they are placeholders, and the operators are being used to collaborate those placeholders. So we have a placeholder that is first looking for a bullish divergence, but the AND operator ensures that this condition will not be true unless there is also an oversold bullish hyperwave. Once both of those conditions are met, it then looks for an overflow reading that needs to be below 50%, and the current hyperwave reading needs to be greater than the previous hyperwave value. And if this hyperwave reading is true, it means the hyperwave slope is upwards. Now, this is an example where we use the AND operator. The AND operator means that all those conditions must be true at the same time in order for the alert to be triggered. Let's look at another example where we use the OR operator. In this example, we're using the Signals and Overlays toolkit, and we're looking for bullish confirmation signals within a specific time period. We're still using an AND operator, but notice how we also have an OR operator. So now we have 2 main blocks of script which are looking for bullish or bearish confirmation signals during a specific time of the day, and they are connected with an OR operator. So either of these conditions needs to be true in order for an alert to be triggered. Now with this system, you can of course create really complex alerts spanning multiple lines. So what if I wanted to reference this exact set of conditions again without rewriting the entire thing? Well, that's where UDP, or user-defined placeholders comes into play. This will allow us to easily reference this set of conditions at any point in the future without rewriting the entire script. For example, to access these conditions again easily in the future, all we need to do is create a new original placeholder name. We'll call it session execution and have it equal to the conditions we outlined. Now we can call session execution at any point in the future to be able to use those exact conditions again. Now, UDPs, as well as any placeholders for that matter, can also be used in steps. The steps feature allows conditions to be executed in very specific sequences before an alert is triggered, and to achieve this we'll use line breaks. In this example, we're looking at the price action concepts toolkit, and in this sequence, which uses steps, we're looking for the following conditions: a 200 simple moving average crossing under the closing price, then a bullish change of character, followed by price entering an order block with higher buying volume than selling volume, then a bullish break of structure. Let's break down the alert script. In the first line, we define our UDP, which checks if the buying volume is greater than the selling volume within the order block, and we name this placeholder volume checker. We will be using this later in the script. On the next line, which represents the next step, we check if the external indicator has cross under the closing price. External one is the moving average, which we have on our chart and have set using the drop-down menu. Next step, we check for a bullish change of character. And since there are two types of bullish change of characters, we use the OR operator to check both. We then check if the price has entered an order block, but we're also going to use our volume checker UDP, which we defined earlier. And by using an AND operator, we ensure that both conditions are true. So we're checking if price has entered an order block and that buying volume is greater than selling volume. Once these conditions are met, we move to the next step, which is checking for a bullish break of structure. But we can add further logic to this. We can also incorporate an invalidation step using the invalidate feature. We will have it restart the sequence from step 1 if at any point during these steps a bearish change of character forms, or if the number of bars between steps is equal to or greater than 40 candles. This will ensure that the sequence happens exactly how we defined it, and also that the steps are not too far apart. This is a great example of how you can use the alert scripting feature to create really complex alerts for your strategy. Now, as much as we've covered today, we're still only scratching the surface of what's possible with this new feature, but we hope this video gave you valuable insights into how alert scripting works and how the scripts can be constructed. We're excited to see how you'll use this feature. Let us know about your experience in the comments, and be sure to join our Discord community to provide feedback and help shape future updates to this feature. Thank you for watching, and until next time. Order blocks are one of the most popular concepts in trading, but with hundreds of methods and videos on this concept, it's nearly impossible to know exactly how to draw or use them effectively until now. We went ahead and dug through thousands of order block concepts and teachings to develop one of the most comprehensive methods of detecting and displaying order blocks ever seen on the platform. And while doing so, we found some very interesting observations you're going to want to know about. So, with the help of some of the best programmers on the platform, we set out to develop and integrate what we learned directly into our price action concepts indicator. And in this video, we're going to show you exactly how order blocks work, the best way to implement them in your trading, and in the end, share a secret that 80% of users are unaware of when using order blocks. Order blocks refers to areas in the market where significant buying and selling activity accumulates before a large move. These areas are theorized to be used for liquidity by large institutions, so when the price returns to these levels, typically, there will be a strong reaction. Now, whether the theory is true or not, we needed to figure out exactly how to identify these areas. We wanted to make sure they had practical use cases, and after careful observation, we started to notice something. Across all methods of detecting order blocks, one single thing remained consistent. As the price moves away from an order block, this causes a shift in market structure, creating a change of character or a break of structure. So in our indicator, bullish order blocks are positioned at the low of bullish structures, and bearish order blocks are positioned at the high of bearish structures. But there's one problem. When order blocks are detected and price returns to those areas, we noticed that a lot of them are completely ignored. So knowing where order blocks were located wasn't enough. We needed to go deeper. That's when we decided to take the volume data and plot it on the order block. But we didn't stop there. We then separated that data into buying and selling activity, where the green bar shows the total buying volume and the red bar shows the total selling volume. So as the price returns to these areas, you can see if there is more buying or selling happening at that level. It also provides a percentage to show how significant an order block may be based on the total trading activity, allowing you to identify potentially weak and strong order blocks. But that wasn't enough. When an order block is mitigated, this leaves behind what's called a breaker block. Buyers or sellers are theorized to now be trapped at these levels. And if price returns to this area, those traders will start to close their positions. This activity may cause price to move further in the direction of the break. With this understanding, we went ahead and integrated what we call volumetric order blocks. This allows users to not only automatically detect order blocks on the chart, but also get valuable information about those blocks to make more informed trading decisions. We even include tons of customization methods, allowing flexibility on how users may want to use these features to tackle the constantly changing landscape that is the market. Now that you made it this far, let's dive into some examples. Then we're going to reveal an insight that 80% of users are unaware of when trading with these order blocks. First, go to the settings of the Price Action Concepts indicator, and you'll see volumetric order blocks. We want to ensure we have the Show Last option enabled. This will allow order blocks to be displayed on the chart, and you can increase this number to see more order blocks or reduce it to see fewer. Then, make sure internal buy and sell activity is enabled, along with show metrics to see the data for each order block. Now let's say you just had a bullish change of character and you're looking to take a buy. But buying here is a mistake, since you might be buying at the high of the market, so let's wait for a retracement. The indicator has already automatically plotted an order block for you below this change of character. And if we look at that order block, we see that there's more sellers than buyers in that area, yet the price went higher. This could be an indication that the sellers are exhausted at these levels, and a return to this area could be a pull on liquidity to go higher. In this other example, we see that a bearish market structure was created with more selling activity, which could mean that price has a strong probability of continuing to trend without an immediate retracement to the order block area. But if the price does return to that order block and it's mitigated, we can go back to settings and enable breaker blocks. This will plot the level where the order block was mitigated, and as the price returns to this level, we can use it as a break and retest to seek longs as a potential reversal setup. We also included a time frame feature allowing users to see order blocks from any higher or lower time frame. Here, we can see we're on a 30-minute chart, but I can use the time frame option to display order blocks detected on a 4-hour time frame, potentially identifying more significant areas on the chart. These are just some of the many use cases for these volumetric order blocks. That being said, here's a secret that most traders aren't aware of when trading order blocks. When an order block is created, the data shown on the order block is not just for the specific candles it's drawn from. It actually extends beyond those candles, providing data for the entire structural shift. Meaning, you'll get to know the trading activity of that entire block of price action, providing never-before-seen insights for sentiment analysis. The indicator includes other features, such as a mitigation method. This is set to close by default, and an order block will be considered mitigated only when price closes below a bullish order block or above a bearish order block. But you also have the options of wick and average. The hide overlap option is very helpful in situations where there are overlapping order blocks displayed on the chart. Enabling this option will cause the indicator to only display the most relevant ones. The length option will allow you to change what swing points are used to detect order blocks, and by default, this is the same as the market structure. We understand the importance of allowing flexibility here, so you can change that and use a different swing point for order blocks without changing your market structure. That being said, by the time you watch this video, more settings may be added or removed as we're constantly improving these tools. But you'll always be able to find out more on those changes at luxalgo.com by going to Resources, selecting Guides, and choosing Price Action Concepts, or by using the ChatGPT feature and get answers to specific questions. We hope this video helps you better understand how order blocks are constructed in the toolkit, exactly how they work, and can be used in your day-to-day trading. Let us know in the comments what features you'd like us to cover next, and if you would. Order blocks are one of the most popular concepts in trading, but with hundreds of methods and videos on this concept, it's nearly impossible to know exactly how to draw or use them effectively until now. We went ahead and dug through thousands of order block concepts and teachings to develop one of the most comprehensive methods of detecting and displaying order blocks ever seen on the platform. And while doing so, we found some very interesting observations you're going to want to know about. So, with the help of some of the best programmers on the platform, we set out to develop and integrate what we learned directly into our price action concepts indicator. And in this video, we're going to show you exactly how order blocks work, the best way to implement them in your trading, and in the end, share a secret that 80% of users are unaware of when using order blocks. Order blocks refers to areas in the market where significant buying and selling activity accumulates before a large move. These areas are theorized to be used for liquidity by large institutions, so when the price returns to these levels, typically, there will be a strong reaction. Now, whether the theory is true or not, we needed to figure out exactly how to identify these areas. We wanted to make sure they had practical use cases, and after careful observation, we started to notice something. Across all methods of detecting order blocks, one single thing remained consistent. As the price moves away from an order block, this causes a shift in market structure, creating a change of character or a break of structure. So in our indicator, bullish order blocks are positioned at the low of bullish structures, and bearish order blocks are positioned at the high of bearish structures. But there's one problem. When order blocks are detected and price returns to those areas, we noticed that a lot of them are completely ignored. So knowing where order blocks were located wasn't enough. We needed to go deeper. That's when we decided to take the volume data and plot it on the order block. But we didn't stop there. We then separated that data into buying and selling activity, where the green bar shows the total buying volume and the red bar shows the total selling volume. So as the price returns to these areas, you can see if there is more buying or selling happening at that level. It also provides a percentage to show how significant an order block may be based on the total trading activity, allowing you to identify potentially weak and strong order blocks. But that wasn't enough. When an order block is mitigated, this leaves behind what's called a breaker block. Buyers or sellers are theorized to now be trapped at these levels. And if price wasn't enough, when an order block is mitigated, this leaves behind what's called a breaker block. Buyers or sellers are theorized to now be trapped at these levels. And if price returns to this area, those traders will start to close their positions. This activity may cause price to move further in the direction of the break. With this understanding, we went ahead and integrated what we call volumetric order blocks. This allows users to not only automatically detect order blocks on the chart, but also get valuable information about those blocks to make more informed trading decisions. We even include tons of customization methods, allowing flexibility on how users may want to use these features to tackle the constantly changing landscape that is the market. Now that you made it this far, let's dive into some examples. Then we're going to reveal an insight that 80% of users are unaware of when trading with these order blocks. First, go to the settings of the price action concepts indicator, and you'll see volumetric order blocks. We want to ensure we have the show last option enabled. This will allow order blocks to be displayed on the chart, and you can increase this number to see more order blocks or reduce it to see fewer. Then, make sure internal buy and sell activity is enabled, along with show metrics to see the data for each order block. Now let's say you just had a bullish change of character and you're looking to take a buy. But buying here is a mistake, since you might be buying at the high of the market, so let's wait for a retracement. The indicator has already automatically plotted an order block for you below this change of character. And if we look at that order block, we see that there's more sellers than buyers. But buying here is a mistake, since you might be buying at the high of the market, so let's wait for a retracement. The indicator has already automatically plotted an order block for you below this change of character. And if we look at that order block, we see that there's more sellers than buyers in that area, yet the price went higher. This could be an indication that the sellers are exhausted at these levels, and a return to this area could be a pull on liquidity to go higher. In this other example, we see that a bearish market structure was created with more selling activity, which could mean that price has a strong probability of continuing to trend without an immediate retracement to the order block area. But if the price does return to that order block and it's mitigated, we can go back to settings and enable breaker blocks. This will plot the level where the order block was mitigated, and as the price returns to this level, we can use it as a break and retest to seek longs as a potential reversal setup. We also included a time frame feature allowing users to see order blocks from any higher or lower time frame. Here, we can see we're on a 30-minute chart, but I can use the time frame option to display order blocks detected on a 4-hour time frame, potentially identifying more significant areas on the chart. These are just some of the many use cases for these volumetric order blocks. That being said, here's a secret that most traders aren't aware of when trading order blocks. When an order block is created, the data shown on the order block is not just for the specific candles it's drawn from. It actually extends beyond those candles, providing data for the entire structural shift. Meaning, you'll get to know the trading activity of that entire block of price action, providing never-before-seen insights for sentiment analysis. The indicator includes other features, such as a mitigation method. This is set to close by default, and an order block will be considered mitigated only when price closes below a bullish order block or above a bearish order block. But you also have the options of wick and average. The hide overlap option is very helpful in situations where there are overlapping order blocks displayed on the chart. Enabling this option will cause the indicator to only display the most relevant ones. The length option will allow you to change what swing points are used to detect order blocks, and by default, this is the same as the market structure. We understand the importance of allowing flexibility here, so you can change that and use a different swing point for order blocks without changing your market structure. That being said, by the time you watch this video, more settings may be added or removed as we're constantly improving these tools. But you'll always be able to find out more on those changes at luxalgo.com by going to Resources, selecting Guides, and choosing Price Action Concepts, or by using the ChatGPT feature and get answers to specific questions. We hope this video helps you better understand how order blocks are constructed in the toolkit, exactly how they work, and can be used in your day-to-day trading. Let us know in the comments what features you'd like us to cover next, and if you would like to recommend a new feature for the toolkits, you can join our Discord using the link in the video description and submit your request in our dedicated feature request channel. Thank you for watching, and we'll see you again in the next video.
What's up, guys? In this video, I'm going to cover everything you need to know about the Lux Algo Signals and Overlays indicator. The very indicator that really made Lux Algo originally known today, and also the indicator that has very much inspired the hype train behind all of the ridiculous signal indicators being marketed all over the internet, which, to be honest, completely sucks. But this indicator from the very beginning has always been focused on providing signals and overlays that can be used to form confluences in anyone's trading. And this very innovation of pushing out updates consistently based on user feedback has made it the #1 most used paid indicator by far in history. And you can see for yourself, if you go to the top custom indicators of all time in the TradingView community scripts, you can see the legendary relics of the past 10 years, like Chris Moody and Lazy Bear's indicators, which are all free. And then just scrolling down a tiny bit, you have the Lux Algo Signals and Overlays that has a lock on it that is now ranking here amongst the most popular custom indicators of all time. So in this video, we're going to cover how this indicator actually works, the ways it was designed and intended to be used, what's new in version 6.0, and of course, how to use it on your charts. So enough context, let's just get right into it. So this indicator as a toolkit can be used alongside many forms of technical analysis, but it really has everything you possibly need, from trend following tools, reversal indicators, and optimization methods. So if you want, it was also designed to be used as a standalone indicator that can fit really any trading style. Now, the amount of features here may be a bit overwhelming, and the ideal way to use this indicator is to first explore through all of the features and the settings over time, pick and choose 2 to 3 that you think best suits your style of trading, and stick with those to create your own use cases. So before we get into some examples and how all of the features can be used together, let's just highlight all of the current features included in the indicator. We have normal trend confirmation signals with green and red arrows, as well as strong signals marked by the plus symbol, specifically designed to help you confirm trends, candle coloring with purple, green, and red to visualize trends developing between normal. What's up, guys? In this video, we're covering the brand new Lux Algo Premium price action concepts that just released for all of our premium users. And this is a super long awaited update, and there's a lot to cover here, so let's just get right into it. So here we have a basic
Wix gives you the freedom to tell your story.
So many people use the RSI indicator completely wrong, and in this tutorial, I'm going to show you the real ways to use it for trading stocks, crypto, or Forex. So the misconception is that the overbought and oversold levels on the RSI are specifically for finding reversals. If the RSI is above 70, this is where the market is considered overbought and we can expect the price to reverse down. Same with the RSI going below 30. The market is considered oversold and we can expect the market to reverse up. Well, this is completely wrong. It's only useful if you're using it as a specific exit point in trading strategies in combination with other indicators, regardless of the overall trend. You will most likely not predict actual market tops and bottoms by just using the 70 and 30 lines, and it's super frustrating to see so many traders on YouTube actually present it like this. So the actual way to use the RSI is as a momentum indicator. The most important level on the RSI is not 70 or 30. It's actually the 50 level, which is this dotted line right in the middle. So once the RSI cleanly breaks above the 50 level, this is a sign that the market is bullish. And once the RSI cleanly breaks below the 50 level, this is a sign that the market is bearish. Any move back or around the 50 level is like a support or resistance level for the momentum. You can even draw a box around it to avoid fake outs here even more. Because if you get a move above or below the 50 level, it could easily be a fake out and the market could still be in the same trend. So retests around the 50 level are actually great entries to hop into an uptrend or a downtrend, or at least to begin developing a bullish or bearish bias on the market. Now for divergences. A divergence is when the price is making higher highs, but the RSI is making lower highs. This would be bearish and we can expect the market to go down. These are actually great to use with the RSI if you use it correctly. And this is where the 30 and 70 levels actually come most in handy, because RSI divergences are most significant if they appear above the 70 level and below the 30 level. And this next tip for RSI is something that I've never seen on YouTube before, and it actually involves the setting within the indicator. So if you've ever gone into the settings of the RSI, you've probably seen the number 14 here as the RSI length. Well, what this means is that we only want to consider divergences on the RSI if there are 14 candles or lower apart from each other. So we wouldn't want to consider this as a bearish divergence because it's way more than 14 bars apart. But for this divergence, we could consider it and put more emphasis on it in our analysis. If you increase the length, you can use this as an ideal amount of bars for the divergences you find on the RSI. Lastly is the moving average on the RSI. The way you could use this is as a signal line, like when the RSI crosses over the MA as a buy signal for a part of a trading strategy, or just as a way to see the RSI as a smooth value. Because when the MA crosses over the 50 line, it's more significant than just the RSI crossing over the 50 line for following trends, as I described previously. All in all, the RSI is a very simple and useful indicator for finding trends, trading divergences, and for using it in strategies like we show all over this channel. If you want to see our trading strategy playlist with custom indicators we make from scratch, just click right here on this video. I hope this is helpful, and I'll see you guys in the next video.
We developed the first and most complete smart money concepts indicator, which became so popular that it now ranks within the top 10 indicators of all time on TradingView. By taking the most essential parts of smart money concepts, traders can finally perform analysis on market structure, order blocks, and liquidity concepts with a single indicator that is completely free and open source. Today, we'll break down exactly how this gem works, and at the end of the video, show you the best features and setups to use in real markets to easily outsmart dumb money.
Oh, you almost had it. You gotta be quicker than that.
At the foundation of this indicator is market structure. Structure is used as an easy way to detect trend changes and validate existing ones using price action. In an uptrend, the market makes higher highs and higher lows, but if a higher low point is broken, a red CHOCH label, which stands for change of character, is plotted, and this tells us the market direction has changed. However, if instead of breaking that higher low point, the previous higher high point is broken, it signifies that the market trend is continuing, and a BOS label, which stands for break of structure, will be plotted. These labels are called real-time internal structures. However, these internal structures often exist within larger ones. If you zoom out, you'll see larger solid lines representing swing structures. These swing structures work the same as internal ones, but can be used to determine how significant a directional change may be. For example, you can have an internal bearish change of character created, but if it's within a larger bullish swing structure, it could be a sign that the trend change might not be as significant, and you may want to be cautious if holding trades for a long time in that direction. In addition to structure, the indicator can also detect equal highs and lows and major price points such as daily, weekly, and monthly levels. Traders will often use these levels together to locate areas of resting liquidity. In this example, an equal low is detected, suggesting that the price is struggling to go lower. Now, we can see that the price then swept that daily low, which might have been a pull on liquidity to go higher. It's then followed by a change of character, at which point could then be traded into this order block above. Which also brings us to the next major part of this indicator: order blocks and fair value gaps. Order blocks are areas in the market where there is significant buying and selling activity. And when the price returns to these levels, there's often a strong reaction. The indicator will show you bullish order blocks in blue and bearish in red, and you can use these areas to take profit or exit your trades. Just like with market structure, you can detect more significant blocks by enabling swing order blocks. A trader may choose to use internal order blocks to enter trades and more significant swing order blocks as areas to exit. Fair value gaps can also be enabled, and these are imbalances within the price that needs to be filled. Price will gravitate towards them, and they're often used to find more precise areas within a retracement to enter a trade. The indicator also includes a premium and discount feature, which can help detect regions of supply and demand in the market. So if you're thinking about taking a buy trade, but the price is above the equilibrium, you may want to wait for a pullback to the discount zone before entering, saving you from getting stopped out in the retracement. These are the major features within this indicator, and many of these features can be adjusted so traders can find just the right fit for their trading style. Since the release of this indicator, we've seen tons of videos and users attempting to use it by blindly taking trades at change of characters or break of structure points. If you blindly execute at these levels, you will inevitably fail as a trader. Traders are supposed to use this tool alongside their analysis and other complementary indicators before executing any trade. So with that said, let's explore some of our favorite trade setups using this indicator. In this example, notice how the price is currently bearish. We know this from seeing a bearish change of character and a bearish break of structure label. However, if we zoom out, we also see that the swing structure is bullish. This could indicate that the current internal structure change may be a retracement of a much larger move. But if it is a retracement, when and where is it likely to reverse and continue bullish? Let's perform some volume analysis on this entire structure to determine that. Now, any volume profile tool will work, but this volume tool not only shows where the most volume is, but also whether traders have more bullish or bearish sentiment within that region. This indicator is the money flow profile, and it's completely free. Now we see that majority of trading happened within this price level, and also notice how there is significantly more bullish sentiment within that price region. Now, as price trades into this level, we don't just execute. We wait to see its reaction to that level. And now that we're seeing larger bullish candles rejecting this level, and also notice that price has swept the previous week's low, we now have quite a number of reasons to expect a bullish move from this region. In this other example, notice how the structure is bearish and the price has retraced into the swing order block. Now, if we enable premium and discount zones, we can see the price is above the equilibrium, which is where you want it to be for sell trades. We also see that there was a bearish equal high plotted, which is the first sign of a possible reversal. If we now enable fair value gaps, we can set a limit order at that fair value gap since the structure is still bearish to get an amazing sell trade. The Smart Money Concepts indicator is now fully available for free on 5 different platforms. If using it on TradingView, a common issue with this indicator is that when candle coloring is enabled, it only changes the colors if the indicator is selected. An easy way to solve this issue is to move the indicator above the candles in the layer panel. This issue was fixed in the premium version of this indicator, the Price Action Concepts Toolkit. We also improved the order blocks to provide volumetric data, multi-time frame order blocks, trend lines, chart patterns, several different types of imbalances, and much more. This version of the indicator is constantly updated as we integrate new features based on user feedback, and you can try it for 30 days at luxalgo.com. We hope you enjoyed this video and now have a better understanding of how to use this indicator. You can get access to this indicator for free within the LuxAlgo library by searching Smart Money Concepts. Let us know in the comments what indicator you would like us to cover next, and don't forget to join our Discord community to provide feedback. Thank you for watching, and until next time. Every trader needs to understand volume, sentiment, and supply and demand zones, but juggling separate indicators for each can clutter your chart and kill your clarity. So we've built a single tool that fuses all 3 into one powerful, streamlined system. It doesn't just show you each element, it shows you how they interact in real time. In this video, you'll see exactly how it works, how to get it, and why it could be the tool that transforms the way you trade. Let's dive in. Volume is a core pillar of most trading strategies, but raw volume alone only tells part of the story. A volume profile takes it further by showing you where volume is concentrated across different price levels. From there, we can break down the volume into buying and selling pressure, giving us a sentiment profile that reveals where bulls and bears are stacking their positions. And when we combine both profiles, we uncover key imbalances in the market. Areas of surplus become supply zones, and areas of deficit reveal demand zones. Seeing all 3 in one unified view gives you powerful insight into optimal entry and exit points. Now let's dive into the settings. This indicator offers a wide range of customization options to fit your trading style. One of the key inputs is the volume data source dropdown. Here, you can choose from 7 different ways to pull volume data, depending on your market or data preference. Right below that, you'll find the value area percentage setting, which is set to 68% by default. This determines how much of the profile is considered the value area. Lowering this number narrows the range and lets you hone in on areas with even higher volume concentration. Under presentation settings, we've added full control over what's displayed. Want to focus only on demand zones and sentiment? No problem. Prefer a clean view of just the volume profile and sentiment? You can toggle elements on and off with ease. No need to stack or swap indicators. Further down, there's the number of rows setting. Increasing this gives you more granularity in the volume profile, while decreasing it helps you simplify the view by focusing on broader zones. And of course, you'll find full styling controls for adjusting the colors, so you can tailor tailor everything to your chart theme and visibility preferences. Now that you've got a solid grasp of how the indicator works, let's walk through how you can actually use it in real trading situations, so you can start applying these insights with confidence. In this example, we've used the indicator to draw the full profile, and the first thing to spot is the point of control, shown by this red line. Notice how it's gradually moving higher. That shift signals growing interest from buyers, indicating that demand is building and price is likely to trend upward. Knowing this, we're interested in going long, so we then need to identify the demand zones. We're looking for prices to dip outside the value area and enter a region where demand is stacked. In that region, also notice the sentiment profile. You'll see a heavy concentration of buyers in this area. Since there are two demand zones forming a range in this case, we'll focus on the midpoint as our area of interest. But we don't just buy blindly. We wait for confluence, and that's where the signals and overlays algo comes in. Specifically, we'll use contrarian mode, which is designed to detect potential market tops and bottoms. Once we get confirmation from this signal, we're almost ready to pull the trigger. But before entering, we need to define our target. We aim for the point of control inside the value area, since that's where the majority of traders are likely positioned and price could face resistance. For the stop, we'll place it at the midpoint between the bottom of the value area and our entry. If the setup gives us a risk to reward of at least 1 to 1.5, we're good to execute. And it really is that simple. By combining the key elements of this indicator, you get a clearer read on market context and a smarter way to time high probability setups. Now here's something crucial to keep in mind. Just because a setup appears doesn't mean you should take the trade. In these setups, risk to reward still rules everything. In our example, we measured the risk to reward before entering, and that gave us the green light. But look at what happens next. As price reaches the point of control, the market briefly pulls back and exits the value area. Interestingly, we get another confirmation from the signals and overlays toolkit. But here's the key difference. When we map out the target, the risk to reward is under 1 to 1.5. Yes, the market does continue higher, but that doesn't mean it would have been a good trade. A trade needs to make sense on its own terms, not just in hindsight. Otherwise, it could just as easily have gone the other way. And that wraps up our deep dive into the supply-demand profile, a dynamic tool that fuses volume, sentiment, and zone detection into one clean, powerful system. It's built to give you instant context on where buyers and sellers are positioned and help you zero in on the most reactive areas of the chart. You can try it right now, completely free, at luxalgo.com/library. And don't forget about the signals and overlays toolkit we used alongside it, with features like contrarian mode. It's designed to catch market turns and add precision to your entries, especially when paired with volume and zone data. It's also available risk-free for 30 days at luxalgo.com. Follow us on X for more setups and market updates daily. Thanks for watching. Stay disciplined, trust your setup, and we'll see you in the next one. You're trading blind, and yesterday's volume just proved it. Most of you are making decisions without using the most powerful piece of data from the previous session. And it's not just how much volume was traded, it's where and who had control, buyers or sellers. But unless you're a pro with hours to kill drawing volume profiles, you're missing out on critical zones that can make or break your trade. That's why we built something wild, an indicator that shows you exactly where the money moved, not just for yesterday, but for the week, the month, the year, and even individual sessions. In today's video, we're revealing an indicator that pro-level traders are already using to decode volume and sentiment instantly. And we'll prove why using it will make your analysis 10 times faster and way more accurate. Let's get into it. Volume profiles have been around for ages, and for good reason. They're powerful tools for spotting volume clusters. Here's how they typically work. You define a range usually by selecting a set number of candles, and the volume profile maps out how much volume was traded at each price level within that range, highlighting where the market was most active and where it barely moved. But the issue here is that if you wanted to know who had control at those levels, buyers or sellers, you'll need to dig into settings, toggle modes, and constantly switch views. And if you're trying to analyze multiple periods, you're stuck redrawing levels manually. It's clunky, it's slow, and it's an outdated approach. But not anymore. With this indicator, you're getting both sentiment and volume profiles displayed together, and you can automatically anchor them to a range of timeframes. For example, if you set it to day, a new sentiment profile is drawn for every daily candle on your chart, showing you exactly who was in control and where the most trading took place. On the left side, you'll see the sentiment profile, color-coded red or green, depending on whether sellers or buyers dominated those levels. On the right, you've got the volume profile, using blue, gray, and orange to tell you more. Gray zones indicate average trading activity, blue zones mark areas with the least volume, and orange highlights where the majority of traders were active. If you want to analyze over longer periods, You can easily switch the base time frame to weekly, monthly, or even yearly. No manual redrawing needed. And here's where it gets powerful. In the Other Settings section, you'll find an option called Level of Significance. This plots a dynamic red line showing the developing point of control, allowing you to track where the majority of volume was as price was forming, not just where it landed after the fact. This gives you a real-time sense of how sentiment evolved throughout the session, which can be crucial for spotting trends, reversals, or market imbalance. All the options provided can be customized, allowing you to change the colors of the nodes and so on. Here's a quick example of how you could integrate this into your analysis. In this case, we're looking at Ethereum, with a sentiment profile plotted at the end of each day. Right away, we can see the market is trending higher, and if we connect the recent highs and lows, a clear parallel channel starts to form. Now, here's where it gets interesting. Looking at the sentiment profile, we notice a cluster of heavy trading volume up near the highs, and most of that volume came from buyers. But price is moving lower. That tells us one thing: those buyers are likely trapped. Despite that, we're still technically in an uptrend. So the next move is to identify where the majority of trading happened yesterday. And we've got 3 key levels that stand out. As price begins to retrace toward those zones, we watch closely for a reaction. Sure enough, as price hits these areas, volume begins to stack again, right at the same levels where most of the prior activity occurred. That's our confluence. All we need now is a trigger. So we look to the RSI. Once we get a clean cross, we use that as our entry signal, placing stops just below the recent candles. Our target? The channel high, right where those trapped buyers are still waiting, and that would net us some amazing gains. Here's another example, but this time we're looking at raw price action. Now, if you had to guess where the market officially transitioned from a downtrend to an uptrend, you'd probably point to this level right here, right? And maybe this one over here for when the trend flipped back to the downside. And while that's technically correct, depending on your entry style, those spots could be way too late. So let's switch it up. We'll add the sentiment profile and enable the level of significance. And now the picture gets clearer. You can actually see the market beginning to shift direction before the breakout. Right here, as sentiment starts to change and volume clusters build up, it's clear the trend is already shifting long before the breakout confirms it. And on the flip side, as the market rolls over into a new downtrend, this early cluster becomes our opportunity. Rather than chasing the drop, we wait for price to pull back into this high volume zone and then take the short. It's faster, cleaner, and puts you ahead of the crowd. We hope you enjoyed this breakdown and picked up something new about the liquidity sentiment profile indicator. If you want to start using it in your own analysis, you can grab it for free right now at luxalgo.com/library.
I'm trying not to cry. Just like, I hate suffering. I've suffered myself, and so I hate to see anybody suffer. And so I grew up in a tough environment. I had 4 different fathers. My mom, she drank alcohol.
Today, we're about to show you an indicator that's so innovative. It doesn't just show volume, it translates it. It spots divergences, tracks surging money flow, and even reveals when the latecomers are piling in, giving you an edge before the crowd even knows what hit them. If you're still analyzing the market without understanding volume, you're trading blind. Volume isn't just noise, it's the heartbeat of every move the market makes, and this tool will flip your analysis on its head. The indicator is called the oscillator matrix, and it's built from 5 powerful components: smart money flow, hyperwave divergences, reversals, and confluence calculations. Let's start with the engine behind it all: smart money flow. Money flow and liquidity are the lifeblood of any market, and in the oscillator matrix, they're front and center. The smart money flow feature is designed to detect emerging trends based on the activity of real market participants. When green waves appear, it signals money flow is increasing in the market. Red waves, money is flowing out. But here's where it gets next level. By analyzing the angle of those waves, you can gauge whether buying or selling interest is accelerating or fading. To make that even clearer, this feature includes a threshold system. Above and below the 50-level baseline, you'll see threshold markers that indicate extreme conditions. When money flow rises above the upper threshold, it's a sign of heavy one-sided bullish activity. But when it drops below the lower threshold, you're looking at intense bearish activity. Now here's the thing. When money flow reaches those extremes, the market often kicks into a powerful trend. But we all know the danger that moment can bring. Sometimes by the time momentum kicks in, it's too late to enter, and a reversal could be lurking. That's why we also built in the overflow feature. Overflow occurs when excessive liquidity floods into a trend over a short period. It's often a sign that late traders are chasing the move, and that the trend might be nearing exhaustion. If you're already in a position backed by your analysis, that's your cue to hold, not chase. If you're still on the sidelines, wait for the overflow to fade before making your move. If necessary, you can go into the settings of the money flow and increase or decrease the length to have it more aligned to your type of analysis. Higher values will be more indicative of longer-term money flow analysis, while lower values for shorter-term analysis. While smart money flow and its supporting components focus on volume and liquidity to gauge market interest, you still need clear, actionable triggers to enter and exit trades. That's where the hyperwave comes in. The hyperwave is a normalized, adaptive oscillator designed to capture price trends with precision, without all the noise that plagues traditional indicators. It's your go-to tool for spotting both trends and reversals, and it's made up of two components: the hyperwave line and the signal line. The signal line is your trigger mechanism. It can be configured as either a simple moving average or a trailing stop function. And when it crosses above or below the hyperwave, a small dot is plotted, highlighting potential turning points. These crosses are often extremely early signals of trend shifts. On the oscillator matrix, you'll also notice dashed lines at the 80 and 20 levels. These represent overbought and oversold zones. If a hyperwave cross occurs within these extreme zones, a large turning point dot appears, marking a high confidence reversal signal. When you combine this with your smart money flow analysis, you're no longer guessing. You're pinpointing high probability trades earlier and with more precision than ever before. Now that we've introduced the hyperwave, you'll start to notice something subtle but critical within the oscillator matrix: divergences between price and the hyperwave. The oscillator matrix includes real-time divergence detection between hyperwave signals and price action. But here's what sets it apart. Most divergence indicators calculate after the fact, often several bars too late, by which time the move is already halfway done. Ours doesn't wait. These divergences appear in real time. No delays, no lag, just pure, actionable insight exactly when you need it. You can adjust the sensitivity of the divergences to see more or less. And we also added a feature to display these divergences directly on the chart, so you can compare the price to the divergence detected, making it easy to incorporate into your chart analysis. This is the icing on the cake. You can now analyze volume and liquidity to understand market flow, spot ultra-early entries at key turning points, and detect shifts in direction before they're even on most traders' radar. Every feature is crafted by real traders, designed for one purpose: to help you capitalize on your edge with precision. And if you thought that was the end of it, think again. We pushed the limits even further with this toolkit. With so many powerful features working together, we knew there had to be a clear, visual way to interpret their collective signals. That's why we introduced the confluence features. Here's how they work. We have the upper and lower confluence zones. When both the hyperwave and money flow features signal an uptrend, the upper zone is shaded deep green, indicating strong bullish confluence. If only one shows bullishness, the upper zone appears in light green, signaling moderate agreement. The same logic applies to the lower zone during downtrends, using shades of red to reflect bearish confluence. This gives you an instant read on how aligned the core features are at any moment. No second guessing required. But that's not all. The confluence zones measure only two components, so we built something even more powerful: the confluence meter. When enabled, this meter takes into account not just hyperwave and money flow, but also the signal line, divergences, and overflow conditions. A higher meter reading means multiple elements are confirming a strong bullish trend, while a lower reading suggests a powerful bearish alignment. It's the fastest way to see the full story of market sentiment at a glance. And for our final major feature, let's talk about reversals. While reversals can often be identified using tools like hyperwave turning points, overflow exhaustion, or divergences, those are all trend-based methodologies. We wanted to go a step further and build a feature specifically for traders focused on spotting reversals directly. So if you look above or below the confluence zones, you'll notice small dots or large triangles. These are your reversal signals. When a small dot appears, it usually signals a minor retracement within an existing trend. It's a softer heads up. But when you see a large triangle, pay close attention. These indicate a potential major reversal, and often appear just before significant market turning points. It's a layer of early warning, designed specifically for reversal-focused traders. And there you have it, every component of the oscillator matrix working together in one seamless, intuitive, and powerful toolkit to help you dominate your market analysis like never before. And now that we've introduced all these features, let's go ahead and show you some examples of how you can combine all these features in your analysis to truly get the most out of this toolkit. Now, looking at this price action, the first thing that stands out is the bright green confluence zone. That's your signal that multiple features are aligned in support of this uptrend. But let's break it down even further. Notice how smart money flow consistently made higher highs, each time pushing through the thresholds with strength. That's a clear sign of ongoing buying interest in the market. However, take a closer look. We're also starting to see signs of overflow. Now, remember, overflow doesn't guarantee a reversal. What it does tell us is that late trend participants are jumping in. Entering a trade at this stage carries higher risk, as these are often followed by retracements or even full reversals. And that's exactly what played out. As the overflow signal dropped off, we didn't see an immediate reversal, but a sharp retracement. At the same time, the hyperwave, which had been trending higher, made a notable swing to the downside, ending that strong momentum to the upside. But despite that, money flow was still rising, so buyers were still interested at this point. But then, another divergence was detected. Another strong sign of the market starting to diverge from the uptrend, and a reversal could be imminent. We also have a strong hyperwave signal triggered within the overbought zone. And also notice that we are below the strong reversal signal and the buyer's overflow falling off once again. The market is clearly getting weaker, but to put the nail in the coffin, look at the money flow. Whereas before we were consistently testing and breaking the thresholds, now we're failing to even reach them. And if you mark the previous high in money flow, you'll see we've begun forming lower highs. More sign that buying interest is fading. And right on cue, the market followed with a massive sell-off from those highs. Let's look at another example. In this example, we're looking at a downtrend, and it becomes clear once you examine the money flow. Mark the lows. First, second, and third. Each dip pushes deeper into the threshold, confirming strong selling pressure. But here's the key moment. On that third low, we begin to see overflow. That's our warning sign. Late sellers are entering, and jumping in here would be risky. As expected, the market follows with a retracement, a temporary pullback, as the overflow fades. Now take a closer look at the hyperwave. Notice how it's crossing above the 50 line, while selling interest remains and no overflow is present at this turning point. That's your perfect opportunity to enter a trade. Clean signal, low noise, and strong timing. As the downtrend continues, another overflow signal appears. But thanks to the early hyperwave entry, you're already positioned, avoiding a late, high-risk entry. This is a textbook example of feature confluence, multiple signals aligning to help you time your trades with precision. And these are just two of the many ways you can approach market analysis with the oscillator matrix. The possibilities? Endless. With a toolkit this powerful, alerts are essential, and we've got you covered. The oscillator matrix supports everything from pre-built alerts to fully customizable scripting. Whether you want to catch real-time reversals, divergence signals, or trend confirmations, the alert system ensures you'll never miss a key opportunity. We've created dedicated walkthrough videos on how to set up and maximize these alert features. So if you haven't seen those yet, we highly recommend checking them out. We hope you enjoyed this breakdown and gained valuable insights into the oscillator matrix, a true game changer in market analysis. If you're ready to take your trading to the next level, you can get 30-day risk-free access to this toolkit, along with the signals and overlays toolkit and the price action concepts at luxalgo.com. Thanks for watching, and as always, trade smart, stay sharp, and we'll see you in the next video.
My Vinted empire runs on an eye for detail and a nose for profit. I curate every time.
You might think you understand volume, but we're telling you there is a hidden layer to it that reveals far more about market movements. You see, traditional volume indicators show you where the majority of volume is, but they don't tell you who's in control, the buyers or the sellers. But with this indicator, you can see beneath the surface of each candle, visualizing the battle between bulls and bears as it unfolds. Later in the video, we'll walk through practical examples of how to apply this indicator to spot momentum shifts and trend strength, helping you make better trading decisions. Stick around, because we're about to break down exactly how it works and how you can get it for yourself. So, let's get into it. The indicator takes your ordinary price candles and embeds the intrabar volume. Instead of just seeing whether price closed higher or lower, this gives you X-ray vision into each candle, revealing if bulls or bears had the upper hand in that candle formation. This delta seen in the candle is the difference between buying and selling volume, and you can use this to filter out trends and zero in on strong, high-conviction plays. Let's break down what makes this indicator a must-have. Here's a chart without the volume delta candles, and here's one with it applied. Right away, you'll notice a second candle layer embedded into each bar. This layer visually represents the delta, with green outlined bars highlighting bullish candles and red outlined bars showing bearish candles. While the indicator still shows you exactly how each candle closed during its formation, the delta might reveal a different story. You can have a bullish candle with bearish dominance, or a bearish candle with bullish dominance. With this indicator, Each candle is filled based on the percentage of delta relative to total volume, effectively visualizing the imbalance between buyers and sellers. The greater the fill, the higher the dominance of one side. This divergence can highlight potential reversals or exhaustion points, giving you an early signal to tighten stops or look for entries. Additionally, you'll see a horizontal line marking the price level with the highest intrabar volume. This is the max volume price. It's like finding the point of control from a volume profile, but for every bar. You can also enable previous max volume price, and a dot will appear allowing past levels to remain visible. These areas are important because they can help identify zones of high interest that could act as support and resistance. Now let's dive into the settings that drives this indicator's adaptability. First up, you can choose between tick mode and lower time frame mode. As mentioned before, tick mode operates in real time, tracking volume shifts as they happen within the bar and uses tick data for its calculations, while lower time frame mode pulls data from a lower time frame using time-based candles. If you intend to stick to a single chart without frequently changing time frames, tick mode might be more useful. However, keep in mind that tick mode data will be lost if the chart is reloaded. To use the tick mode, you may also want to enable the premium option, and this will simply allow the indicator to calculate using sub-1 minute bars. Lower time frame mode, on the other hand, uses a time frame selected from the res dropdown and continues to provide data even if the chart reloads, making it a more consistent option for historical analysis. Another key setting is the auto option. When enabled, the indicator will automatically adjust its lower time frame calculations based on your current chart time frame. This ensures you're always analyzing relevant data without manual adjustments. The indicator also allows for color customization. You can adjust the bullish and bearish delta colors to stand out more against the direction of the candle, making divergences easier to spot, giving you a clearer visual cue of potential reversals or trend shifts. And we, of course, have a display option to allow you to customize how the delta candles appear. You can choose between half bar and full bar display. In half bar mode, the delta candle is centered within the bar, representing a balanced visual of buying and selling pressure. Full bar mode extends the delta candle across the entire range. Finally, the show details option overlays a small label above each bar, displaying the total volume, delta volume, and percentage delta. This quick snapshot gives you immediate insight into how aggressive buyers or sellers were during each period. Now that we understand how the indicator works, let's look at some examples. In this first example, price is in an uptrend, and we can identify the prior higher low point, which now acts as a support level. As price retraces, we see 3 strong bearish candles, and one of them closes strongly below the support zone. Initially, this might suggest the trend is going bearish, and you might be considering taking a breakout trade. However, by looking at the volume delta candle for the breakout bar, we notice that the majority of volume within that candle is still concentrated above the support zone. This indicates buyers are still active at higher prices, despite the bearish close. A strategic approach here would be to wait for price to break either the high or low of the breakout candle. In this case, the high is broken. Entering at that point with stops placed below the low of the breakout candle offers an opportunity to continue riding the uptrend while minimizing downside risk. By using the volume delta, we've essentially avoided a false breakout scenario. Now in this other example, we're looking at a clear uptrend. At a swing high, we notice more bearish volume appearing within the candles, a strong sign that a retracement might be incoming. As expected, price is then followed by several bearish candles, pushing down into a retest of a previously identified level. Once price reaches this support level, bullish delta is detected within one of the bearish candles. However, instead of entering the trade immediately, we wait for the high of that candle to be broken just as before. This breakout above the high serves as our entry signal, while the low of the candle with the bullish delta acts as our stop level. And once again, this allows us to continue riding the overall uptrend, ensuring we minimize risk while maximizing the chances of catching the next upward move. Volume delta candles takes volume analysis to the next level, allowing you to track market pressure as it happens, giving you a real edge over traders using traditional candles. To get your hands on the Volume Delta Candles indicator, visit luxalgo.com/library and search for Volume Delta Candles and add it to your chart. Thank you for watching, and we'll see you next time.
If you are sleeping in a position like this, you are wrecking your body and your breathing. Obstructive sleep apnea happens when your upper airway repeatedly becomes blocked during sleep. reducing the oxygen intake needed to restore cognitive function and recovery. While it may only result in loud snoring, the hidden dangers are far greater than you think. Over 10 million people in Britain suffer from sleep apnea, but only 20% know it, and even fewer do something about it. Meanwhile, they end up suffering stress, hormonal imbalance, and an increased risk of a stroke or dementia. If you care about your health and future, there is one simple way to reduce these risks. Introducing Dorilla Ergo, an ergonomic pillow designed to improve your sleep and reduce the risk of sleep apnea by providing the head and neck support needed to improve breathing and posture. Here are 7 excellent reasons you should replace your regular pillow with Dorilla. 1.
Volume indicators. Among the many things to understand in trading, these rank high. You must not only understand when everyone is trading, but also where. And that's the issue because most volume indicators only show you half of the picture. So we created this indicator that will not only show you where traders are, but also if they are bulls or bears. With that data, the indicator can automatically detect consolidation zones, multiple levels of significance, plot a volume heat map, and much more. We're releasing this indicator completely free. So let's dive right into how you can get this indicator and show you some tips on how to get the most from it. This indicator does not only provide volume data, letting you know where the most or least trading happened, but it also shows the sentiment of that trading on the left. The sentiment profile can tell you if the majority of that trading was from buyers in green or sellers in red. We also know that areas with high trading are often within tight ranges that become consolidations. So if you go into the settings and scroll down, you can enable consolidation zones. These blue areas will appear on your chart, showing you price zones you might want to avoid when trading. The yellow zone that runs across the chart is called the level of significance. It is based on the volume and shows the price zone with the highest trading activity. You can consider it the fair value of the asset, where if the price moves too far away from it, it is likely to return. You can also enable the highest sentiment zone, which shows the price zone with the most buyers or sellers. Now, if you've noticed that these levels don't go among the many things to understand in trading, these rank high. You must not only understand when everyone is trading, but also where. And that's the issue because most volume indicators only show you half of the picture. So we created this indicator that will not only show you where traders are, but also if they are bulls or bears. With that data, the indicator can automatically detect consolidation zones, multiple levels of significance, plot a volume heat map, and much more. We're releasing this indicator completely free. So let's dive right into how you can get this indicator and show you some tips on how to get the most from it. This indicator does not only provide volume data, letting you know where the most or least trading happened, but it also shows the sentiment of that trading on the left. The sentiment profile can tell you if the majority of that trading was from buyers in green or sellers in red. We also know that areas with high trading are often within tight ranges that become consolidations. So if you go into the settings and scroll down, you can enable consolidation zones. These blue areas will appear on your chart, showing you price zones you might want to avoid when trading. The yellow zone that runs across the chart is called the level of significance. It is based on the volume and shows the price zone with the highest trading activity. You can consider it the fair value of the asset, where if the price moves too far away from it, it is likely to return. You can also enable the highest sentiment zone, which shows the price zone with the most buyers or sellers. Now, if you've noticed that these levels don't go all the way across the entire chart, that is because where they stop indicates the data being used to calculate the profiles. You can increase or decrease this range using the lookback settings. If you want an even better way to visualize this trading data, you can enable the profile heat map, which can be based on either volume or sentiment. If based on volume, red areas represent low trading activity, while blue areas indicate high trading activity. If switched to a sentiment profile, red areas show where sellers are, and green areas indicate where buyers are, and you can increase the row count to see a smoother heat map. This indicator can identify the fair value of an asset, and using the profile heat map, you can locate the levels on the chart with little to no interest from traders in red. If the price is in these areas, it is likely to reverse back to the fair value. By doing some basic price action analysis within this area, you can set stops at a reasonable level and trade back to this yellow fair value zone. We could also use the sentiment profile within this indicator to determine areas to place stop loss orders. Given the indicator shows us where buyers and sellers are resting, we can find zones on the chart with significant buyers or sellers and place stops above or below those zones before executing our trades. If you want to try this indicator yourself, go to luxalgo.com/library and search for Money Flow Profile to get it for free today. Let us know what indicators to cover next. Thank you for watching, and we'll see you in the next video.
Autodesk Fusion for Manufacturing integrates design, documentation, machining, additive, and nesting workflows.
Every trader needs to understand volume, sentiment, and supply and demand zones, but juggling separate indicators for each can clutter your chart and kill your clarity. So we've built a single tool that fuses all three into one powerful, streamlined system. It doesn't just show you each element, it shows you how they interact in real time. In this video, you'll see exactly how it works, how to get it, and why it could be the tool that transforms the way you trade. Let's dive in. Volume is a core pillar of most trading strategies, but raw volume alone only tells part of the story. A volume profile takes it further by showing you where volume is concentrated across different price levels. From there, we can break down the volume into buying and selling pressure, giving us a sentiment profile that reveals where bulls and bears are stacking their positions. And when we combine both profiles, we uncover key imbalances in the market. Areas of surplus become supply zones, and areas of deficit reveal demand zones. Seeing all three in one unified view gives you powerful insight into optimal entry and exit points. Now let's dive into the settings. This indicator offers a wide range of customization options to fit your trading style. One of the key inputs is the volume data source dropdown. Here, you can choose from 7 different ways to pull volume data, depending on your market or data preference. Right below that, you'll find the value area percentage setting, which is set to 68% by default. This determines how much of the profile is considered the value area. Lowering this number narrows the range and lets you hone in on areas with even higher volume concentration. Under presentation settings, we've added full control over what's displayed. Want to focus only on demand zones and sentiment? No problem. Prefer a clean view of just the volume profile and sentiment? You can toggle elements on and off with ease. No need to stack or swap indicators. Further down, there's the number of rows setting. Increasing this gives you more granularity in the volume profile, while decreasing it helps you simplify the view by focusing on broader zones. And of course, you'll find full styling controls for adjusting the colors, so you can tailor everything to your chart theme and visibility preferences. Now that you've got a solid grasp of how the indicator works, let's walk through how you can actually use it in real trading situations, so you can start applying these insights with confidence. In this example, we've used the indicator to draw the full profile, and the first thing to spot is the point of control, shown by this red line. Notice how it's gradually moving higher. That shift signals growing interest from buyers, indicating that demand is building and price is likely to trend upward. Knowing this, we're interested in going long, so we then need to identify the demand zones. We're looking for prices to dip outside the value area and enter a region where demand is stacked. In that region, also notice the sentiment profile. You'll see a heavy concentration of buyers in this area. Since there are 2 demand zones forming a range in this case, we'll focus on the midpoint as our area of interest. But we don't just buy blindly. We wait for confluence, and that's where the signals and overlays algo comes in. Specifically, we'll use contrarian mode, which is designed to detect potential market tops and bottoms. Once we get confirmation from this signal, we're almost ready to pull the trigger. But before entering, we need to define our target. We aim for the point of control inside the value area, since that's where the majority of traders are likely positioned and price could face resistance. For the stop, we'll place it at the midpoint between the bottom of the value area and our entry. If the setup gives us a risk to reward of at least 1 to 1.5, we're good to execute. And it really is that simple. By combining the key elements of this indicator, you get a clearer read on market context and a smarter way to time high probability setups. Now here's something crucial to keep in mind. Just because a setup appears doesn't mean you should take the trade. In these setups, risk to reward still rules everything. In our example, we measured the risk to reward before entering, and that gave us the green light. But look at what happens next. As price reaches the point of control, the market briefly pulls back and exits the value area. Interestingly, we get another confirmation from the Signals and Overlays toolkit. But here's the key difference. When we map out the target, the risk to reward is under 1 to 1.5. Yes, the market does continue higher, but that doesn't mean it would have been a good trade. A trade needs to make sense on its own terms, not just in hindsight. Otherwise, it could just as easily have gone the other way. And that wraps up our deep dive into the supply-demand profile, a dynamic tool that fuses volume, sentiment, and zone detection into one clean, powerful system. It's built to give you instant context on where buyers and sellers are positioned and help you zero in on the most reactive areas of the chart. You can try it right now, completely free, at luxalgo.com/library. And don't forget about the Signals and Overlays toolkit we used alongside it, with features like contrarian mode. It's designed to catch market turns and add precision to your entries, especially when paired with volume and zone data. It's also available risk-free for 30 days at luxalgo.com. Follow us on X for more setups and market updates daily. Thanks for watching. Stay disciplined, trust your setup, and we'll see you in the next one. In his book Beyond Candlesticks, Steve Nisson describes a curious phenomenon, bursts of extreme volatility on a chart that, when interpreted correctly, don't just show price movement, they reveal hidden zones of power, zones where support and resistance aren't just guessed, they're felt. Traders have tried to bottle this magic for years, building tools that promise to capture it, but none quite nailed it until now. Today, we're going to show you an indicator born from that very concept, refined, modernized, and designed to lock onto those same volatility spikes Nissan first spotlighted. Let's dive in. First, let's clarify what high volatility actually means and how we can spot it. Volatility in trading can be measured in a number of ways, but one of the most widely used methods is the average true range, or ATR. By taking a handful of those candles, applying some basic math, we can calculate the average range, what we consider normal volatility. So, when a candle suddenly breaks above this average range, it's not just noise, it's a signal. That spike tells us volatility has surged, and that is how we identify a high volatility event. This indicator zeroes in on those rare high volatility candles. Bullish spikes are highlighted in dark green, while bearish ones appear in dark red. But it doesn't stop there. The indicator also marks the midpoint by default of each high volatility candle, automatically drawing horizontal levels that act as potential support or resistance zones. Zoom in on those levels and you'll spot something subtle but powerful. Small circles that occasionally appear when price taps into a zone, but doesn't close beyond it. This wick rejection is a key signal. It suggests the level is holding, and it's often the perfect moment to consider a trade. Now, if you open up the indicator's settings, you'll find some interesting customization options, starting with the ability to switch between historical and trailing display modes. In historical mode, which you've seen so far, the indicator draws a separate line from every high volatility candle. Each time price retests one of these levels, it marks the interaction with a dot. This mode gives you a detailed history of how price has respected or rejected past volatility zones. Trailing mode, on the other hand, works differently. When a new high volatility candle of the same type appears, and the previous level hasn't been broken, the line updates to reflect the most recent candle's values. This creates a dynamic, trailing level that adapts in real time while keeping your chart cleaner. We also wanted to give you flexibility in how support and resistance levels are drawn, because different traders prefer different reference points. With the percentage setting, you can define exactly which part of the candle is used. Setting it to 100% will anchor the levels to the candle's close, while 0% uses the open. You can fine-tune anywhere in between, depending on how you interpret candle behavior. Just below that, you'll find filter settings that let you adjust the sensitivity of the volatility detection. This is where you can tweak the ATR multiplier and other parameters to better match the dynamics of your specific market or trading style. And finally, the style options give you control over how the indicator displays, like adjusting the colors of bullish and bearish volatility candles to fit your chart aesthetic. And that covers all the settings available within the indicator. Now, let's shift from theory to practice and see how this tool performs in real market conditions. Now, you can absolutely experiment with this indicator and develop your own strategy. But based on our testing, here's what we've found to be a reliable approach when tracking trades. The first thing we look for is confirmation that the level, created by a high volatility candle, is actually acting as support or resistance. In this example, we have a bullish volatility candle, and what we want to see are at least 3 interactions with that level. In other words, 3 rejection dots. That tells us price is respecting that zone, but we're not jumping in just yet. On that 4th touch, we want more than just a reaction. We want a high volatility candle to either break or bounce off the level. This signals that volume and momentum are backing the move. After that, we wait for price to return and interact with the newly established resistance, rejecting it in the same direction as the breakout. That's our trigger. From there, we place our stop just above one of the volatile candles and target a clean 1 to 2 risk to reward setup. In some setups, these high volatility candles can serve as direct entry triggers for your trades. You can use the accompanying support or resistance line as your stop loss level and another volatility zone as your target. In this example, we've set the support and resistance levels to 0%, so they're drawn from the open of the candle, giving us a precise baseline. We're also using the NeoCloud from the Signals and Overlays toolkit to confirm our directional bias. When it's blue, we're only looking for long setups. When it turns red, we're hunting for shorts. In this case, the cloud is red, so we're focusing on short opportunities. What we want to see is a volatility spike, a candle that aggressively rejects the NeoCloud resistance. That's our entry. From there, we place our stop above the resistance line drawn by the volatile candle, and we set our target at a lower support zone formed by another high volatility event. And that wraps up our breakdown of the candle body support and resistance indicator, an intuitive way to pinpoint explosive price moments and uncover hidden support and resistance zones with precision. You can start using it right now, completely free, at luxalgo.com/library. And if you want to take your trading confidence to the next level, Don't forget about the signals and overlays toolkit we used alongside it. Tools like the NeoCloud give you that extra layer of directional clarity, helping you filter noise and lock in on high probability setups. You can try it out risk-free for 30 days at luxalgo.com. Thanks for tuning in. Trade with intention, manage your risk, and we'll see you in the next one.
But it's wonderful to finally meet the girl I've heard so much about.
Oh, please let me.
Thank you, dear.
What an amazing home you have. I wonder what it's worth. Oh, not that you'd sell it. I just mean it'll fetch a good price when you...
Most traders rely on market highs and lows whether they realize it or not, using candle highs for stop losses, swing lows for take profits, or simply referencing daily, weekly, or yearly extremes. These levels are baked into trading strategies across the board. The problem? Identifying them consistently takes time, and missing one could cost you. That's why we built a tool that does it all for you automatically. In this video, you'll see exactly how this indicator works, how to get it on your chart, and why it can seriously level up your trading game. Let's get into it. These levels, market highs and lows, are almost impossible to ignore. That's because nearly every trading strategy out there, especially swing-based ones, taps into them in some way. And more often than not, those swing points align with higher time frame candle highs and lows. Take this daily chart, for example. If we mark the high and low of this candle, then drop down to the 4-hour chart, those same levels become clear pivot points. Now, tracking these across multiple time frames manually, that gets tedious fast. And that's exactly why we built this indicator, to automatically map out those key levels so you don't miss a thing. Once the indicator is added to your chart, you'll immediately see a series of red and green lines, each accompanied by a number off to the right. Red lines represent candle highs, green lines mark candle lows. The numbers indicate how recent that level is, 0 being the current candle, 1 the previous one, and so on up to the 4th. To help you quickly identify the current open candle, its high and low are drawn with dashed lines, while the rest use solid lines. You'll also notice something different at the extremes. The highest high and lowest low are marked with shaded areas instead of just lines. This is intentional. These zones highlight potential major supply and demand levels, giving you a visual edge in spotting key decision points. You may also notice 4 vertical lines drawn on the chart as well. These lines mark the start of each candle on the higher time frame being used to draw the levels. And if you're curious about what time frames these levels are pulled from, that's all adjustable in the settings. Here, you can control everything. The Show Last option determines how many previous candles the indicator uses to draw levels. By default, it's set to 4. Right below that is the frequency setting, which selects the time frame of those candles. It's set to daily by default, meaning it references the current and last 4 daily candles to map out highs and lows. You also have control over the size of those supply and demand zones through the area width setting, which adjusts how thick those shaded regions appear. We also added a smart filter. When enabled, it automatically removes highs that are below the current price and lows that are above it, keeping your chart clean and focused. And for those who love to customize, you've got full styling options for tweaking colors, transparency, or even turning off the zones entirely if you prefer a minimalist look. And now that we have a pretty good understanding of how this indicator works, let's see how traders might consider using it to make life easier. For this setup, we'll start by heading into the indicator's settings and changing the frequency to monthly. Then we'll jump up to the monthly time frame to break it down. What we're looking for here is a potential reversal setup. Notice how the candles are consistently printing lower highs and lower lows. A classic downtrend. The strategy is simple. We wait for a break above a previous candle high. Once that happens, we target a high from one of the earlier candles, like this bullish candle here that stands out in the sequence. Now, instead of manually plotting each of these highs and lows, we just let the indicator do the work. With it enabled, we instantly see the highs and lows of the past 4 candles laid out for us. What we want is a break of the level marked 1. That's the high of the most recent closed candle. And our target will be the level marked 3, which aligns with that earlier bullish candle. So let's drop down to the 4-hour time frame. The beauty of this setup is that even on the lower time frame, our monthly levels remain clearly visible thanks to the indicator. We can easily spot the 1 level we're watching for a breakout and our eventual target at 3. To strengthen the setup, we'll now add the Signals and Overlays toolkit and enable the Trend Tracer. This tool is excellent for cutting through market noise and revealing the true direction. Once we start seeing candles closing above the 1 level and the Trend Tracer flips bullish, that's our signal. We set our stop just below the breakout level and our target at the level marked 3. Clean, straightforward, and highly effective. And if you're taking less complex setups, this indicator also works beautifully for those as well. In this example, we're still using monthly levels, but analyzing them on the 4-hour time frame. Right here, we can see the current monthly low. We know it's the monthly low because of the dashed lines being used to plot this area, indicating we're dealing with the active candles range. Now, notice how price has reacted at this level. It's been rejected multiple times, signaling it is a strong support. So if broken with volume, major opportunity. At this point, the setup becomes straightforward. All we're waiting for is a clean break and close below that dashed line. Once that happens, we look for a logical target based on previous price action. In this case, the low of the third most recent monthly candle has already shown its significance. It's been respected more than once, and that makes it an ideal target for the trade. No guesswork, just a clean read of market structure using automated levels that do the heavy lifting for you. And that wraps up our deep dive into the previous high and lows indicator, an effortless way to visualize key price zones and structure across any time frame. You can start using it right now completely free at luxalgo.com/library. If you want to level up even further, don't forget about the signals and overlays toolkit we use today. With tools like Trend Tracer, it adds real-time confirmation and clarity to your setups, and it's available risk-free for 30 days at luxalgo.com. Thanks for watching. Trade smart, stay sharp, and we'll see you in the next one.
Struggling to trade? We trade for you and get you a prop firm payout in under 30 days. And you don't.
What if you could start noticing the handoff from bulls to bears, bar by bar, instead of waiting for a decisive candle to close? Over the past few months, we've been tinkering with an idea that might make that possible. A free indicator that shows the flow of structure as an oscillator, rather than pinpointing exact breakpoints. In the next few minutes, you'll see how it works, how to add it to your chart, and why it could become a gentler, more flexible alternative to the usual wait for the break routine. Let's take a closer look. Before we dive into charts, let's ground ourselves in what traders call market structure. Put simply, price moves through three major states: uptrends, downtrends, and ranges. In an uptrend, each push leaves behind a higher high and a higher low, showing buyers consistently winning the tug of war. Flip that around, lower highs and lower lows, and you have a downtrend. When neither side can impose a clear pattern of progress, price drifts sideways in a range, bouncing between support and resistance as conviction stalls. Traditional tools detect market structure by waiting for decisive breaks or closes at those swing points, so the readout can feel abrupt. One moment you're bullish, the next you're bearish. That's the gap we set out to narrow. The indicator we've built translates those binary swings into a smooth oscillator, letting you watch the structural pressure build and release in real time, rather than only after the break. When you add the indicator, it opens in its own pane beneath the price chart. The panel is split at the 50 level, which acts as equilibrium. The yellow upper band marks the overbought zone, and the blue lower band marks the oversold zone. The market structure oscillator line oscillates around that midpoint. Prints above 50 show buyers edging ahead, while moves below 50 warn that sellers are taking control. Behind the line sits the cycle oscillator histogram, turning blue above 50 to signal strengthening bullish pressure, and amber below 50 to flag building bearish pressure. Reading the line for direction and the bars for acceleration lets you catch momentum shifts early and line up entries before price makes its next decisive move. Now, if we open the settings of the indicator, you'll see that the market structure oscillator is driven by three time frames: short, mid, and long term, borrowed from the pure price action structures indicator, which we broke down in this video. Each tier has its own weight value. Increasing a weight tells the engine to give that particular structure more sway over the overall reading. Beneath the weights, you can toggle market structure oscillator cross signal, which paints a small circle on the price chart whenever the oscillator crosses the 50 level equilibrium, giving an at-a-glance bull or bear market shift alert. The cycle oscillator offers similar controls, so you can highlight its bullish or bearish crossovers just as easily. Although the oscillator is designed to spare you from tracking every swing point, the traditional structure levels are still just a click away. Under Market Structure on Chart, you can switch on short-term, intermediate, or long-term swing lines for added visual context. And if you ever want to inspect the raw inputs that feed the final market structure oscillator line, the Oscillator Components section lets you display each tier's individual line before they're merged and smoothed. Now that we have a solid grasp of how this indicator works, let's look at some examples of how you can use it in real trading. In this example, notice first that the overall market structure oscillator is bullish, even though it wobbles a bit along the way. To fine-tune our entries, we open the settings, head to Oscillator Components, and switch on the short-term structure line. Now we're watching two layers at once, the blended long view reading and the isolated short-term pulse. Our plan is simple. Wait for the short-term line to dip into the oversold blue zone. A dip there tells us to start stalking buys, and because the broader structure remains bullish, that bias is fully aligned. But we don't pull the trigger immediately. Instead, we watch the cycle oscillator for confirmation that momentum is turning. When its histogram flips, and the line crosses back above the 50-level equilibrium, momentum and structure are finally pointing the same way. That's our cue. We go long, tuck a stop just below the most recent swing low, and aim for roughly a 1 to 3 risk to reward. The key takeaway is synergy. Use the overall structure to set the bias, the short-term structure to pinpoint the zone, and the cycle oscillator to time the actual entry. Here's a second setup that layers the oscillator with the reversal zones and trend catcher overlays from the Signals and Overlays toolkit. Reversal zones highlight price areas with a high probability of a retrace or full reversal, while the trend catcher flashes very early entry cues. Handy, but only when they're filtered through solid confirmation. On this chart, the market structure oscillator has been parked in the oversold or blue region for several candles, and price is sitting inside a reversal zone. That tells us to start thinking long. Instead of jumping in immediately though, we wait for trend catcher to flip to a bullish signal. This helps us sidestep premature entries. As extra confluence, we check that the cycle oscillator's momentum bars have risen back above the 50 level, showing buyers are really stepping up. Once those three conditions align, we go long, tuck a stop just below the recent swing low, and aim for a measured 1 to 1.5 reward to risk. We keep the risk to reward low since the overall structure reading is not fully bullish, and this is more of a retracement play. And that wraps up our look at the market structure oscillator, an easier way to watch trends hand off from bulls to bears in real time. You can drop it on your chart right now completely free at luxalgo.com/library. One extra firepower for timing those structure shifts. The Signals and Overlays toolkit we paired with it today is waiting for you too. Risk-free for 30 days at luxalgo.com. Thanks for watching. Trade smart, stay sharp, and we'll catch you in the next one.
In a city where dating is stuck on repeat. Sorry. Two builds were set to collide.
Ever noticed those massive candles during major news events or volatile market moves? They often leave behind these huge wicks, like the market stretched too far and snapped right back. Those wicks aren't just noise, they're clues. And knowing how to trade them can be the difference between a win and a loss. That's exactly why we built an indicator that automatically detects these large wicks for you and marks out the key support and resistance zones they create. And we're giving away this indicator for free. So let's dive in, because this might just be the edge your trading strategy has been missing. Let's first break down what wicks actually are. Each candle shows the open, close, high, and low of price movement within a given time frame. The wicks represent the price extremes. At a one-dimensional level, many traders often use these wicks to help identify candle patterns like the doji formation or tweezer tops and bottoms. But there's more to these wicks than just surface-level formations. If you were to zoom in on one of those long wicks, you'll often find they represent retracements of lower time frame moves. And based on the principles of market structure, many of those wicks tend to get filled later on. But here's the challenge. How do you know which wicks are meaningful and which ones are just noise? That's exactly where our custom indicator comes in. When you first add the indicator to your chart, the most noticeable elements are the green and red horizontal lines stretching across the screen. Red lines mark significant bottom wicks, and green lines highlight major top wicks. You'll also see that the candles themselves look different. That's because, by default, the indicator uses something called wick-based transparency. This setting makes candles with smaller wicks appear more transparent, while candles with larger wicks stand out more clearly. It's a smart way to visually emphasize areas of volatility. But how does the indicator decide what counts as a large wick? That's where the settings come in. If we go into the settings, the first option is the wick threshold, and this controls the sensitivity of the detection. Lower values detect more wicks, while higher values filter out all but the most significant moves. Next is the level percentage setting, which defaults to 100%. This determines where the wick level is drawn from. At 100%, the level is placed at the very high or low. Reduce it to 50%, and the level is drawn from the midpoint of the wick, useful depending on how you'll be using the indicator. Then there's max duration, which sets how long a level stays visible on the chart, useful for hiding older zones that may no longer be relevant. The next toggle is mitigated wick. If this is disabled, any wick level that price has already interacted with will be removed from the chart, helping you keep things clean and focused. Finally, under the style section, you'll find two key options: wick-based transparency, which we covered already, and breakout-based color. This one adds another layer of clarity. If enabled, the indicator will color candles based on the most recent wick level that price broke through. And now that you have a good understanding of how this indicator works, let's see how it can actually be used to execute trades. Now, one of the most effective ways traders use wick zones is as target areas. Take this example. The market breaks structure and forms a higher high, but on the pullback, it leaves behind a significant wick, which our indicator flags in real time. Now, if you look closely at the price action next to that wick, you'll notice a large, clean candle. That's important. It tells us price moved through this area easily before. without much resistance. This makes it a prime target for a short-term retracement trade. To trade this setup, we'll activate the Signals and Overlays toolkit. We start by disabling both candle coloring and smart trail, and then turn on the short-term autopilot. Now we simply wait for a bearish confirmation to form, and we'll set our target at the low of that wick. Once we get to that wick target, watch what happens next. It sharply reverses. That's a strong clue. It shows how these wick zones often act like magnets for price, but also as reversal points once filled. The key takeaway? Always consider the surrounding price action when using wicks as targets. They not only highlight volatility, but can help pinpoint short-term opportunities with precision. Here's another great example. This time, we're trading in the direction of the overall trend. We see the market is trending higher, confirming bullish momentum. Then, a large wick appears, immediately detected by the indicator. As we touched on earlier, large wicks often represent retracements on a lower time frame. So let's drop down to a lower time frame to see what's happening. And now, it's clear. The market continues to make higher swing highs and lows. And that wick pullback? It's just a healthy retracement. And once more, notice how a large, clean-bodied candle forms during that push to the upside, which we're now retracing into. Once price clears that candle and a bullish candle starts printing, the entry becomes obvious. We can place our stop loss below that candle's low and target the wick level above. Simple, effective, trend aligned. And that wraps up our deep dive into the long wick detector, a powerful tool that transforms overlooked price extremes into actionable support and resistance zones. You can add it to your chart right now, completely free, inside the LuxAlgo library at luxalgo.com/library. And if you're looking to sharpen your entries around those wick zones, the Signals and Overlays toolkit we used alongside it is also ready for you. Risk-free for 30 days at luxalgo.com. Thanks for tuning in. Trade smart, stay sharp, and we'll catch you in the next one.
Somebody save me!
Aldi can save you!
There's one strategy that stood the test of time and has been used by some of the most elite traders on the planet, and it all centers around the market open. Why? Because during those first few moments, the volume is explosive, the price action is clean, and the opportunities are prime for sniping entries and locking in profits. Today, we're unveiling a brand new indicator that automatically detects these opening range plays, complete with precision entry signals and powerful confluences. Best part? It's completely free. Let's break down how it works and how you can use it to level up your trading. Market open breakout strategies are widely recognized and frequently used among traders, but what sets them apart often comes down to the specific time frame selected to define the breakout zone, such as the first 15 or 30 minutes after the market opens. Despite these variations, the core principle of the strategy remains consistent. Establish a directional bias using higher timeframes, then wait for a clean breakout or a precise retest of the defined range before executing an entry. This structured yet flexible approach is what allows traders to capitalize on the initial surge of momentum with great clarity and confidence. Once you've added the indicator to your chart, the first step is to switch to a time frame below 30 minutes. Ideally, the 5-minute. This is important because by default, the indicator calculates its opening range based on the first 30 minutes after the market opens. The indicator then extends the high and low of that range across the rest of the session to serve as reference points for potential breakout moves. These ranges are color-coded to reflect their relationship to the previous day's opening range. Green, if the current opening range is higher, and red if it's lower. When a breakout is detected beyond this range, a triangle is plotted on the exact candle where the breakout occurs, giving you a clear and timely signal. While this type of strategy is most effective on trending days, it can also be adapted for range-bound conditions. Traders can use the same framework to look for mean reversion plays, targeting a return to the opposite side of the opening range. You may also notice thin horizontal levels appearing above or below the opening range. These are dynamic target zones plotted in response to the breakout signals. Once a target is reached, a new one is immediately plotted beyond it. This creates a continuous sequence of take-profit levels, allowing you to strategically scale out of your position by closing partials along the way. Opening the settings panel of the indicator reveals several customization options designed to give traders full control over how the strategy is applied. The first notable toggle is the ability to unlock historical data. When this is disabled, the indicator will only display the current session's opening range, helping to declutter your chart if you prefer a cleaner look. Recognizing that not all traders use a fixed 30-minute window to define the opening range, the next section allows you to adjust that time period. Whether you prefer shorter or longer windows, or even custom intervals based on unique session starts, you can tailor the detection to suit your strategy. Further down, The breakout signal settings let you tweak the size of the breakout markers and apply directional filters. If no bias is selected, the indicator will trigger a breakout signal the moment price breaches the range, regardless of direction. However, selecting the daily bias option introduces a smarter filter. Breakout signals will only immediately trigger if in alignment with the established daily bias. If price breaks in the opposite direction, no signal appears unless the first target is hit. This helps to reduce noise and avoid false signals in the wrong direction. Next, the target configuration settings offer options to fine-tune your take-profit levels. You can toggle target display on or off, set the percentage of the opening range used to calculate targets, and choose whether targets are validated by a full candle closing beyond the level or just a wick touch. You also have control over how targets behave, either adaptive, resetting with each breakout as they do by default, or extended, where all levels persist until a new range is formed. Finally, a session moving average is included. This can be enabled and customized to serve as a trend filter or dynamic trailing mechanism for entries post-breakout, adding yet another layer of precision to your strategy. Now that you have a clear understanding of how the indicator functions and how to tailor it to your trading style, let's dive into some practical examples of how it can be applied in real market conditions. It's important to remember that not every breakout is worth trading. Just because a breakout is detected doesn't automatically make it a high-quality setup. One of the most effective ways to validate these moves, beyond simply having a directional bias, is to confirm them using volume and momentum analysis. In this example, we're incorporating the Oscillator Matrix Toolkit, which provides real-time insights into money flow and momentum via its hyperwave signals. Take this Tesla setup, for instance. Immediately after the first 30 minutes of market open, we got a breakout signal. However, the oscillator matrix showed the market was already in an overbought state at the time of the breakout, an early warning that a retracement was likely before any continuation. And that's exactly what happened. But during the second breakout from the same range, the oscillator indicated bullish money flow, and we were no longer in overbought territory. These conditions made the second breakout a far stronger candidate for entry. For this trade, we placed our stop loss at the midpoint of the range and planned for 2 take-profit levels. When deciding how many targets to set, always ensure your risk-to-reward ratio remains favorable, ideally above 1.5. This disciplined approach not only filters out weaker setups but also helps you scale in with greater confidence when all signals align. It's also crucial to understand that no matter how clean or promising a setup appears, no indicator is infallible. The market doesn't always behave in a trending manner, and there will be days when price action simply refuses to cooperate. In this alternate Tesla example, we saw a bullish breakout almost immediately after the first 30 minutes of market open. However, price quickly reversed, triggering a bearish breakout shortly after, only to pull back again, invalidating both moves. When you encounter back-to-back false breakouts like this, it's often a strong signal to take a step back. The market is clearly choppy, and further trades could expose you to unnecessary risk. That said, if your trading plan permits it, these conditions can also open the door to contrarian strategies. For instance, rather than attempting to ride a third breakout in the same direction, you might anticipate continued ranging behavior. In this case, once the third breakout failed and the candle closed back inside the range, we shifted our approach. Instead of entering another long, we treated the market as range-bound, setting our stop loss just above the initial buy-side target and aiming for the opposite sell-side take profit. This is a practical way to adapt the indicator for sideways markets, helping you capitalize on mean reversion while managing risk in uncertain conditions. And that wraps up our deep dive into the opening range breakout indicator, a powerful tool designed to transform the chaos of market open into a structured, actionable framework for both trend and range-based strategies. You can load it up for free inside the LuxAlgo library at luxalgo.com/library. Looking to take your entries and exits to the next level? The Oscillator Matrix Toolkit we paired with the strategy today is built exactly for that, giving you real-time insights into money flow and momentum. It's also available risk-free for 30 days at luxalgo.com. Thanks for watching, trade smart, and we'll catch you in the next one.
And I'm trying not to cry. Just like, I hate suffering. I've suffered myself, and so I hate.
You've been analyzing structure wrong, and it's not your fault. For a while now, we've been deep in the trenches, testing every structure theory we could find, and what we discovered turned everything upside down. We've built something different, and today we're revealing a new indicator with a new approach, one that doesn't require a length input from the user, and it maps not one, not two, but 3 layers of structure, significantly minimizing lag and making it ideal for capturing the most subtle shifts between bull and bear markets before anyone sees it coming. If you've ever felt like you were always one step behind when analyzing market structure, strap in as we demo this new indicator. Most market structure tools force traders to decide upfront how deep or shallow their pivot detection should be. Too shallow, and the chart explodes into noise. Every minor jiggle crowns itself a swing. Too deep, and the important shifts vanish until they are ancient history. This indicator sidesteps that dilemma by adopting an alternative method of detecting structure, where market structure is shaped by 3 distinct levels of swing points: short-term, intermediate, and long-term. This cascading logic means the indicator is constantly self-tuning, without ever requiring a pivot length input or any form of guidance from the user. And since this indicator relies solely on closed bars, yesterday's candle can never be revoked. What you see in the moment is what remains on the chart forever. Nothing repaints. Once added to your chart, you'll immediately see 3 distinct types of lines, each representing a different layer of market structure. The dotted line captures short-term structure. It's your earliest signal, ideal for spotting a trend continuation or potential reversal, before most indicators even flinch. Then comes the dashed line, marking an intermediate level shift. This serves as a more reliable confirmation, useful when you want to filter out noise and catch cleaner setups. Finally, the solid line represents long-term structure changes. It's the most significant signal, and by default, it's the only one labeled LTMSS, long-term market structure shift. At the swing points that define this structural change, you'll also notice subtle dot markers. These visually confirm the precise pivots behind each long-term shift. But here's where it gets powerful. Every layer is customizable. Jump into the settings and you'll find dedicated sections for short, intermediate, and long-term structures. Want labels for the other levels? You can turn them on. Prefer a different line style or color scheme? It's all adjustable. You can even choose to display a floating label for structure type, instead of just decoding by line style alone. In short, you're not just seeing structure, you're tailoring how it's shown, so it aligns perfectly with how you trade. And unlike most structure indicators that rely on static pivot counts, each layer in of structure in this indicator adapts dynamically, making it uniquely effective in chaotic or fast-moving markets. It doesn't wait for a fixed number of bars to confirm a swing. Instead, it reads the intent of price itself, allowing you to detect structure where other tools may get lost. In this example, we're using the Signals and Overlays toolkit to algorithmically determine directional bias, with the ML classifier enabled to rate each signal from 1 to 4, where 1s and 2s indicate a retracement, and 3s and 4s confirm trend continuation. In this case, a level 2 confirmation tells us the market is pulling back within an uptrend. As the candle colors shift from purple to red, we see momentum building, marking the transition from a weak trend to a strong one. But the real insight comes when we enable the pure price action structure overlay. All 3 layers of structure appear during the retracement, even before the candles transition to red for strong bearish confirmation. This gives us a roadmap. A short-term confirmation during the red candles could serve as the initial entry and our smallest position. Then, as the trend strengthens and structure shifts align with the directional bias, intermediate confirmation follows, offering a more solid entry. And finally, when the long-term structure breaks, it provides the strongest confirmation for scaling in further. And there, you have 3 positions entered, all at different levels of confirmation. It's important to note that entries at the long-term level can sometimes face short retracements before continuation, which makes this layered, confirmation-based approach especially effective for managing risk while positioning with the broader trend. In this next example, we're focused on confirming a strong long-term trend. However, as mentioned earlier, significant long-term confirmations are often followed by deep retracements before the broader move resumes. So how do we handle entries following those market structure changes? Here, we've identified a long-term break of structure confirming bullish intent, and after some upside movement, we start to get a pullback. Instead of guessing where to enter, we can improve timing by identifying oversold conditions within the retracement using a tool like the RSI. Once price enters an oversold region while long-term structure remains intact, we begin looking for short-term structure confirmations. In this case, as price exits the oversold zone, we receive that short-term signal, prompting a small, early position. Because it's a lower-tier confirmation, we size conservatively and aim for nearby highs. What's crucial here is how that short-term confirmation offered an early opportunity to enter, rather than waiting for the intermediate confirmation, which, in this instance, arrived too late. It's a clear demonstration of why short-term signals shouldn't be overlooked. They can provide precision entries and improve risk-reward when used within the broader structural context. And that's just a glimpse of how this multi-layered structure tool can transform the way you read price action by giving you real-time clarity across short, intermediate, and long-term trends. We hope this walkthrough helped you understand how to use it effectively and how to adapt it to your own trading strategy. You can start using this tool completely free at luxalgo.com/library. And if you're looking to enhance your edge even further, the Signals and Overlays toolkit we featured in this video is also available to try, risk-free for 30 days at luxalgo.com. Thanks for watching, trade smart, and we'll see you in the next one.
Welcome to the Self-Obsessed CEO series. This is episode 1, the morning routine. Once my wellness morning rituals are all done, it's time to switch to CEO mode. And the way I start this part of my day is the most important. My mornings used to feel chaotic, a blur of emails, ideas, to-do lists, but now everything starts inside Adobe Acrobat Studio. Before I speak to my team or open emails, I let my AI assistant catch me up in 60 seconds. Since all of my documents are in one PDF space, it can help me summarize contracts, briefs, and product feedback within seconds, so I have everything I need to know for the day. Then I can open up Adobe Express straight from Acrobat Studio so I can convert all that clarity into creativity. I'll design the visual overview for the day, content plan, strategy, and calendars, all by using the brand kit.
You're about to miss the most powerful breakout of the month, and you won't even see it coming. Why? Because it's hidden inside the one thing traders overlook the most: ranges. But what if you could flip that weakness into your secret weapon? In this video, we're going to show you a tool that does just that. And it doesn't just reveal consolidation zones. It maps them out for you in real time. Flags break out the moment they happen, giving you a serious edge, while others are still guessing. Let's get into it. Everyone talks about markets going up or down, but what often gets overlooked is how long they're doing either. When that movement stalls, when price doesn't push far in either direction, that's when consolidation develops. But these ranges aren't just dead zones, they're pressure cookers. Volume builds up, liquidity concentrates, and when that tension finally breaks, it's often with explosive force. And if that explosive breakout doesn't come immediately, price tends to revisit them, where they'll act as hotspots for taking profits, stop losses, and major trading decisions. Knowing this is exactly why we built the range detector. It automatically scans your chart, locks onto these high-value zones, and alerts you the moment a breakout begins. So you're not reacting late, you're prepared early. Once you apply the indicator to your chart, you'll immediately notice colored boxes. These are the detected ranges. Each range actually begins in the color blue. You'll also see a vertical line. This marks the exact candle where the range was detected, giving you a precise visual cue. From there, the high and low of the range are then projected forward, forming a boundary. When price breaks through, the range will shift colors between green for bullish breakouts and red for bearish ones. It is also worth noting that if price reverses after a breakout, but no new range has yet formed, the box will flip color to match the latest breakout direction. That means the final color you see on any past range always represents the last confirmed breakout before a new zone is detected. Inside the settings of the range detector, you'll find 3 core options that directly influence how ranges are identified on your chart. The first is minimum range length, which determines how many consecutive candles must remain within a tight, volatility-based envelope before a range is confirmed. Choosing a lower value, like 10 to 15, allows the indicator to detect quicker, shorter consolidations. Useful if you're aiming for more frequent signals. On the other hand, setting it higher, say between 30 to 50, focuses detection on longer, more significant pauses in price action, often leading to fewer but more powerful breakout opportunities. The second setting, range width, adjusts how wide the ranges appear, using volatility measured via ATR. Smaller values will tighten the range zones, capturing more compact consolidations, while larger values expand them to encompass broader market movements. Lastly, ATR length controls how volatility itself is measured. A shorter ATR period will make the tool more responsive to price shifts, while a longer period smooths the output, helping to filter out noise and highlight only the most stable, consistent volatility environments. Below that are just some styling options to give users more control over how the ranges and breakouts appear on the chart. And now that you have a strong understanding of how this indicator works, here are some examples of how you can use it in your trading to actually get the most out of your setups. In this setup, we can see that a range has been successfully detected. Now, rather than trading within the consolidation, which, as every seasoned trader knows, is often a recipe for getting chopped up. We wait for a decisive breakout to signal directional intent. In this case, price breaks down below the range, confirming a bearish move. What's crucial to understand here is that the range itself now represents a high-volume zone, a region where many traders likely got trapped. This makes it a prime area for liquidity grabs on any pullback. However, simply entering on a retest isn't enough. To increase precision, we want to align this pullback with a clear imbalance in price. To do that, we'll turn to the Price Action Concepts toolkit and enable the Fair Value Gap Imbalance setting, then set that to a higher time frame, such as the 4-hour. In this example, we spot an imbalance sitting right at the low of the breakout, an ideal alignment. But note that even if that imbalance were slightly higher, it could still be valid. What's important for a bearish setup is that the imbalance doesn't sit above the midpoint of the range. For bullish setups, you'd want the opposite. The imbalance should not fall below the midpoint. From here, we simply wait for price to retest and reject this imbalance, as it does in this case. That's our entry trigger. Stops go just above the imbalance, and we aim for a clean 1-to-3 risk-to-reward ratio. Now, as mentioned earlier, once a breakout occurs, the detected range high and low continue to plot on the chart until a new range forms. This persistent visual reference makes these zones valuable for setting both take profit and stop loss levels. In this example, we see a bullish breakout. Now price often breaks out, then retests the range's high or midpoint before continuing its move, which is similar to what we did in the first example with the imbalance confluence. But this time we have confirmation, and we also see a clear uptrend structure forming, which gives us added confluence. Now, instead of relying on a fixed risk-to-reward ratio, we can identify our target more dynamically. One smart method is to look for the most recent consolidation zone above the current price. Since it previously acted as a range, there's a strong likelihood it will serve as resistance or another pause point again. That makes it an ideal level to aim for your take profit. Now, that's just a glimpse of how the range detector can level up your market analysis. We hope this walkthrough gave you a solid understanding of how it works and how to integrate it into your own strategy. You can start using the range detector right now, completely free, at Lux/library. And if you want to take things further, the Price Action Concepts toolkit we used in this video is also available for you to explore, risk-free for 30 days, at luxalgo.com. Thanks for tuning in. Until next time, trade smart, and we'll see you in the next one.
Insurance feels better when you've just used Confused.com.
Autodesk Flow Studio. Take your storytelling to the next level.
How many times have you seen this structure? The market creates a low and then a high, and you're advised to wait for a pullback to enter? But let's be honest, we've all entered trades at what seemed like the perfect entry price, only to watch the market stop us out. Today, we're providing a solution for traders looking to perfectly time their entries between these ranges. This indicator doesn't just detect ranges. It clearly plots entry points, take profit, and stop loss levels for you, all in real time. And the best part? We're giving it away completely free. So, if you want access to this indicator, stick around. We'll show you exactly how it works and how you can get your hands on it. Let's dive in. First, let's clarify what defines a range, as traders often confuse ranges with consolidation. A range is defined by two significant swing points, a high and a low. As long as the price stays between these points without breaking either, the market remains within that range. Consolidation, however, typically occurs after forming higher lows or lower highs within the range, indicating that the market is struggling to break out and losing momentum. This indicator specifically targets ranges, not consolidation patterns. When using the indicator, you'll notice clear red and green lines on your chart. These lines indicate the high, low, and midpoint of the detected range. The midpoint is critical. This is the level we use to trigger our trades. If the automatically detected ranges don't match your preferences, you can easily customize them. Simply head into the settings and adjust the pivot length. Default is 20. This setting determines that a valid swing high or low must have at least 20 candles on either side that are lower for highs or higher for lows. Once a range is established, the indicator waits patiently for the price to revisit the dashed midpoint line. When it does, that's your trade trigger. A quick note, sometimes multiple ranges can appear on your chart, which may clutter your view. To address this, we've added a threshold setting that filters out less significant ranges, ensuring your chart remains clear and easy to analyze. Also worth noting, if you see ranges but not trades, It's likely because your take profit and stop loss levels have overlapped. You can enable overlap trades in the settings, which is off by default, to visualize these potential setups. The green area on your chart represents your take profit, while the red area indicates your stop loss. These levels are dynamic, calculated using the average true range to adapt to market volatility. This ensures your trade levels remain realistic, sometimes wider or tighter depending on current market conditions. And you'll also notice that it does not matter if price breaks outside of the range before retracing to the 50% point, effectively allowing you to also capture entries based on the pullback of false breakouts. Now, while this indicator can detect trade setups based on this structure, as usual as we would advise, never rely on indicators blindly, and always combine them with your analysis to get the most out of them. So here are two examples of how you can use this indicator to get the most out of it. In this example, we can see the market was trending higher before forming a clear range high and low, which has since turned into a consolidation zone. By marking those levels, it's easy to spot what looks like a classic breakout. But then, price snaps right back into the range. Now, instead of guessing where to re-enter, we enable our indicator, and instantly, it detects the exact same range. From there, we simply wait for price to pull back to the 50% midpoint, which becomes our precise trade entry. Normally, you might set your stop loss at the candle low or just beneath the range, but the indicator has detected increased volatility and instead automatically places the stop loss well below the range using ATR-based logic. And check this out, price does retrace back to the low. If you had placed a traditional stop loss, you'd be stopped out. But thanks to the dynamic ATR calculation, the trade stays alive, and our take profit still offers a 1 to 2 risk to reward setup. Here's another example. This time, we're combining the range indicator with the reversal zones from the Signals and Overlays toolkit. In this example, we can see new lows being created, and the upper reversal zones aren't even getting tested, a strong sign we're now trending downward. Now, the market bounces perfectly from the lower reversal zone and pulls back to the 50% midpoint, and that becomes our ideal entry. From there, you can use either the ATR-based take profit levels from the indicator or the lower reversal zone lows as your profit targets. Clean analysis, smarter execution. This indicator is called the Range Average Retest Model, and you can access it right now through the LuxAlgo library at luxalgo.com. You can also get a 30-day trial of the Signals and Overlays toolkit, so you can see for yourself how powerful this combo really is. Thanks for watching. We hope you found this valuable, and we'll catch you in the next one.
Give the whole family a holiday, including the furry ones.
35 minutes to destination. Ignition sequence start.
One ticket for the whole gang.
It seems that every week a new price action strategy pops up. Some new trend lines, liquidity grabs, Fibonacci tweaks, you name it. And let's be real, it can get overwhelming fast. But what if you had a toolkit that could cut through this noise, giving you the most critical concepts in a powerful way? Well, that's exactly why we built the Price Action Concepts Toolkit. It's not just another trading tool, it's your all-in-one system for decoding price action in real time. And by the end of this video, you'll see exactly how it works and why traders at every level are making it a must-have. Let's dive in. At its core, trading is all about price action, the movement of price over time. No matter the strategy, volume footprint analysis, TPO charts, or any other method for that matter, price action is the common thread that ties everything together. Yet mastering it can feel elusive. That's where the LuxAlgo's Price Action Concepts Toolkit comes in. It takes complex market dynamics and simplifies them into clear, actionable insights. And to do this, we start with market structure. Market structure is the backbone of price action analysis. It is a simple and clear way to identify both macro and micro trends. In order for us to simplify this for traders, the Price Action Concepts Toolkit automatically plots key labels at the most important turning points in price. So let's break down how that works. An uptrend forms when the market creates higher highs and higher lows. When a higher low is broken, the toolkit plots a bearish change of character label, meaning we might be entering a bear market. Likewise, in a downtrend, when a lower high is broken, a bullish change of character appears, hinting at a possible bullish market. However, majority of the time, the trend doesn't reverse and instead continues in one direction. And that's where a break of structure label is formed. This confirms that the market is following through with the initial trend shift and is often used as a confirmation to get into trades. So to keep things visually intuitive, these labels are color-coded based on the anticipated direction of the structure change. But if you would like to take it a step further, you can also enable color candles. This will shade your chart candles based on the structure labels. Green candles for a bullish trend, and red candles for a bearish trend. So that's it for structure, right?
You serious?
You see, an experienced trader knows that trends exist within trends. And this can cause you to enter a trade after a change of character or break of structure, only for it to turn out to be a retracement within a much larger move. So to help traders tackle this, we provide two versions of market structure. The swing structure is plotted with solid lines and accounts for more data, highlighting major macro moves, while internal structure identified by dashed lines uses less data and captures smaller structure fluctuations within the larger trend. By using both versions, you can confidently assess market structure and ensure your decisions to enter a trade are aligned with the broader market direction. Once we had the market structure implemented, it was time to tackle the next crucial element: support and resistance levels. These are key price zones where price is expected to react, making them essential for traders when setting stop losses or identifying target areas. Nearly every trader uses this concept in some form, with the most common approach being key swing points as reference levels. But we decided to take a different approach. Based on our research, the most effective and widely used method for detecting support and resistance levels is through order blocks. These are zones where market orders accumulate before a significant move, acting as hotspots of institutional activity. However, we didn't stop at just regular order blocks. We introduced volumetric order blocks. This enhancement not only highlights where orders are clustering, but also provides insight into buying and selling activity at those levels. Additionally, we gave users the flexibility to adjust the time frame for these levels and even detect breaker blocks, adding another layer of market intelligence. This has become one of the most popular features in our toolkit. For a deeper dive into how it was developed, check out our dedicated video on order blocks. And next, we dove into liquidity concepts. Liquidity is the heartbeat of the market. It refers to how easily a market can be bought or sold. After all, trading isn't possible without someone on the other end willing to buy or sell. So, market levels of high liquidity often end up being where traders' stop losses are placed. This creates prime opportunities for market makers. The Price Action Concepts Toolkit brings liquidity to life. Every feature within this category is built with the intent of how users can make trading decisions at these liquidity zones, because trading isn't just about identifying liquidity. It's about understanding how the market reacts to it. Let's break down the features available. First, we have liquidity trend lines. These dynamic zones adapt to real-time liquidity readings. Zones will only appear when market participants have actively sought liquidity there. Traders use these areas as reaction points, either to continue an existing trend or wait for a break to spot potential reversals. And then we have pattern detection. The toolkit identifies a number of bullish and bearish chart patterns in real time. To make decision-making easier, there is also a dashboard displaying the name and type of pattern detected. For instance, if a descending triangle appears, the first thing to note is that this is a bearish pattern. It signals sellers attempting to push prices lower. A trigger for this setup is waiting for the support to break and for the price to start closing below that zone before considering a trade. We also have the equal highs and lows feature, which highlights market areas that are at relatively the same level. These are most significant when they occur in well-established and clear uptrends or downtrends because they can mark the very top or bottom of the market. Once one is detected, the idea is to wait and see if it is followed by a market structure shift in the opposite direction of that trend, making them perfect for an early warning sign of a reversal. And finally, for this category, we have liquidity grabs. This is an advanced way of potentially identifying market manipulation. This feature first identifies liquidity zones and then detects any unusual price action within those areas. If such activity is detected, a bullish liquidity grab appears in blue, while a bearish grab appears in red. This often indicates that the market could start moving strongly in either direction of the grab. If both occur in relatively the same area, it could indicate a higher likelihood of a ranging market, in which case you should avoid trend trading strategies. Now that we have a solid understanding of liquidity concepts, it's time to tackle another crucial category: imbalances. These often occur as price moves toward or away from liquidity areas, creating gaps where supply and demand becomes unevenly distributed. These imbalances in the market will need to be corrected, and as such, they can act like magnets, pulling price back to fill these voids. So, recognizing the importance of imbalances, we didn't just implement one, We integrated 5 of the most significant types. This includes 3 major types of fair value gaps, volume imbalances, and opening gaps. Simply select the ones you want, and they'll be instantly highlighted on your chart. As mentioned earlier, price reacts to these zones much like a magnet to metal, making them ideal levels to set targets or to place your stop loss. If being used as an entry method, traders will often wait for a reaction off these key levels before executing the trade. Many of these trades will take place between surplus and deficit zones. To navigate these areas effectively, you need a way to identify these areas. This is where the premium and discount feature comes in. The premium and discount tool simplifies this by dividing the market into overbought, premium, and oversold, discount areas, giving you a clear visual representation of whether price is trading at a favorable level for entry or exit. On top of this feature, there are many psychological levels in trading that are widely used in price action strategies. Traders can enable key price levels such as Monday's high and low, previous monthly levels, and other significant reference points. Additionally, we've recently introduced a Fibonacci tool, but we took it a step further than a standard implementation. Instead of simply plotting fixed retracements, we allow traders to anchor Fibonacci levels between major points on the chart, using almost any feature within the toolkit. Whether you want Fibonacci levels drawn from the premium and discount zones, or between the high and low of an imbalance, the possibilities are endless. So now that we've explored all the features of the price action concepts, let's talk about the glue that ties everything together: alerts. Staying ahead in the market is all about timing, and we've made sure our alert system covers every angle to keep you informed when it matters most. The toolkit offers 4 types of alerts: pre-built alerts, ready to go for a quick setup; any alert function calls, perfect for combining multiple features into a single customizable alert; custom alert creators, offers more flexibility in combining alerts and introduces the ability to set alerts based on sequences. The all-new alert scripting feature allows you to build alerts from the ground up with ultimate flexibility, perfect for advanced users. Because alerts are such a game changer, we've dedicated full-length videos to breaking down each alert type in detail, showing you exactly how to set them up and optimize them for your trading strategy. So no matter what kind of trader you are, you'll always be in the loop and ready to act. Now you can see that what sets the Price Action Concepts toolkit apart is that this isn't just a collection of features. It's a thoughtfully designed system that simplifies your analysis and helps you trade more effectively, from identifying market structure to spotting liquidity zones, imbalances, and key levels. Everything is designed to give you a comprehensive view of the market. You can access this toolkit directly on our website at luxalgo.com. It's included in all 3 of our plans: Essential, Premium, and Ultimate. If you opt for the Ultimate plan, you unlock even more powerful features. You'll gain access to the Price Action Concepts backtester, allowing you to fully backtest every feature within this toolkit, and exclusive access to the first-of-its-kind AI backtesting assistant, an intelligent platform that understands the Price Action Concepts toolkit inside and out, helping you uncover the most profitable strategies this toolkit has to offer by simply asking questions within the interface. We hope you enjoyed this video and learned something new. Thank you for watching, and until next time.
We work on performance-based model with prop firms like FTMO, Topstep, and Apex. Our success is tied directly to yours. Meet Sarah, 7 failed prop firm challenges and over $4,800 lost. Her husband told her to quit, and she almost did, until she found Algo 1. What she did next was buy another prop firm challenge, this time with structured support. We helped her prepare, pass, and manage her funded account with clear performance-based trading. Instead of going in alone, Sarah focused on the bigger picture. While we handled the process, she only paid a fee once results were achieved, a simple, transparent percentage under agreed terms. And it's not just her. Jane, Parker, and Damien also choose to work with us. And now they are focusing on growth with funded accounts, supported by our system. And proof? All activity is tracked with verified trading records, like this, and this. Transparent, documented, and built on years of disciplined trading. So if you're ready to explore the same path, tap the link somewhere on the screen right now to see how it works. Seriously, what are you waiting for? No guarantees, just structured support designed for serious traders. And I'll see you all right there.
This isn't your ordinary support and resistance indicator. This script is an all-in-one tool that includes just about everything you need to analyze major and minor levels in the market. From signals showing when the price breaks a major level, retest that level, and even multi-time frame features. It's not only the perfect tool if you're a new or experienced trader, but we also released it for free. Anyone on TradingView can get access, and today we break down exactly how it works and give some killer examples that can easily improve your trading. When you add this indicator to your chart, it might seem a bit overwhelming, but it's really not as complicated as it looks. The green and red areas are the support and resistance levels, and these labels that are plotted in real time tells you what the price is doing. For example, if we hover over this B label, it tells you that this was a breakout, and the R label shows that the price retested that breakout area, and the T show that price is testing an unbroken level. One way we could use this is if we're trading between a support and resistance level, and you happen to get a T label. This is perfect for reversal trades, where you can set stops above or below the level and target the opposite side of the range. But if you don't want to risk trading inside the consolidation, you can simply wait for a B label when price breaks out from the channel. Now, if you want to take a trade on this breakout, you might end up with an extremely large stop loss, seeing as you'll need to set stops above this breakout candle. So what you can do instead is wait for a retest of that breakout level, which is when the R label is created. Now you can set stops above that zone and enjoy the ride down. Also, you see these blue and orange zones on the chart? Occasionally, manipulation of price can happen. So these are detected manipulation zones that the indicator will try to locate. If the price strongly rejects from these levels, a label with no letter will be shown. But if you hover over it, you'll see that it detected a rejection with high volume. Similar to liquidity grabs, they are great for reversals. Now, the best part about this indicator is that with all these features, you can set it to any time frame you want. I can be on a 5 minutes chart and see the 4-hour levels. Don't forget to comment and let us know what indicators or features to cover in our next video. And to get this indicator, simply go to luxalgo.com/library and search support and resistance MTF to get it for free today. Thank you for watching, and until next time. Support and resistance indicator. This script is an all-in-one tool. This isn't your ordinary support and resistance indicator. This script is an all-in-one tool that includes just about everything you need to analyze major and minor levels in the market. From signals showing when the price breaks a major level, retest that level, and even multi-time frame features. It's not only the perfect tool if you're a new or experienced trader, but we also released it for free. Anyone on TradingView can get access, and today we break down exactly how it works and give some killer examples that can easily improve your trading. When you add this indicator to your chart, it might seem a bit overwhelming, but it's really not as complicated as it looks. The green and red areas are the support and resistance levels, and these labels that are plotted in real time tells you what the price is doing. For example, if we hover over this B label, it tells you that this was a breakout, and the R label shows that the price retested that breakout area, and the T show that price is testing an unbroken level. One way we could use this is if we're trading between a support and resistance level, and you happen to get a T label. This is perfect for reversal trades, where you can set stops above or below the level and target the opposite side of the range. But if you don't want to risk trading inside the consolidation, you can simply wait for a B label when price breaks out from the channel. Now, if you want to take a trade on this breakout, you might end up with an extremely large stop loss, seeing as you'll need to set stops above this breakout candle. So what you can do instead is wait for a retest of that breakout level, which is when the R label is created. Now you can set stops above that zone and enjoy the ride down. Also, you see these blue and orange zones on the chart? Occasionally, manipulation of price can happen. So these are detected manipulation zones that the indicator will try to locate. If the price strongly rejects from these levels, a label with no letter will be shown. But if you hover over it, you'll see that it detected a rejection with high volume. Similar to liquidity grabs, they are great for reversals. Now, the best part about this indicator is that with all these features, you can set it to any time frame you want. I can be on a 5 minutes chart and see the 4-hour levels. Don't forget to comment and let us know what indicators or features to cover in our next video. And to get this indicator, simply go to ordinary support and resistance indicator. This script is an all-in-one tool that includes just about everything you need to analyze major and minor levels in the market. From signals showing when the price breaks a major level, retest that level, and even multi-time frame features. It's not only the perfect tool if you're a new or experienced trader, but we also released it for free. Anyone on TradingView can get access, and today we break down exactly how it works and give some killer examples that can easily improve your trading. When you add this indicator to your chart, It might seem a bit overwhelming, but it's really not as complicated as it looks. The green and red areas are the support and resistance levels, and these labels that are plotted in real time tells you what the price is doing. For example, if we hover over this B label, it tells you that this was a breakout, and the R label shows that the price retested that breakout area, and the T show that price is testing an unbroken level. One way we could use this is if we're trading between a support and resistance level, and you happen to get a T label. This is perfect for reversal trades, where you can set stops above or below the level and target the opposite side of the range. But if you don't want to risk trading inside the consolidation, you can simply wait for a B label when price breaks out from the channel. Now, if you want to take a trade on this breakout, you might end up with an extremely large stop loss, seeing as you'll need to set stops above this breakout candle. So what you can do instead is wait for a retest of that breakout level, which is when the R label is created. Now you can set stops above that zone and enjoy the ride down. Also, you see these blue and orange zones on the chart? Occasionally, manipulation of price can happen. So these are detected manipulation zones that the indicator will try to locate. If the price strongly rejects from these levels, a label with no letter will be shown. But if you hover over it, you'll see that it detected a rejection with high volume. Similar to liquidity grabs, they are great for reversals. Now, the best part about this indicator is that with all these features, you can set it to any time frame you want. I can be on a 5 minutes chart and see the 4-hour levels. Don't forget to comment and let us know what indicators or features to cover in our next video. And to get this indicator, simply go to luxalgo.com/library and search support and resistance MTF to get it for free today. Thank you for watching, and until next time.
Hi, I'm Carl. I run Intent Productions. We build stretch tents for events. We grew quickly with bespoke designs, opening new revenue streams, which led to some business blind spots. That's why we added Intuit QuickBooks to our team, with real-time cash flow visibility and powered by new AI agents. Outdo it with Intuit QuickBooks.
Let chicken consume you. The double deal for $5.99. Get the deal. Believe in chicken.
Mastering market structure is one of the best things that you can do for your technical analysis. When you're moving with the trend, it's easy to make money. When you're moving against it, you will be consistently killed by the market. Now, I've used market structure as the core concept of my trading systems since I first found profitability about 6 years ago now. And it's awesome, but it's pretty easy to get wrong. So in this class, I'm going to teach you everything you need to know about market structure so that you can trade it successfully and you don't end up catching falling knives, fighting the market, and getting killed by moving against the trend. So let's get into the basics. Markets move in 3 main phases: uptrends, downtrends, and consolidations. An uptrend is simply a phase where the market is moving up, downtrend where the market is moving down, prices are getting lower, and a consolidation is where the market moves sideways. And if we averaged it out, basically price wouldn't have made any movement to the upside or the downside. Now, these 3 phases are going to be the phases of which we are trading. We are going to buy during uptrends, and we are not going to sell. We are going to sell during downtrends, and we are not going to buy. And when it comes to consolidations, we are pretty much just going to avoid these. We don't really want to trade consolidations because there's no clear direction as to whether the market is likely to go up or go down. And the idea is we just want to move with an uptrend for the duration of the trend, and eventually the market will give us signals that it is moving back. And when it starts to show us that it might be moving down, we stop buying and we actually start to sell instead. So these are the 3 core phases that you need to understand: uptrends, consolidations, and downtrends. Uptrends are for buying, downtrends are for selling, and consolidation is for sitting out of the market or finding opportunities somewhere else. When it comes to identifying whether a market is in an uptrend or a downtrend, there is, in my opinion, a clear-cut and correct way to do this. Now, we don't want to use things like trend lines. I know a lot of traders believe a trend line indicates the direction of the market, but the problem with trend lines is actually what you can see just here, where sometimes a trend line will break, indicating to trend line traders or trend traders as a whole that the market is likely to move down, but then it actually just continues moving up. Now, when you think about it realistically, a trend line is just an arbitrary line that you've drawn on the chart, and it's not really giving you any clear insight into real price action. So instead of using tools like trend lines, we're actually going to look at the real price structure, which means when we're looking at a market, we want to view the highs and the lows, and they indicate which way the market is going. So it's the most realistic, the most raw way of looking at which way the market is heading. To do this, we use concepts we call high and low structure, which is essentially what you can see on the chart here. Higher highs and higher lows indicate an uptrend. So where you can see I've written HH, this is a higher high, and this is simply a high that is higher than the previous one. Okay, so as you can see, we are continually forming higher highs in the price structure here. Obviously, this is an example, but you'll see this on a real chart in a moment, which tells us that this market is endlessly moving to the upside. It keeps going higher, therefore indicating an uptrend. Now, in order to maintain the uptrend, we also have higher lows, and this is showing that price structure, each low, like this one, is higher than the previous one. And this one here, again, is higher than the previous one. Now, this is how we validate the continuation of the trend, because the higher highs are obviously what leads us into profitable moves if we're buying the uptrend, but the higher lows essentially protect the integrity of the trend. Providing the market continues to make higher lows, then this market should indeed continue moving higher. And the idea for us as traders, which we're going to get into soon, is to buy around these higher low points to catch these larger moves. The reason higher lows are important to kind of protect the integrity of the trend is because what can happen is that the market can come down like this and push through a higher low. Now this would then create a lower low, okay? Because this low that we've just formulated at this level is now lower than the previous low, which was indeed a higher low over the previous lows, right? So keeping it simple there, essentially this low is lower than the last one, which tells us that the integrity of this uptrend is now broken because the market is showing willingness to push lower than previous lows that were printed in the market. So what would this lead into then? Well, generally what we see after the formation of a lower low is the start of a downtrend. So this lower low might then be followed, and often will be followed, with a lower high. Okay, so we can mark that as an LH. This lower high is simply a high that is, of course, lower than the previous one, which is this one just here. This tells us that the market is actually now starting to trend downwards. And instead of moving up, and instead of looking to buy, because we're expecting it to move up, we would now shift the narrative. And what we would hope to do is see a pullback or retracement, as that's also called, to sell in and around the next lower high. We're expecting from this point onwards for new lower highs to form and for the market to continue moving down. So that is kind of how we see trends using highs and lows, and the simple price action way to view the changes in the trend. Now let's lock in on this phase of price action on Euro Swiss franc. This works on all markets, on all time frames. We're going to go through that high-low structure and mark out this trend. So from where we are going to begin, we're looking at pretty much this high, and then our swing low of the entire movement is going to be down here, and then our swing high of where price currently is up here. So we're going to work out the trending direction between this area of price action. So the first thing we can do is just use this path tool to start plotting the trend. We have our high. Here we have a low. However, one thing I want to draw your attention to is this low did not push beneath a previous higher low. So this phase of price action following to this move and then down to here is actually just consolidation, okay? Because we didn't break through a higher low, the higher low being this one just here initially, we haven't yet validated or changed the trend at all. So this would be a consolidation. Now we can then see there was a push down here. This pushed us through into a lower low. So this is actually the beginning of a downtrending phase of price action here, okay? Now from this lower low, the market comes up and creates a high. Guess what? This high is lower than the previous high. So this would be our lower high. The market then comes all the way down very quickly to this level and prints a lower low, okay? So now let's mark those on. We have a lower high, which is lower than the previous. Now we do also have a lower high just here, which was then validated with the break-in structure that appeared. And then we have our lower low once again. So we can see that each of these lows and each of these highs is lower than the previous ones that the market printed. So we can remove this for now and just focus on that structure, okay? I'm going to mark this as well. We have a high, then we have a lower high, lower low, lower high. Note how we didn't mark this low. It's because it's not a lower low. This low was lower, so this is actually still a higher low until we break this point, which creates the downtrend. So following on from this lower low, what we actually see from the market is a push to the upside just here, where this high is actually higher than the previous. So this is a higher high, or once again, a kind of transformation point for the market where we're shifting from moving down to now potentially moving up. So in real time, this would be your validation or your kind of confirming factor to tell you instead of looking to sell this market, you might now want to start looking to buy. We can then see from that point on using the path tool. So our new trend looks like this, low to high. Then we come in and we create a low here. We don't actually make a break all the way through until this point. Then we come back down and we create a low around these points, which is then followed by a push up, which pretty much takes us to where we are now. So to plot this trend out, we can see there is now a higher low, which is higher than the previous low. We then see there is another higher low printed around here. And we can see that there is a higher high printed at just this level when the market made its drive through the highs just there, creating a high that was higher than the previous one. So now let's take a look at what this looks like on the chart. We're going to run through it with the path tool so you see the full explanation. From the high down to the low is essentially the major first move. This is where we created our first downtrending price action. But to really refine it in, we have this consolidation followed by this push down, which creates a lower high and validates it with a lower low. The market then comes and creates a lower high, pushes down, validates it with a lower low. The market then pushes up to create a higher high, pulls back down to validate it with a higher low. Then we have this run to create a higher high, which is higher than this previous one. Then we come in to create a higher low and push up to create a new higher high as well. Okay, so that is the overall refined view of the trending market. And this is a market that's shifted from downtrend into uptrend. And you can see both of the directions there and both of the trends laid on that. Now, one question you might have, of course, because you can see I've averaged out the price action here, is why aren't we accounting for this area, for example, as lows? And that is because, of course, this did not create a new higher high. So essentially any price action that takes place underneath this high is then just consolidation again. We've created our low at this point. We created our high at this point. So anywhere between these two red lines is sideways price action. It's only when the market breaks out above this high that we actually validate this higher low and can then start looking at new higher lows and higher highs. Okay. So if we don't create a new higher high, then the higher low is not going to be valid, meaning basically this is the lowest point we reached before we broke through here. Therefore, this is going to be our higher low. If the market had pushed up like this and then pulled back and then pushed to this level, then this would indeed be our higher low. But for the given example we're looking at, we like to average out and see things for just the simple individual highs and lows, which in this case is going to look like this. Okay. And then on the down trending move, we have consolidation move. But then this is where our trend begins with our high down to our lower low, then to our lower high, then to our lower low. So that's an idea of structure mapped on a real chart. Obviously, as you can see, it's not as clean as a diagram, but this is what you're going to be working with. So we are going to look at a fair few chart examples throughout this class, so you can see this in real markets, as well as, of course, the diagrams and explanations we give. So let's move on. All right, so the next thing to talk about is impulses versus corrections. Impulses and corrections are the two phases of which markets trade in when they are in a trend. So during an uptrend, which is going to be pretty much all of the price action from the low here up to the very high in the trend, there are going to be two types of move in each of these little pushes we get: impulse moves and correction moves. An impulse move is the pro-trend move, which essentially means it's the move that creates a higher high, or in a downtrending scenario, it's the move that creates a lower low. So the impulse moves actually decide the trend direction, right? If we get a push from here down to here, and it pushes through a higher low, creating a lower low, that's actually an impulsive move, which is now deciding the direction of the trend. Now with this next move again as well, we have this lower high down to our lower low. And as you can see, this move pushed us through a previous low. So that makes it an impulse move, right? So the impulsive moves are essentially the movements that push price over highs or beneath lows. We can see here we have a high, then the pullback, then the impulse move is the one that pushes us to a new high. So an impulse move will push us past this level, and that's going to create the new pro-trend movement essentially. So the impulses mapped out on this chart are pretty much all of the ones we have now marked, along with this one here. These ones, so 1, 2, 3, 4, are bullish impulses, and they are pushing us into new highs, confirming the existence of an uptrend. For the bearish impulses, we are looking at this one and this one, because this one here pushes us from a high down to a low, which is lower than the previous low, crafting that lower low, therefore breaking us through a low, becoming an impulsive move. So the impulsive move basically determine the downtrend here, and then following impulsive moves will continue the downtrend. Now, if the market created this low and then had a push all the way back up like this, which pushed us over this lower high once again and actually created a higher high, then this move would be the impulse move to a new uptrend, okay? So that's impulses. The second type of movement is corrections or corrective moves. Corrections are the pullback moves. So a pullback is essentially where the market is slowing down temporarily and making a movement kind of against the overall trend. Now, this happens because, of course, buying is very strong in these impulsive moves, but people are going to take profits. Some people are going to sell. So we get this kind of alleviation for the market where weakness comes in for the short term until we see a price where traders are happy to buy in mass again. Then we get that new impulse. So corrective moves are basically contained within the high and the low of each of the impulsive moves. You can see the low of the impulsive move is there, the high is there. The corrective move does not break above a high, and it does not break beneath a low. All it does is pulls back inside of the range of the larger impulsive move. So you can see that's what's happening with every single one of these corrective moves, okay? So a corrective move is basically counter trend. If we are in an uptrend here overall, so this averaged out is going to be a pretty clear uptrend. Let me mark that on. We know the impulsive moves are therefore going to be up or pro-trend moves, and the corrections are actually going to be going down. So they counter the overall idea, okay? They are essentially retracements or pullbacks or phases where the market is going in the opposite direction to the overall bigger trend. Now, in the downtrend where we have bearish impulses or downtrending impulses, which are continuing to push the market lower, the corrective moves are going to be pulls back to the upside. So any short sellers who are profiting from sell moves are going to buy back their contracts, which is how they close them to take a profit. That's going to inject small amounts of buying pressure into markets around new lows, which will create these corrective moves, pulling back. So we call it a correction, a pullback, or a retracement, either or, any of those. And then when we reach our new lower high point, then we will follow through with a new impulsive move, okay? So impulse moves are pro-trend and corrective moves are counter-trend, okay? And it's important to understand these phases because we are always going to be looking as to whether the market is continuing to make bullish impulses or whether it breaks into bearish impulses. Now, if we track the impulse moves, that is how we determine whether the market's making new highs in an uptrend or whether it's breaking down into new lows in a downtrend, or once again, whether it's going to be breaking from a downtrend into an uptrend by making a new bullish impulse. So it's important to understand the concept of impulse and corrections. Now, another use case of these impulse corrective moves is these corrections, which in the uptrend are going to be pulls to the downside, are actually where we want to buy. Now, if we want to buy a market that is continually moving up, it's ideal for us to be able to buy as low as possible because, of course, the lower price we can get in at, the more profit we can make when the market moves to higher prices. So what we don't really want to do in an uptrend is end up buying up here. Okay, we don't want to buy at these levels. We want to buy as low as physically possible in each of the moves. So if we see the market push up like this and it creates a new high, rather than buying here, we want to ideally be able to buy somewhere in the corrective move. That way, not only do we profit on all of the movement that happens above this level, but we can actually profit on all of the price movement that happens as price reapproaches a previous higher high, okay? So we get the biggest profit potential by buying from the corrective points or the corrective moves in an uptrend. And the same goes for a downtrend. If we can sell around the high of the corrective move, then we get the biggest profit on a short trade, which is basically where you profit when the market falls, by getting in here and managing to catch the entirety or the majority of the downward impulsive moves that then occur. So now we've popped back over to our Euro Swiss franc example, and we're going to mark the impulses and corrections on this chart. We're going to start with the impulsive movements on this phase of price action from the very beginning. So we have a low here, which is then pushed up, and it's pushed us over the previous structural highs. So from here to here is our first impulse, okay? Then we can see the market pulled back. However, it failed to break through the low. So therefore, this is going to be a corrective move. So let's mark them different colors based on the trend. Green, that's going to be our impulse. Red, that's our correction. Then we have another push to the upside here, creating a new high ever so slightly. That is going to be our impulsive move. And then the market comes back and creates a bearish corrective move. Why is this a correction? Again, because it didn't break us through any significant lows. In order to change the trend, we would have needed to see a break of this low here, okay? So then we get another impulse to the upside from this low to this high. That's going to be an impulsive move or a pro-trend move. Now, this is where things get a little bit messier, and this is good to show you. This move here, although it did eventually follow through into a lower low, in real time would have been seen as a corrective move because, of course, we can't see that the market was going to move into a downtrend. So we would essentially be looking at buying this level in anticipation of the market then moving higher. Then what we actually saw from that point was that the market didn't push higher. It ended up pulling back here. So this move realistically is just going to be seen as a consolidation move. And that goes for basically both of those pushes there. From this point to around here, the market didn't get anywhere. It just failed to make a new low, failed to make a new high. So this is a consolidation or a phase of price action that we would generally want to not trade. Now we then do get, however, from this high down to this low, an impulsive move. And this one can be classified as an impulsive move because it broke through a previous low, right? We see that we had this low marked up just here. This low was broken with this move down. So that creates a new bearish impulse, or basically makes this push down a bearish impulsive move or a downtrend impulse. So that would then lead us to kind of shift the narrative. We're not looking at bullish impulses and bearish corrections anymore. We're looking at the impulses to be the large down moves, and the corrections now become the shorter pullback moves. So this would be our corrective move. So what we can do is make this one green so you can see this is an impulse. Our next correction would then be up to this point. Our next impulse would be down to the low just here. But then we have a pretty immediate market shift. So from this low up to this high is also an impulse. And the reason that this one is an impulse is because it has created a high, which is higher than the previous high, okay? So we have impulse, correction, impulse, correction, impulse. That's an uptrend. We move into a bit of a messy phase of consolidation, but then we make an impulse, starting a downtrend, correction, impulse, continuing the downtrend, but then we are immediately followed by another impulse, which pushes us back into new highs, therefore validating a new uptrend. So the next corrective move is going to be a bearish corrective move, which is the pull down from the high that we've just marked down into this low. This is our correction because the market is now actually moving to the upside. It's bullish, okay? So our next impulse will then be from this low to the formation of a new high, which is going to be this piece of price action here. So that's going to be our impulse. Then we have a corrective move down to this low, followed once again by an impulse, which pushes us higher, okay? So that's a view of the impulses and corrections on a real chart. You can see that the market is initially bullish. So the impulses are making new highs. Then we have an impulse move that makes a new low, which makes the market bearish or downtrend. Then we have an impulse pretty quickly that pushes us back into the uptrend, and the market phase continues from there of continually making higher highs and higher lows. So let's plot this on real quick. We have pretty much from this point onwards, that is an uptrend, okay? So this phase is uptrend. We then have from this low up to this high, which is also going to be an uptrend. So let's make these green as well, just so that we are very clear on that. Then we have the consolidation, which is pretty much nothing happens at this phase. We're going to leave that gray to indicate no direction. And then from the high that we print pretty much there, down to the low just there, we're going to mark that out as a downtrend because that is where the market was shifting to the downside. So now you can see how we've formulated the market direction by using high-low structure. And then we've also plotted them as impulse corrections. So you can see what that would look like. Now, I know this is rather messy. Don't worry, your analysis is not going to be this messy. I'm plotting this on to show you the theory. Okay, we'll keep it simplified when we get down to some chart examples in a bit. Okay, so we've been through high-low structure. We've been through uptrends, downtrends, consolidations. We've talked about impulses and corrections. Now let's talk about break of structure, or BOS. Now, a break of structure is simply a tool or pretty much a markup that we use to determine where the trend has broken. So a break of structure is pretty much every time a new high or low is broken, we envision that as a BOS, or a break of structure. It's simply because the structure has now broken in one direction or the other. Okay, so we have the high printed here. When the market comes up and prints a new high, that creates a break of structure. And the break of structure takes place at the previous high, pretty much at this point here where the market pushes through. Okay, so that would be a break of structure. We also see another break of structure here when the market pushes through the previous high. Why do we call it a break of structure? Well, because the existing structure is breaking into a new high or a new low, right? Now, we use this BOS tool to kind of simplify and envision where the breaks are happening to keep us in line with the trend. You'll see later in the video how we use this to create confirmations and formulate real trades. Now, I indicate breaks of structure both ways. There's also something that people use called a change of character. So it's actually called a chock or a chotch or something like that. In my eyes, this is nonsense terminology, and I'm not going to use that. So if you've used that before, I just call it a break of structure, just so you don't get confused through the video. If you haven't, you can use it if you want, but I just prefer to view things as what they are. So I mark then the level here where the market pushes from higher highs and higher lows into its first lower low as, again, a break of structure. What we've actually seen now, though, is a reversal break where the market, initially these breaks of structure or BOSs were bullish. We were seeing bullish breaks into new highs. Now we've seen a bearish break of the structure into a new low. So this BOS here indicates a trend reversal. Now, as you can see, this high, where our break of structure could potentially take place if the market pushed higher, it doesn't take place. Okay, we don't get a break of structure there. Instead, what we get is a push through the next low, which then again creates the next break of structure, or in this term, creates a bearish impulse and validates continuation of the downward trend. So breaks of structure are essentially taking place at the points where highs are breaking into new highs or where lows are breaking into new lows. And these things are going to be pretty much how we indicate which direction the market is going. We're going to use them for trade confirmations and just making the analysis clearer. You're going to see these a lot more, but that is what a break of structure is. And some people will call this one a chock, change of character, whatever. I don't do that. If you do, you can continue to. But throughout this video, you're going to see this indicated as breaks of structure instead of that. Okay, so let's move on. So in a simplified manner now, we're going to run through this little phase of price action on Australia dollar, Japanese yen, and mark out these breaks of structure. So we're going to begin around here. We have a high, pushed down to create a lower high, and now we've pushed down to create a lower low. Now, until we break this high, we are not really changing the trend direction because, of course, the market could pull up to pretty much here, but still keep moving down. The reason for this is the market here did not make a new low. So this is still our valid low. And anything that happens between basically this level and these levels here is just consolidation. So this entire move becomes a consolidative move. So what we would do to approach this is mark our BOS line on around this high. We're going to just put it there just to keep it nice and simple. And then we would have a BOS line that we could mark out here. If the market was to push through this low, that would create a break of structure upon the push through, which would continue the bearish move. But what we did instead in this example was push to the upside, which at this level, where we start to close above the previous high, creates our first BOS. So the valid break of structure, or BOS, is this one here. There's no break here, so there is no BOS there. From that point onwards, we created a new high. We then came down, created a new low, and we pushed up to this point, which created, once again, a new high. So at that point, we see a clear BOS. We see our high printed there. We can drag that across, and you can see the structure, being this high, has broken into a new high. Okay, so that's going to be our next BOS. Now at this point, our valid low is this level. So we've got two opportunities from pretty much this point onwards in price action. Either number one, we create a new low, push higher, indicating a break of structure and continuation of the uptrend. Obviously, you can see that is what happened. But the alternative would have been if the market had pushed down, crossing through this level would have created a BOS here, and that would have indicated further downside or the start of potentially a downtrend, which could push us into bearish impulses. Okay. Now, obviously, as you can see with the benefit of hindsight here, this market pushed into a new high, creating a break of structure at this level here as the market pushed its way into a new high. So what this does again is now creates our valid low. This is our higher low. We know that because the market's gone and closed higher. So this would be our BOS point, right? If the market was able to push through this level, that would indicate a downward trend. What we see happened is we pushed up, we pushed down, we stopped there, we pushed up and created a new high. So what we've got now is a new higher low, which we can pretty much put in around this point just here. So from this point up to here, that's going to be our break of structure at this level. And now, again, we've created two levels to work with. Either we push up, pull back, and then push up again, creating a new high, or we come and push down and break through this low, which would indicate a downtrend beginning. Okay. So from where we are, which is here, we now see the market's pushed up. It did come down to break through this low, but it only broke with a wick. And we're going to get into this very soon. I want to just briefly mention it now, but if you see a wick like this, we don't really use this as a valid closure or a valid change in the trend. Now, a wick, the little sticks coming off the candles, what that indicates is rejection of price action. It's the candle bodies or the big blue and gray blocks that you're seeing that indicate confirmation. So if we wick under a level like this, that's not necessarily telling us that this market is going to be moving to the downside immediately. Sure, the fact the market got down here could be indication that maybe the trend changes soon, but it's not really going to validate a change in the trend until we see confirmation with closures. So following this push lower, we then have a push higher, which pushes us over our previous high. However, once again, these are just wicks. So pretty much from this low all the way up to this high, we now have a little phase of kind of no man's land where we haven't closed above, we haven't closed below. What we've just done is create a wick beneath and a wick above. So that actually puts this bit of phase of price action from here through to here into what we call a consolidation. And until the market made a closure one way or the other, we wouldn't have validation as to whether the market is going to continue moving up or whether it's going to start moving down. Now, at this point, obviously, here, we created a break and close, and that went underneath our previous low. So just clean this up a little bit. Our previous low that we had marked was pretty much these levels here. And as you can see, this push created closures beneath that level. So therefore, this would become our BOS or break of structure because we've seen closures underneath the level. And this is maybe first indication that the market is now moving in a downtrend, which as we can see, it's kind of what it's doing because it's pushed us through to the next lows as well. So by marking the BOSs and marking the swing highs and lows and waiting for a break of structure either way, we basically get validation of whether a trend is going to continue going up, continue going down, or reverse to the other direction. Here we had our first break, which came in at this level here. That indicated an uptrend where we had bullish impulse, bearish correction, bullish impulse, bearish correction, bullish impulse, bearish correction, bullish impulse, bearish correction. Then we shifted into consolidation. The market did nothing, but eventually it broke through. What's this break? Well, this, considering it's now broken through a lower low, has become a bearish impulse. So now we could look for bullish correction, bearish impulse, and so on and so on and so on. That would be the first indication that this trend could potentially be changing direction. So that is how we plot BOS on the chart. And really, it's just for, number one, confirming trend directions. Number two, keeping our structure analysis pretty neat. As you can see, this compared to what we did before with drawing the impulses and drawing the HHHL structure on the charts, it was a bit of a mess. But this is very simple and easy to work with. We can see from this point onwards, if the structure breaks here, we go up. If it breaks here, we go down. If it breaks here, we go up. If it breaks here, we go down, etc., etc. And it gives us a clear way to understand which way the market is going and a clear way to react to the breaks in structure that we may see, whether they are up, pro-trend, or down, counter-trend, and the start of a new trend. So now we've taken you from no understanding of structure through to understanding impulses, corrections, how to determine uptrends and downtrends by using high and low price structure, and how to identify and indicate breaks of structure, which will either continue moving the market higher or lower, or indicate reversals as we see here. From this point, you've pretty much got everything you need to build the foundation of a profitable market structure trading strategy. Now we're going to talk about some traps and nuances and mistakes that people make before going on to showing you how to profitably trade using the structure theories we've discussed so far. So the first big mistake that a lot of traders make with structure is getting the internal structure wrong, right? Now, internal structure is anything that takes place inside of basically one of these impulsive moves. So our impulse in this example is from this low up to this high. Anything that takes place under this high and above this low is called internal structure. So the market can do whatever it wants. Unless it breaks out one side or the other, there is no real shift or no real urgency for us to start looking for positions. And any trades we do take are going to be kind of lower probability because they're not moving with the larger trend. Now, the mistake that people make in regards to internal structure is they will see a high forms and then we get a little low, which is internal. We get a new lower high, also internal. And then when the market breaks through this low, for example, traders will then see this here as a break of structure and a confirmation of this market going lower. So they will start looking for selling opportunities, thinking because the structure is broken here, we've actually seen a change in this upward trend. Now, you may already be able to see the problem with this, and that is because with it being internal structure, we still have a clearly intact uptrend. We had an impulse, we had a correction, we had an impulse, and now anything that happens here, whether it does all of this crazy price action on a lower time frame, is still just a corrective move. And the market can then still, and probably will still, go and push up in line with the larger uptrend. So if you start selling after an internal break here, let's say you sell from this high when the market pulls back, well, what can easily happen is that the market just pushes through into its next impulsive move and you end up getting killed on the sell because you've sold into a market that hasn't actually indicated a break in structure at all. Now, what we could see, which would make this better, would be if the market had pushed up like this and created a new higher high, okay, at this level, well, then that would have, number one, created a break of structure here, indicating a new impulsive move, which would then have created this price action of impulse, correction, impulse. And then if the market had pushed down through this low, that would be indeed a break of structure, which would be a bearish impulse. So we would be well within our right mind to sell from here on out because we will have actually seen a clear break of structure where bullish impulses are breaking into bearish impulses. But when you start to see the market like this and you treat this as a valid break in structure, well, now you've got a problem because this here is not a higher high. All it is a piece of internal structure that really doesn't tell us much of the story. And if you start selling into that, well, then when the market breaks up to make a new impulse, you're going to lose and you're going to be confused of why it happened. But hopefully not now that I've explained that. So making sure you don't get caught up in the internal structure and make sure you're only working off of the clear high-low structure of the market is a very simple way to avoid one of the biggest traps and biggest mistakes people make with structure. Right, now I want to show you that on a chart because I think this is going to resonate with a lot of people who have been into structure trading before or currently and are struggling. So if you take a look at this chart here, we've seen a break of structure which has taken place over the previous highs, this being the break, and this being what some people will see as a higher high. So seeing this price action on the chart, a lot of people are going to look for buys when the market pulls back. So they might look for the retracement with the expectation to then continue buying this because they see, well, this is broken structure, which has pushed us into an uptrend. Okay, you can see that there is on the surface a break of structure here, over this high, and over this high. Now, the problem with this is there is actually no clear break of structure here. Although it looks like there is, it's a bit of an illusion. Because if we look at the low that's been printed by price, which has taken place down here, we can now see that realistically everything that happens above this low is just internal structure. If we look at our impulsive move, it begins here and it runs all the way down to here. There is then nothing which has indicated a new break and change in the structure. So until we push over this high, there is no change in the trend. And all this is a corrective move that is likely to then follow through with a new impulse. So although it looks like when you look at this structure, we see, okay, we've had a break of structure, we're happy to start buying. Realistically, there is no reason to do that. In fact, if anything, you should continue selling because there's been no change in the structure other than this small kind of internal structure, meaningless pullback move. So if you were tricked by this, and I know a lot of traders are, this is one of the biggest problems with structure, then you're going to be drawn into buying when in reality what happens is the market just makes its next impulsive move and pushes into new lows. So what would have fixed this? Well, rather than creating our low and then just trending up like this, if we had instead created the low here, pulled back to these highs, then created a new low, and then pushed up above the structural highs, that would be a valid break because we'd have actually seen the impulses changing direction. But because we didn't get that, this is indeed still just a corrective move and is unlikely to lead into a large reversal, so therefore should be approached as just a correction to sell from into further bearish impulses. The next big mistake that people make with structure, and this one's a really easy fix, is failing to differentiate liquidity sweeps to breaks of structure. Now, a liquidity sweep, we're not going to go massively in depth on the topic of liquidity in this video, but there are many classes on my channel. But a liquidity sweep is basically where the market will push above or below a swing high or low, take out liquidity, which is essentially orders, and then reverse sharply in the opposite direction. As we can see when we look at, of course, the low we just drew on here and the high that we have up here. So we see a push beneath the swing low and then a sharp reversal. We see a push above the swing high and then a sharp reversal. So although on the surface these may look like breaks of structure because the market has pushed through this level, it's actually not. It's actually pretty much the opposite and is very likely to move against you. So the way you can differentiate between actual breaks of structure, which are going to lead into, new moves, and the liquidity sweeps that are going to lead into sharp reversals, which will kill you, is to look for closures above or below structure. So we can see at this low, we had no candle closure. And the candle closure, by the way, is simply when we see a large candle body like this close through a high or low. So if we look at this previous break of structure, we have a high, low, and then the break of structure which takes place here is a closure. We see a candle close higher than the previous high. That is going to indicate continuation of the trend. When we look at this potential reversal though, we actually see no closure under this low. We see a wick instead. Wicks indicate rejections or rejected and attempted price action. Bodies indicate confirmed and closed price action. So if we see the selling rejected at this level, what's that telling us? That's telling us buyers are too strong for sellers to get down there. So the next likely move is we go all the way back up and carry on in the uptrend. So by seeing a wick here, do not treat this as a break of structure. This is instead a liquidity sweep. The simple rule you can follow is if there is no candle closure above the level, don't buy. If there's no candle closure beneath the level, don't sell. Don't expect that to lead into a new trend. You have to see closures, such as we validated the breaks here when we started to see candle closures at this area over here, okay? That would be fine, but until we get a closure, as long as it's just wicks, treat it as either consolidation or no confirmation of reversal. So we can see again, after we pushed above this high, no closure, and then the market went for a sharp reversal. If we'd have seen a candle body close above this level, that would have then indicated that we can start buying pullbacks. But because we didn't get the closure, because we only got the wick, we see this as a sweep of liquidity or a sweep of the high and low instead of a closure and confirmation of continued trend. So make sure you're waiting for candle closures and not trusting wicks, because if you trust a wick as a break of structure, you're going to get killed a lot of the time. So we've discussed pretty much everything there is to talk about in regards to structure, and now we're going to learn how to trade it. And the most simplistic way to trade with market structure is by introducing a concept called supply and demand. Okay. So what we have here is a diagram of an uptrending market. We have higher highs and higher lows. The market is impulsing to the upside, and then there are bearish corrective moves. Now, when the bearish corrective move bottoms out, we create here what we call a demand zone. The demand zone is basically an area where significant demand has come into a market, or in other words, where significant buying has taken place. Now, when we see a large impulse like this is driven by institutional buying. Okay, the big push that breaks us into new highs is basically banks and trading firms placing significant orders, which is big enough essentially to drive the market. Okay, the more people that want to buy, the higher prices go because the more sellers can demand for the asset. That's why they go high. So more people that want to buy is pretty much equivalent to the demand to buy. So another way of saying more people want to buy is saying there's high demand. Okay, there's a lot of demand for buying this asset. When we see a corrective move bottom out, we then see what we call a demand zone a lot of the time, which is basically an area where the market has very temporarily gone sideways or consolidated before a large impulse to the upside. This tells us that this is a good place to buy. And basically the concept will then be, if this is seen as a good place, a good price level to buy at, when the market returns to this level again, we are likely to see more buying taking place. Okay. If there's a discount and then things get expensive and then it comes back down to the discount and you want it, well, you're probably going to buy it down there. So that is what supply and demand is. Now, this is demand, the buy side. On the sell side, it works the exact same way, except what's happening here is the institutions are injecting significant amounts of supply into the market. So that is why we call it supply instead of demand. Obviously, this is then seen as a premium price to sell. If the market retraces to it and you want to sell your assets, well, the more you sell it for, number one, the more profit you make if you are in a buy trade. Number two, the better price you are in at if you are looking to short the market. Okay, so that's the supply version. Let's focus on demand for the moment then. So what we often see within the market when we're looking at candlesticks is we have our demand zone, push away, and then the market pulls back, retests the demand zone, and then makes its next push away. Now, it's not always going to come back. Sometimes it's just going to come to there and then run away, and you'll miss that trade. But it's the most simplistic and effective way to trade the trend using market structure by just looking to buy demand zones and sell supply zones. So in this example then, following on, we had a demand zone, impulse, correction, retest of demand zone. This is where we want to buy. Then following that point, we have had a demand zone, impulse. We would now look for a correction, and our demand zone is where we would want to buy again. Okay, so we would essentially approach this market by buying this level, stop loss beneath the low of the zone, and then we can look to continue the market higher because we know with an uptrend intact, it's likely that we're going to get new highs once again, right? So that is the simple supply and demand way to trade. That's demand for uptrends. You only want to trade demand in uptrends, and you only want to trade supply in downtrends, okay? And this is simply going to be the same, but you're looking to sell the market instead of buy, all right? So this supply and this supply become good selling points. Right, let's take a look at this on a real chart. So we're doing a bit of replay and we're looking at NZD/JPY, 15-minute time frame. But for reference, this will work on any time frame you want to approach the market from. So at this point in time, we are looking at a downtrend. We've seen the market here create a high, then we've pushed into a lower low, then we've created a lower high, we've pushed again into a lower low and a lower high, and now we've pushed lower once again. So we are now in a downtrending move, right? Just to draw that out for you, we have this kind of price action, and we are currently trading down here. Now we can see this downward move, this break of structure was created by a supply zone here. And to show you how I plot supply, I simply use the last candle before the impulse that has imbalance. So don't get confused. I'll break it down for you now. We see this candle here, this gray candle. This is the last candle before the impulse to the downside. Okay. So that is why that will be the supply zone. Simply the last candle essentially before the push begins. So to show you a couple more examples, we would have this gray candle here. This is the last candle before an impulse to the downside that broke structure. Therefore, that is going to be the supply zone. As you can see, if you'd have sold that supply, you'd have caught a very nice entry to that move. Okay. Now, the imbalance point I just made, an imbalance is simply an open candle range. So when we look at, for example, the supply zone we're currently focusing in on, we can see the wicks of these candles here go up to this point, but don't go into the supply zone. So that creates basically in this area here, what we call imbalance, right? There is no wick filling this zone. So if this wick had traded in, that would have created efficiency or balance. Therefore, we wouldn't have any imbalance. Therefore, this supply wouldn't be of interest to us. But because there is still this open price range between these wicks and the wick of the supply zone, there is basically a draw. This is going to act as a magnet that pulls price towards that level. So this is therefore a level of interest. Now, that is why we are not going to be interested in, for example, this, which is a last candle before an impulse. Why is that? Well, because this one has already been hit. So this could have provided its own trade, but we are kind of past that point now. There is no gap between this wick and the candle that we're looking at as our supply. Therefore, there's no real reason to focus on that level, okay? Again, here we have supply, but there is no imbalance. There was initially between this candle and this candle, but the market's filled this now. So there is no imbalance there for us to focus on, therefore making this one irrelevant as well. So the zone that we're looking at here is basically the last imbalance point in this leg of downward price action, right? Nowhere imbalance down here anymore. The only imbalance left is up at this point. So with this being the last candle before the impulse, and with it being an imbalanced supply zone, we know the market is trending down. We have that clearly mapped. Down, correction, impulse, correction, impulse. We would then want to look at this supply zone as our selling move, okay? So providing we don't push above the high around here, or even in this scenario around these points, we should remain bearish. Therefore, we could confidently sell this supply with stop losses above those highs and expect the market to at least come down towards this low again, right? So a simple way to approach is simply to target the low that's been printed in the market. Now, you can actually extend trades further because you're pro-trend trading. So if you wanted to and you expected the market to keep going, you could extend the target further. But for simplicity's sake, we're going to look at it like this and actually map just a target down into the low, all right? So generally then, what we would expect to see is for the market to return to the supply zone and then lead down in an impulsive move to create a new low, which would then open the doors to the next opportunity, right? Again, with this push down that we've now seen, we could look at the last candle before the impulse down. That's going to be up here for this example. So this would be where we would look to sell the market, all right? So if you were following this simple trend trading system, you would have your entry around this supply. Your target would go down into the swing low here, and then you would just look to sell that market when the market returns to it. Now, obviously, there are nuances. You can use confirmations and things like that, but we're keeping this lesson on track, on topic to market structure. So we're going to just follow this simplistic approach. Market returns to there. We are then hoping to see the market sell off. And as you see, in this instance, it didn't happen. So what we get here instead is, number one, a losing trade. So that's going to be minus 1%. When we factor that up, though, we have a minus 1% trade here, and we have a plus 3.94% trade there. So in total, over these two trades, you've made 2.94%, even though you've only won one and you've lost one, okay? 50% win rate, you're still up 3%, just over two positions. Now, this is where the real beauty of trend trading kicks in. Let's think about what this has actually told us. Although we've just lost a trade, the market has broken structure. We've seen a push, which has created a BOS over a previous structural high. So let's map that. We're up 2.94% so far. And what we've actually done at this point in time is reshift the structure from down to up. So if we continue this structure mapping, we've got one impulse, correction, impulse, correction, impulse, correction, impulse. Now we've had another impulse, okay? So we had some internal structure mess arounds, and then we had a big push to the upside, which has created an impulse. What has this impulse done? This has given us a higher high. A higher high indicates the market is likely changing direction. So what do we do from this point on? Well, first of all, that's going to be the low that we're focused on. if the market pushes under this low, that would actually shift us back into downtrend. But providing we stay above that low, we can actually now look for buying moves. So what I'm going to do here is mark out the demand zone, which is the last candle before the impulse, which has created this break of structure. So what we would now want to do is place our buy orders here, stop loss under the low, and then we could target the newly formed high, or we could extend that target even further because we now have a good idea and a good understanding that it's quite likely the market will retake this high, given that it follows the standard trend structure of, let me just map it out, low, lower low, lower high, higher high, confirming trend reversal. We're now looking for a higher low to take us into higher highs. So the no-brainer trade is the one we have mapped here. Now, let's give this a moment and see how this goes. So we see internal structure, market's not really doing too much at the moment. Then we come down into this area of demand. So the trade is then going to be triggered at this point. Now you're in a position where, number one, the market goes up and you win. Number two, the market goes down, and that's going to reshift the trend and provide you with a new opportunity to go the other way and sell. Okay. So the goal with trend trading is not to be right all of the time. Nothing in trading is going to make you right all of the time. The goal here, and with pretty much every form of trading, is just to have positive risk reward and positive expectancy, meaning we can be wrong on 50 or even 60% of trades, but the ones that win are considerably larger. So if we take a look at this, we've had a 5.42% win there at 1% risk. We have 2.94%, 5.42%. We're looking at around an 8.3-ish% return over these positions. So we have one loss, two wins. Decent win rate, but nothing crazy, 66%. And we've actually made 8.3% in just 3 positions by using this simple supply and demand method in line with market structure. So it's incredibly simple, but this is how we start to turn market structure theories into actual trades. Now, there is an extra way that you can double confirm trades if you feel a little bit nervous placing sell orders and buy orders on these supply and demand zones. This is what we call a standard confirmation entry. Now, in this market, we can see there is a clear downtrend at the moment. We created our low, lower high. Now we've pushed down with a massive impulse into a new lower low. So if this high around here breaks, that would push us back into an uptrend because that would create a impulse, which was bullish. But providing we stay underneath this high, we would be creating a lower high. Therefore, we'd have good odds to sell this market down back towards the lows, okay? So an immediate trade you could do following the method we just discussed would be a short position or a sell trade. You'd sell supply with a stop loss over the high, and your target would go down into this low. Now, this, of course, is what we just discussed. This would be a fine way to approach the trade. However, psychology plays an important role in trading, and some people are going to be a bit too scared to go placing buy and sell orders on supply and demand zones like this. And sometimes you might have a couple of zones that you work with, and you're not sure which one's going to be the one that's going to create the good move. So this is where that standard confirmation comes in, okay? Now, a standard confirmation is simply a price structure reversal that happens on a smaller time frame to the one that we've prepared our idea on. And what it looks like is this that I'm drawing on the chart right now. We have an area where the market is going from higher highs and higher lows, breaks down into a lower low, and then we just simply look to use a supply zone up here to sell the market when it returns to this level. We would generally look for these patterns inside of supply and demand zones that we're interested in buying or selling from. So in a sell scenario, we have our supply zone. We know if the market gets into here, we've got good odds of selling. So we would then look for this pattern on a lower time frame once the market has hit this supply zone. And if we see that, so essentially what we're looking for is a movement like this, that's going to give us the indication and the confirmation that we need to basically double confirm the trade and give us maximum confidence on this position, which gives us the benefit of being able to execute it without worrying. And essentially then you will look to get in at this point at the top of this smaller corrective move after this lower time frame has also created a break of structure. Now this market did provide this opportunity, so let's take a look at that now. We're going to drop down to the 5-minute for this one. We are now looking for that standard confirmation that we just discussed once the market has hit this level of supply, okay? So here you can see we've had a push up, high, pull back, higher low, push up, higher high, pull back, lower low. So here we've had a break of structure on a lower time frame. Okay, the break came in here when this candle closed beneath this previous higher low. So you can see that kind of, we get a trend inside of a trend, right? Although we're looking at an overall downtrend, we can see that there is kind of its own uptrend on this lower time frame. So what we're looking for is this uptrend to also shift into a downtrend, because then we have high time frame and low time frame agreement, right? When you get high time frame and low time frame agreement, you have the best odds of success in a trade. Now what we're looking for is a supply zone with imbalance. We can see here this blue candle, which is the last candle before the impulse, the last candle that goes sideways before the push down, right? Still has some imbalance in it between this wick just here, okay? So therefore, that's going to be our area of interest. We can sell there, stop above the high. Now, realistically, you can put your stop loss above the swing high. If you want to be safe though, you can still keep it over the higher time frame structure. And then targets wise, we are just going to go down and target the low that we were looking at before. So if we go back up to the 10-minute time frame, you can see that we also have that confirmation here. High, higher low, higher high, lower low. Okay, we've had a break underneath. Now we'd be looking to sell upon the return to this level. So this will be a 5% return trade. If you went for the refined one, you're looking at 10% plus, which is a massive position. And here's what it looks like in the real market. So you see a drive down from that level, and slowly, surely, eventually the market gets its way down to the target. So that is how you use confirmation entries to get safer opportunities, because number one, you've got high time frame agreement, large bearish impulse, corrective move, supply zone to sell. Now, number two, you've got low time frame agreement. We have the impulse on the low time frame shifting us into a bearish market. We can look for a pullback and then we can sell from there. We can target this level and we have many opportunities to take partial profits or go break even or stop trail along the way. Now we're going to talk about substructure and swing structure, because this is where a lot of different opportunities come in. So remember we discussed the impulse correction format of a market. Well, depending on what time frame we're looking at, we're going to have kind of trends inside of trends. So if your high time frame analysis and your high time frame trend is on, say, the 4-hour time frame, on the 30-minute time frame, the hourly time frame, the 15-minute time frame, the 5-minute time frame, there are going to be these smaller trends inside of trends. You're going to see smaller trends taking place as you zoom in because there are more candlesticks available. So we can section the analysis into two types. Number one is the swing structure, and that is the clear directional bias of the higher time frame that you've analyzed. So if we analyzed an uptrend on the 4-hour, the 4-hour structure is going to be the swing structure, and the uptrend that we found there is going to be, again, the swing structure. But this is where the magic happens, because inside of the corrective moves or the pullback moves that we see, we get substructure, which is kind of that internal structure that we discussed. This is going to be just the corrective pullback move. But when we look at this on a time frame lower than the one we analyzed on, so in this example, if we have a 4-hour as our swing structure and it's an uptrend, then anything beneath the 4-hour, so perhaps a 30-minute could be our substructure. And what we're going to see on the 30-minute there is inside of the corrective moves, we're going to see smaller trends. And what we're going to see there on the 30-minute is inside of these corrective moves, we're going to see smaller downtrends, okay? Whereas these might not be so visible on the 4-hour, it might just look like a couple of candles pulling back. There's going to be actual obvious trends when we scale in, creating that trends inside of trends format that we've just discussed. Now, why is this beneficial? Why am I telling you? Because this provides us with new trades. We don't just have to stay isolated to buying the higher lows, but what we can also do is look at opportunities in the corrective moves to sell down through the corrective move inside of these lower time frame downtrends. Now, there are some nuances around this, and we need to be careful that we don't try to extend markets too far. So what we're going to do is go to the real charts, and I'll show you some examples of how we can trade this substructure. Let's go now. All right, so for this example, we're going to look at XAU USD, which is gold, and we're going to the 4-hour. We're going to do that 4-hour, 30-minute format. So we can see the structure here has just shifted from bearish with these lower lows and lower highs into bullish with this break of structure, which pushed us over the previous lower high. Okay, again, all of this down here is internal structure, so the break doesn't take place until this high goes. Now, with the market pushing into an uptrend, Our obvious next move is going to be looking for a buy on this market when we pull back to an imbalanced demand zone. Imbalanced demand zone, the lowest possible one is going to be here. So we would look for a position that looks something like this, waiting for a pullback down to then buy higher. This is the swing structure. Okay, the 4-hour is now officially in an uptrend. This is the first impulse we are going to be looking for on the 4-hour time frame. Correction, impulse, correction, impulse, and so on and so on and so on. However, of course, if we are expecting this market to get lower, well then isn't there opportunity for us to sell through this range? Surely there is a trade somewhere for us in there that we can take on a lower time frame. And that is what this substructure trading is all about. So if we go down to the 30-minute time frame now, what we're going to be looking for here is a shift in the 30-minute structure, because as we can see at the moment, along with the 4-hour, the 30-minute structure is also up. We're creating higher highs and higher lows continuously, and that is still pretty much exactly what we're doing right now. But if there was to be a break of structure like this, well, that would change the narrative here on this lower time frame. We would have seen a higher low break, and that would then lead us into the possibility of selling on this 30-minute trend. And there's nothing that really makes this 30-minute trend less valuable than the 4-hour, okay? So what we can do here is look for opportunity to sell the 30-minute as if it's its isolated pair. And then when we start to reach more significant swing structure areas, we should look to get out. Now, what we don't want to do is try to push a substructure trade too far. We should always understand if we're trading this substructure format, we only want to trade it down towards previous areas of demand because we expect the market is likely to trust the 4-hour more than the 30-minute, meaning the market is more likely to go higher once again rather than turning it into a new downtrend, okay, on the higher time frame. So any substructure trades we take essentially should take place within the confines of the last swing structure move. If the swing structure move is going up, we don't want to try and trade past that low, but we just want to see if we can push this market down into an area of demand before we then start buying once again. So essentially we create what we call a sell to buy scenario. We are looking to sell here, and then we are looking to buy from there onwards, okay? But it provides us with new, fresh opportunity on kind of trends inside of trends. We have our big picture narrative. Now we can look for an opportunity inside of that. So here is a quick rundown of what this might look like in a real market. We've seen the market push down under this level. We've then seen a pullback up. We didn't get a closure, so we probably wouldn't want to immediately look for a trade just there. Although had we got in there, that would have been a very nice place to do so. Okay, so if we'd have seen a candle closure under this low, this would have been the ideal location for us to then sell from. But what we would really want to do is see a more significant breakdown from there. We need to see closures under this level essentially to validate that we are ready to go lower. Now, yes, we did have a break here, but with substructure trades, it's always nice to see us pushing more significantly into the range so that we're not getting into positions too soon. Because, of course, what we don't want to do is dive into a sell and then just get killed by the impulse continuing. We want clear indication that the impulsive move of the market, being this move here, is over for now, and that the corrective move is beginning, okay? So there's a couple ways we could approach this. Number one, we saw a closure under this level, so you could realistically enter there. You could put your stop losses above the next high, and you could look to take the market down towards that target, where you would then look for buys. Number two, we can wait for the formation of a new demand zone or supply zone, and then sell from there. So we have a supply zone just here. The market went and pushed down and closed. So you could look at selling from this level, and you could look to take that down towards your target. Now, this one's a little bit messy. I'd prefer to go for the first opportunity of closing under the low and then selling into it. But this one is okay as well. And as you can see, the market's then pulled back and tapped it. And now we're looking essentially for a continuation lower, which is what we want to see to provide opportunity for us to be, in this position safely. Now, at this point, we'd have gotten pretty much on that first wick. The market came back, tapped entry one more time, and has now pushed down to create more significant lows. So what you could do at this point is just hold this trade out and see if this is going to be the trade that gets down towards your demand zone on a higher time frame. So this area from this high down to this low becomes your substructure area. and it provides trades, essentially trends inside of trends and trades inside of trades. You have your big picture narrative of waiting for a corrective move to then buy the impulsive move and continue the swing structure. But it actually allows you to take these smaller trades, because what we've done here is confirm change in the trend that then can be sold into to bring this market lower. So that's the general idea of how we would trade swing and substructure. And then, of course, after the substructure move is completed, your buy limit on the demand zone to get you into the impulsive swing structure move is going to be triggered, leading you then back into new highs, higher prices, and another profitable trade. So as you can see, this is why we don't want to try and take substructure trades too far, because as soon as the demand zone was hit, we just created a big move to the upside. So any substructure trade we take should look to pretty much just fill some of the range. Then we want to get out and move into the overall substructure idea, because that's the one that's going to be the highest confidence and the highest probability. So there are oftentimes opportunity to do this. Not every piece of substructure is going to give you a chance to get in. I'm saying based on the price action we saw up here, there wouldn't have been much opportunity for me to sell this movement back down. But a lot of the time, you are going to get opportunity to sell down with the substructure on the way into larger trades inside of the swing structure move. Okay, so you look for your short-term sells there, long-term buys there, short-term sells there, long-term buys there. All right, and as you can see, we never really want to push the market past an area of demand. You're good to just run it down to where you think it's going to buy from, and then you can buy, and you might find yourself a little sell on the way into it. If you enjoyed that video, hit the link in the description at the top. There is a free course which is going to help you to build a trading strategy. Second link goes to my academy if you really want to master this fast. And with that said, that is it for this class. So thank you for watching. If you don't want to do either of those things, then watch this video next. Thank you. I'll see you in the next one.